Good afternoon, everyone. Yes, online students, good afternoon. And first of all, apologies. Actually, today I should have started at 10:30, 10 o'clock like that I thought of. But as both my kids were not feeling well and I have to take them to the hospital. And as you know, doctor and all will not come on time. He's not like your CA faculty to come on time. because of that, it took time for me because he has to come and he take but because of that reason today we will extend the session till 7:30. Okay, so as we started late today alone we will go up to 7:30, 8 o'clock, but tomorrow onwards as usual from 10 to 6 or 6:30 as the case may be. Okay, and I am planning for total 4 days including today. So these 4 days my objective is to cover the revision of all the chapters in indirect taxes for CA final May 24 exam, exclusively for May 24 exam. And reason being, first I want to complete the revision. Thereafter, if time permits, I want to do the MAY24 questions. But it is not in my hands. Reason being, I can take everything in a fast forward mode also. But end of the day, it is the students who should be able to understand. So I don't want to skip any concept, mainly for that reason. Reason being, this is going to be the first question paper in this new syllabus. So as you all know that there is a change in the syllabus from 2024 onwards, but when it comes to indirect taxes, there is no change in the syllabus per se, but the weightage has changed. So previously you all know that, so in paper 8, IDT law, there used to be GST, customs and FTP, and the weightage was like this was for 75 marks and customs 20 marks and FTP used to be for 5 marks. So this is how, this both customs and FTP together they used to give for 25 marks. This is not there now. Up to May 24, so that is like up to November 23 exam, this was like this. But now there is a change. So in this paper 5, indirect taxation, what they are telling is that GST is for 80 marks, whereas customs and FTP is only for 20 marks. Which means previously there used to be one guaranteed question on FTP. So now we may not be able to expect that guaranteed question on FTP. So due to that reason, so even customs and FTP together is only for 20 marks. According to me, how it is going to impact the question paper, let me perceive. So MCQ part 30 marks, no change. That I feel the same. That will be same. And in descriptive, you have to write 5 questions of 14 marks each. I don't think so. There also there will be a change. Okay. So 5 questions of 14 marks each. I don't think so. Here also there is any change. 14 marks will be same. But in this 14 marks, see, this is what I'm predicting. I don't know certainly till the time we see the question paper. What I feel is that previously there used to be 5 marks question for customs and FTP. Now it will be 4 marks questions because of the change in the weightage. Okay. So I think the first part, so you know that in this 5 questions, the first question is a compulsory question, and that compulsory question will be for 14 marks and it will be completely on GST. So there won't be any other portion on this, and this is a comprehensive question. And this comprehensive question covers what and all, so that we should be knowing. So because without knowing the concepts of these areas, we cannot answer first question. So what is that? As usual, input tax credit. You should be thorough with input tax credit. Definitely that will be tested in the first question. And then this exemptions, ITC, then exemptions. Exemptions on RCM, so mandatory. Exemption RCM will also be definitely be tested. Okay. And thereafter, place of supply. Actually, many students will neglect place of supply. I'll tell you how it will be useful in the first question. So we need to prepare one table. So that contains like particulars, CGST, SGST, IGST. This is a standard template for every 14 marks question, the first question. So in that, what they will do is that, so they will give the transactions. So in the transactions, we need to analyze whether it is taxable or exempted. But when it is taxable, so then again, whether it is intrastate or interstate, this is where we miss. So because place of supply, if you are not properly applying, instead of intra, if you put inter, or instead of inter, if you put intra, what will happen? The answer will not be correct. I mean, the total answer is correct, but computation wise, when you do, so gross liability, there will be a change. When there is a change in the gross liability, ITC application also will change. So net liability also will change. So because of a small error, what is that small error? Treating intrastate supply as interstate supply, the waterfall effect will happen, because of which for a 14 marks question, we may be getting only 6 marks or 7 marks. So this is where majorly we will lose. So because see, while giving the marks, they will behave as if their wealth they are sharing with us. You understood? While taking the marks, like government, they will take tax, like government will take the tax from us, like a right royally they will take, like that they will deduct the marks. And that too, November 23 paper, after seeing the way evaluation is being done, so literally like, so I wanted to become a terrorist and become a human bomb and go to the place where the valuation is happening and kill myself. Actually, I thought of that. Okay, our question answer is correct here, but 1 mark also not given. Skipped. Bro has skipped. You understood? So he skipped giving the marks. Okay, because of which that student has got 48 marks. 48 marks, and that impacted the aggregate. So literally many students who thought that they will be getting 60 plus and all, literally they failed in indirect taxes, and some students did not get proper marks like 43, 42 like that and all they have got. So evaluation, already this has been escalated to the proper places by all the faculties, but I don't know how they are going to do that further. So that is one update I just wanted to share. So to the extent possible, see, basically they are all psychos and sadists who do evaluation. Okay, so definitely, usually there is something called as Garuda Puranam. Okay, so in that Garuda Puranam, people who do sins and all, they will be put in the oil and we will fry it there, in hell. These people will definitely face. You understood or not? So they will definitely face, because they are playing with the life of the students every 6 months, and therefore already they are like that. So we should be careful. You understood what I am telling? We should be careful enough and ensuring that not even one mistake we are doing in the exam. So that should be your objective. You understood? It's not about how much time you are learning or how much efforts you are putting. End of the day, that 3 hours, that bloody 3 hours is going to be your testing time. You understood or not? So therefore that 3 hours, how you perform matters a lot. In that 3 hours, ensure that these mistakes and all, you are not doing anything. You understood? So what is that? Place of supply, you should be properly able to identify whether it is intrastate or interstate. That's why I am telling you ITC, exemptions and RCM, place of supply. Also supplementary, some more aspects we need to know whether an activity is supply or not. Because what happens, there will be one question which says that so and so person has given a product on gift basis, okay, to other person. And in that ITC related point also they will be testing like ITC has not been availed. But this focus will not be there in exam hall. They will think, okay, gift given, and definitely it will be supply 71C. So it will be taxable. Sometimes the activity itself may not be a supply, but we will bring it into taxability and we will be paying the GST also on that. So ensure that mistakes and all should not happen. So first we need to check the supply or not. And sometimes even time of supply will also be tested. In what way? The transaction may be taxable in the next month. So we will not see that. It is given in one particular, so which means we will directly take. So you see whether the transaction, time of supply falls in this particular month or not. So only then the GST will be payable during this month. Otherwise it is not payable. Moreover, for ITC it will be impacting. So it's like invoice in the month of January. but goods are actually received in the month of February. When we can take ITC? January or February? Only February month we can take ITC, because we have one point now. What is that? Goods should actually be received for availing the ITC. Just invoice is not sufficient. So they will give invoice date January. Goods are received in February. But right now we are doing the computation for January month. So this ITC if you have taken, so gone. Unnecessarily the answer will go wrong. You understood? So that's why all these points carefully you see and apply, and then you will arrive at the answer. According to me, as a strategy, I'll advise you, you write this 14 marks question at the end. At the end, okay? Keep your pressure at the end. You understood or not? So therefore, what happens is that I have interacted with many students. What they said is that, sir, this 14 marks question, sometimes it is taking 1 hour, 1.5 hours, sir. Even though we have learned the subject and we went, we did not attempt for 100 marks. That is the target for you. It is like 100 marks you should attempt. When you can attempt 100 marks, the time management is very, very, very important. So ensure that you are not spending more than half an hour for each question. So which means 14 marks question means half an hour. So how many 14 marks questions you need to write? 5 14 marks questions you need to write, correct? 5 into 14, 70 marks. These 5 questions, half an hour, not more than that. So 2.5 hours gone for that. And 30 MCQs, 30 marks MCQs. You will not get 30 MCQs because many are 2 marks MCQs and all. Hardly it will be like 18 or 19 MCQs only, okay? So there 30 minutes, not more than that. The way if you are doing this way, categorize your time this way, definitely you can attempt for 100 marks. So please keep that as the first target. So what is target number 1? Attempting for 100 marks. So sir said to attempt, so we will write question paper that will come under attempting is not that. No? Question paper, if you write only the question number, that is not attempting means. Attempting means you are trying to arrive at the answer and you are doing it. Whether it is correct or not, so leave it to God, you understood or not. But you should be putting effort and half an hour time. Definitely will save time. Few questions and all, what will happen? It will not take half an hour for you to write. Sometimes you will save time, so that you can spend on the 14 marks question and all. So when it will happen? Only when you put the 14 marks question at the end. When you keep a target of 30 minutes, first 30 minutes for MCQs. MCQ you do first, 30 minutes, not more than that. Thereafter, don't spend time. Okay. Then next, so you have 2.5 hours. In the 2.5 hours, the 4 questions. Which 4 questions? Question number 3 to question number 6. Question number 3 to question number 6, you write any 4 questions. Question number 3 to question number 6. Out of this, any 4. Correct. So in that any 4, you write that, complete that. Definitely, I'll tell you, it will take 1 hour 45 minutes only. Actually 2 hours time, but it will not 2 hours. It will take 1 hour 45 minutes. Moreover, these questions are small questions. That's what I told you now. So GST, I think part A will be GST, part B will be GST, and part C will be customs and FTP. Previously, this customs and FTP questions used to be for 5 marks. 5, 4, 5. That's how it used to be. So the logic was simple. 4 questions you need to write. 4 into 5, 20 marks, descriptive. And then 5 marks, they will be checking in the MCQs. Got it? Now the weightage has been reduced. So I feel this is 5 marks, this is 5 marks, this will be 4 marks questions on customs and FTP. So 4 marks questions into 4, 16 marks. And remaining 4 marks they will test in the MCQ. That's the logic which I have arrived. So I feel this is how it will be. So therefore, GST questions will be like 5 marks and customs mostly it will be 4 marks type questions only. So now, what should be the strategy in customs, sir? It should be like concept learning. Don't think, you will not get big questions and all. Mostly it will be testing your concept to the point. So therefore, that is the objective. But GST, compared to last attempt, what you have prepared or what you have done, so definitely you need to accelerate your preparation and you need to learn really lot of things in this. Okay, you cannot take any chapter for granted. Don't do anything like that. So, and first thing I wanted to share with you all is that there is nothing like that called ABC analysis for May 24 exams. Don't keep that. Don't keep that. Every chapter is important. Maybe I can give you less important and more important. You understood? Don't think, because come on, we are dealing with ICI. You understood? So they play with many tactics. So if they test the education, definitely everyone will clear CA. You understood? They are not testing on education. They are playing with the mindset of us. Okay. So what they will do, they know that there are few chapters, students will neglect that, like refunds, appeals, and offences and penalties, then demand and recovery. They know these are the chapters CA students will not prepare. So they will all be preparing input tax credit, value of supply, like that. From this only 20 marks they will be asking. You understood? So that's why I'm telling you, first attempt, this May 24 attempt, don't take anything for granted, don't skip any chapter. So please try to cover all the chapters. That is the humble suggestion I am giving to all of you. Okay, keep that in mind. Anyhow, exam is going to be postponed for sure. For sure, for sure. Don't worry. Tomorrow, if it is not postponed, don't question me. But really, what I have interacted, I could say, but because like they have not yet given the election date, and they made an effort of one nation, one election, like one nation, one GST. One nation, one GST was not possible. So same one nation, one election also not possible. Okay, so it will take time. So that's why ICI already they have taken the decision to push it to June, because election result and all this will come. So that's why they are pushing it to June. So therefore we have ample time. So it's like God has given 1 month extra for us, like that you think. So that extra month for what? Not for postponing preparation. Preparation should be on time. Okay, don't postpone your preparation. Learn extra. You understood? Whatever things which you could not learn, that you should learn. That's how you need to use this 1 month time properly. You understood? And then, so therefore GST, you don't think like ABC and all. Don't listen to anyone. Okay, so you believe in me. Don't follow ABC analysis for indirect tax subject alone. Okay, I'm not talking about other subjects, because I'm not taking other subjects. I'm talking about indirect tax. Don't follow ABC analysis, but I can tell you like what are the more important chapters. There you should be focusing more and ensure that without preparing that you should not go for exam. So what are those most important chapters? Most important. Without this you should not. So we have, and this is based on the order, first, second, third, like that only. So input tax credit. Without input tax credit, you cannot see question paper. All the provisions relating to input tax credit, wherever it comes. For example, one rule 86B is there. 86B says what? We have to pay 1% of our gross liability through electronic cash ledger, even though we have sufficient balance in the electronic credit ledger. That provision will come in payment process, but it's related to input tax credit. You understood? Like that, whatever provisions which are related to input tax credit, because if you take out input tax credit from indirect tax subject, the indirect tax subject will be like miscellaneous, some 30 marks only. Really? Because all the provisions which are all there is surrounded by input tax credit only. So due to that reason, without learning this, you should not. So input tax credit. And second, exemptions and RCM, GST. Exemptions under GST. Then now they have added RCM for goods also. Previously RCM we had for services. Now they have added goods also. Okay, because they have removed one chapter in customs. Duty drawback, like that one chapter they have removed. Okay, and so as they removed, they need to compensate na. So they have added RCM in case of goods. Who asked them to remove, and why they are adding, we really don't know. One more chapter also they added, that is ethics under GST. So 2 chapters in GST they have added, like 2 concepts, ethics in GST and thereafter this RCM in case of goods. What they have eliminated is duty drawback. Really duty drawback is not there. Okay, and therefore RCM with respect to goods and services. RCM with respect to goods and services. And number 4 is value of supply. Value of supply, then place of supply, Next, we have this valuation under customs. Valuation under customs and types of customs duties. Then refund under GST. So this also will be definitely be tested this attempt, because there are n number of cases right now on refund, and moreover CAs are mainly involved in processing this refund and certifications. So therefore I feel like definitely questions will be started, like from this attempt onwards more questions will come on refund. Then as they added ethics in GST, this refund is refund under GST. Ethics in GST, because they added one new chapter, definitely they will test one question on this for sure, okay. And then offenses, penalties and prosecution, because there are a number of amendments in this. Previously, what are the cases where imprisonment happens? So we had a big list. Now they modified that. Even imprisonment limits also they have modified. One section called as compounding of offences, fully they have revamped. So due to that reason, from this offence and penalties, prosecution you will be getting. So these are the 10 most important areas. Most important. Remaining and all less important but important, you understood. It is important only but less important, but this is most important. Now, so what I am going to do is that I am going to take the lectures from That's It book, and That's It book, if you might be already purchasing it, and if you have it you can refer from that, and if you don't have it, if you have attended the regular batch, at the end of each and every chapter I have given in resource book the revision. Either you keep that, or no sir, I want to buy one book, I can afford, I can invest, then you can purchase it, okay. So it will be handy. And then if I am writing any extra points, so that extra points you just put a sticky note and you just try to write those extra points, and even I will also share with you the handwritten notes. Anything extra I am writing and all, that handwritten notes I will share with you, don't worry about that. So in the Telegram group I will be sharing, so you can be accessing that handwritten notes as well, even if you miss writing anything etc and all, okay. And I will give more importance to amendments, as you know, like every May attempt. So the target, like previously 14 to 16 marks they used to test on amendments. I have observed that every May attempt, so 14 to 16 marks was from amendments only. That's why we cannot take amendments easily. So therefore I will focus more on amendments, and in the book itself I have given what are all the amendments that we have, index of amendments I have given. In the beginning itself I gave the index of amendments. So this many amendments are there, around some 37 amendments, okay. 2 pages I have given an index of amendments. In that, along with the page number, where and all this has a reference. Now what you need to do is that, so like this one day before the exam, you should definitely revise this amendments and go, okay. And what I will do is that now while taking the classes, I will discuss everything, but amendments alone little bit in detail we will be focusing on, okay. Then, and this being revision, please don't expect me to discuss everything in detail etc and all. So definitely not possible, and I know that you will not expect me also to do that, because already you would have attended the regular lectures or fast track batch etc. So this purely revision, let's focus it like a revision, and some usual questions will be there in YouTube. Let me answer that first. Sir, will these lectures be available even after live session? It will be available forever till the time YouTube server is there. So don't worry, it will be there. So sometime May 2020 I have uploaded, that still it is there. So why will I remove? What is the benefit for me if I am removing? Then second thing, sir, this explain that concept once again, sir. Don't ask, because it's YouTube. You have the scrolling bar, just to scroll before. So again the video will come, so you can watch it. Unlimited time we can watch, okay. So don't ask me to repeat any particular concept because this is not a regular class, it's already there in YouTube, okay. These two requests. And sir, please share the PDF of this book. Ask my wealth also, okay. So my life will be like this, you understood. I cannot share PDF and all, so you can buy that, and really if you cannot afford, message our team, so they will be able to help you out, okay. So this book is 400 rupees only here, you can definitely afford. And then I'm not starting in like chapter 1, chapter 2, chapter 3, because this is not a regular class na, to discuss everything from the scratch, etc. and all. So that's the reason why. So first chapter I am going to discuss is this introduction to GST, just for namesake, but thereafter we will proceed to input tax credit. So the agenda for today is that today we will be completing input tax credit and value of supply. If time permits, we will also discuss composition scheme. So that's the agenda for today, okay. So see this basic concept, actually they removed from the syllabus itself, they just gave it like an appendix to the first chapter in the new study material. New study material, chapter number 1 itself is supply under GST. In that somewhere below in appendix they gave this. So I don't think so any question will be tested on this. Even if it is tested, it will be mostly MCQ type only. So quickly we will see this. You all know all these things. So when is GST implemented? With effect from 1st July 2017. And how GST is formed? A lot of indirect taxes which we had in the past that got subsumed into GST. So whether all central government levies got subsumed into GST, everything got subsumed into GST except customs duty. So excise duty, service tax, central sales tax got subsumed into GST. Here related to central sales tax, you should know one point, that central sales tax is levied by central government, but it will be collected and retained by the state government. So that will not go to the center, even though it is levied, it was levied by central government, okay. Then customs duty is outside the ambit of GST. However, additional customs duties, so two additional customs duties called as CVD and SAD, countervailing duty and special additional duty, these two so got subsumed into GST because basically this countervailing duty is to counterbalance excise duty. Excise duty got subsumed into GST, due to that reason CVD also got subsumed into GST. Then special additional duty was to counterbalance sales tax. As sales tax got subsumed into GST, so this SAD also got subsumed into GST. So therefore, these additional customs duties, when it will come on import only, these additional customs duties basically will come. So this will not come on export. Additional customs duties will come only on import of goods. On import of goods, we should have paid additional customs duty, but as we are not paying this additional customs duties now because it got subsumed into GST, so on import of goods, along with customs duty, we are also required to pay IGST, okay. Then indirect taxes levied by state government in the past, only these specified indirect taxes got subsumed into GST, total 6 indirect taxes, that is value added tax, advertisement tax, luxury tax, entertainment tax, lottery and betting tax and purchase tax. Purchase tax also known as octroi, only 6. Apart from this, other indirect taxes levied by state government or indirect taxes levied by local authorities not got subsumed into GST. There is a possibility of asking this as a MCQ. Which of the following got subsumed into GST? A. Value added tax. B. Central sales tax. C. Entertainment tax levied by local authority. D. None of this. What will be the answer? C. Entertainment tax levied by local authority, because entertainment tax levied by local authority, not only entertainment tax, any taxes levied by local authority not got subsumed into GST, okay. So that is this point. Then what about the professional tax which will be levied by the state government, whether it got subsumed into GST or not got subsumed into GST? Not got subsumed because we don't have that in the list. So value added tax, advertisement tax, luxury tax, entertainment, betting tax, purchase tax, but we don't have the professional tax. So the professional tax not got subsumed into GST. So this alone you please remember. Then entertainment tax, there are two entertainment taxes. One entertainment tax which is levied by state government got subsumed into GST, but another entertainment tax which is levied by local authority not got subsumed into GST. Then India has adopted the dual GST model. So what is dual GST model? On the common tax base, both central government and state government can levy tax, that is known as dual GST model. And this dual GST model so is adopted from Brazil and Canada, where both CGST has power to levy tax on the common tax base, and GST Council. So basically GST Council is the decision making body under GST. So GST Council derives its power from one article. So article 279A of the Constitution, article 279A of Constitution, and this is constituted by President of India. But who is the head of this GST Council? Union Finance Minister is its chairman, and basically it will have 33 members. Who are those 33 members? So one Union Finance Minister and 33 state ministers. How's are 33? We have 28 states and 3 union territories with state legislature. What are they? Delhi, Puducherry, then Jammu and Kashmir. These 3 are considered as union territories with state legislature, treated as state only under GST. And for this 33, we have 33 ministers, that is the 31 states, 31 state ministers plus 1 union finance minister, and remaining 5 union territories without state legislature. What are those 5 union territories without state legislature? Ladakh, Andaman and Nicobar, Lakshadweep, Daman, Diu, Dadra, Nagar Haveli and Chandigarh. So for these 5 union territories, we'll have 1 union MP in charge of the revenue. So that person also will be there. So total 33 members. And what is the quorum? 50%. So 50% should be present in the meeting. Then only it will be called as a valid meeting. In that meeting, central government is having how much weight? 1/3 weight. Whereas state government is having 2/3 weights. And what should be the majority? A simple majority is sufficient, or a weighted majority is required? Weighted majority. And what is that weighted majority? That's where for central government vote 1/3, and for state government vote 2/3, and that too it should be like a special resolution majority. What is that? 3/4. 3/4 majority is required. Then next aspect, we need to know what are the types of GSTs. So how many GSTs we have? 5. CGST, levied by central government. On what supply? Intra-state supply. What is a intra-state supply? If location of supplier and place of supply is in the same state or same union territory, then it is intra. If location of supplier and place of supply is in 2 different states or 2 different union territories, or a state and a union territory, then it will be known as interstate supply. So in case of intrastate supplies, we will have CGST plus SGST if it is within the state. Example, location of supplier Tamil Nadu, place of supplier also Tamil Nadu. So Tamil Nadu is a state. So CGST levied by central government plus SGST levied by state government. Suppose if the location of supplier is in say Ladakh and place of supply also Ladakh, then it will be intrastate only. And what is the type of GST? CGST plus UTGST, Union Territory GST. But in Jammu and Kashmir, it will not be UTGST, it will be SGST only. So these 3 basically CGST, SGST and UTGST levied in case of intrastate only. Okay. And who will levy CGST? Central government. SGST, state government. UTGST we don't have any separate government. It will be under the control of central government. So central government. Whereas IGST, when IGST is levied in case of what type of supply? IGST levied interstate supply. Interstate means what? I have given next page. What is the meaning of intrastate and interstate? Intrastate means location of supplier, place of supply in same state or same union territory. Interstate means location of supplier, place of supply in 2 different states or 2 different union territories, or a state and a union territory. So IGST is levied. Who will levy this IGST? Central government will levy on interstate supply. Then there is something called as GST compensation cess. GST compensation cess is levied only on notified goods. Sir, what are those notified goods? That you don't have to remember. So there is some list of notified goods. So if at all in question, if there is GST compensation cess given, then only you consider, otherwise don't consider. And sir, how GST compensation cess will be computed? Just like how GST is computed, the same way. For example, 10 lakhs is the value. GST is 28%. GST compensation is 12%. Now what you will do with 12%? While adding the, while computing the GST compensation, don't add GST. GST 28% also on 10 lakhs and compensation says 12% is also on 10 lakhs only. But don't add this and show like 28 plus 12, that will be 40%. Always you need to show the taxes separately. So show GST at 28%, compensation says at 12%, like that. But these two will be computed on the same value only. You understood? So GST compensation says is levied on notified goods. Some examples of notified goods. What are the examples of notified goods? Tobacco products, pan masala, and then we have this aerated waters, and then motor vehicles. These are some examples on which there is GST compensation cess. Mainly, what is the purpose of this GST compensation cess? This is levied on notified goods which are sold across the country, anywhere it may be sold. And this GST compensation cess, which is collected by the central government, will be used to compensate the states on account of the loss incurred by them due to implementation of GST. So to compensate the states on account of implementation of GST, and shall be levied up to, what is the date up to which the GST compensation cess can extend? 31st March 2026. For MCQ purpose it will be useful. 31st March 2026. Can it be extended even beyond that also? Yes, as and when the GST Council decides, they can extend it for a further period of time as well. Right now it is up to 31st March 2026. Then IGST is levied by central government, we know that, and out of this IGST 50% will go to whom? 50% will go to the consuming state based on place of supply. So in case of B2C transactions, I am not talking about B2B transactions, in case of B2C transactions, or in case of like B2B transaction but recipient is not able to take ITC. So in these two cases, what are the two cases I am referring to? What is the type of supply? Interstate supply. The type of supply is interstate supply. And what is the transaction? B2C, okay, or B2B. B2C means what? Recipient is unregistered. B2B means what? Recipient is registered. B2B where recipient so cannot avail ITC. Why recipient cannot avail ITC? There are many reasons. So maybe he is using it for exempted supplies, or he is using it for non-business purpose, or he is like blocked credit, or he may not be able to take it within the time limit. So any reason, so he is not able to take the ITC. So in these two cases, interstate supply, B2C or B2B where recipient cannot avail ITC, what happens is that 50% of the IGST, 50% of IGST given to which state? Given to consuming state. Given to consuming state. Now say for example, it is like place of supply is Karnataka, location of supplier is Tamil Nadu, then IGST will be collected. In that IGST 50% will go to Karnataka. So that's the logic behind it. Sir, what if it is B2B and recipient can take ITC? If recipient can take ITC, we need to see how he is going to use that ITC. See, it is very simple. 50% of IGST is given to the consuming state when? If it is B2C transaction or B2B where recipient cannot avail ITC. Now here, what if location of supplier and place of supply, location of supplier is Jammu and Kashmir, place of supply is Ladakh, then nature of supply, if you see, the nature of supply is interstate, and then what will happen to the revenue, IGST revenue or GST? So here it is collected by, who will be collecting this? Central government, and 100% retained by central government only. Why 100% retained by central government? Because Ladakh is under the control of central government. Suppose if it is reverse, location of supplier is Ladakh and place of supply is Jammu and Kashmir, the nature of supply is again inter, but Jammu and Kashmir is union territory with state legislature, means there is a separate government for that. So therefore, even though it is interstate IGST collected by central government, 50% shared with Jammu and Kashmir. You understood? So this is what you need to remember. 50% IGST given to consuming state or union territory with state legislature. State legislature. Now sir, what if it is an interstate supply and if it is B2B, not B2C, B2B and recipient can avail ITC, opposite of the above. Then in this case, interstate supply, B2B and recipient can avail ITC. What will happen? Simple, that IGST credit, what we are going to do? So we have a IGST credit to the recipient. That recipient is going to use IGST credit against IGST payable. Then we can't do anything. Still it is in the IGST account only. So then suppose if it is used for CGST payable. So then what will happen? Entire amount will go to, goes to central government, correct or not? Suppose if the IGST credit is used for SGST payable, then also entire amount goes to state government. Okay. Suppose if this IGST credit is used for UTGST payable, then what will happen? Everything is R here, either this or this or this or this. If it is to UTGST payable, then what will happen? Entire amount goes to central government. Okay. Now when IGST credit is utilized for payment of IGST payable, so it will be still in suspense account. Okay, because we cannot distribute it. Still it is in IGST account. Suppose if IGST credit is utilized for payment of CGST liability, what will happen? So fully it was in suspense, now it will go to central government treasury fully. If it is IGST credit utilized for payment of SGST payable, previously it was in suspense, now it will completely go to state government. IGST credit, if it is used for payment of UTGST is under whose control? Central government. So again completely it will go to central government. So in this regard, we need to know IGST settlement as well. So what is this IGST settlement means? IGST settlement means it's like two situations IGST settlement will happen, and one situation what we have seen is above, that is when IGST credit is utilized for payment of SGST payable. So then central government will, because this IGST credit means what? This money is collected by whom? Central government. So central government will give this money to state government. Whereas when SGST credit is utilized for payment of IGST liability, then also this problem will happen, that is state government has to pay that amount to central government. So what are the two situations where IGST settlement will happen? Number one, IGST credit for CGST payable, IGST credit for SGST payable. When IGST credit is used for SGST payable, what will happen? CG shall transfer or shall pay to SG. Then second situation, when SGST credit utilized for IGST payable, even in this case there will be IGST settlement. Who will make payment to whom? State government shall pay to central government. So these are some connecting topics related to this, and that's what I have given here. Okay, so don't worry, parallelly if you are not able to copy also, anyhow as I said, by the end of the lecture I will share this PDF, and even it is there in the YouTube also. YouTube, in the description I will be giving this PDF, in case if you miss in Telegram also you can check there. Okay, don't worry about this. So enjoy on learning the subject first. Okay, so because it's purely a revision for that purpose. Then so that is what I have given. If place of supply cannot be ascertained, it shall be apportioned between the states based on turnover of the supplier during the financial year. First what we need to do, IGST levied by central government, 50% will be transferred to state government based on place of supply. So that's what we have seen, and also we have seen when it will be. If it is B2C or B2B where recipient cannot avail ITC, and interstate supply, B2B and recipient can avail ITC, what will happen we have seen. Now what is a crucial point here? So 50% IGST given to consuming state. But how do I know consuming state? So consuming state is known based on place of supply. So what if the place of supply is not ascertainable? So then they have given one provision which says that it shall be apportioned between the states based on the supplier during the financial year. For example, my turnover during this financial year from Tamil Nadu to Andhra Pradesh 20 lakhs, Tamil Nadu to Karnataka 10 lakhs, Tamil Nadu to Kerala 5 lakh. So in 20:10:5 ratio, this will be distributed between Andhra Pradesh, Karnataka and Kerala accordingly. You understood? That is this. So it shall be apportioned between the states based on turnover of the supplier during the financial year. Then state of Jammu and Kashmir is divided into 2 union territories. So that you should know. Union territory of Ladakh, Union territory of Jammu and Kashmir. Ladakh is a union territory with legislature or without state legislature? Without state legislature. And Union territory of Jammu and Kashmir is with state legislature. Then Union territory of Dadra and Nagar Haveli and Union territory of Daman and Diu. So this got merged into a single union territory. So therefore, if any supply takes place between Dadra and Nagar Haveli to Daman and Diu, don't write it as interstate. It should be intrastate. Then last we have GST network. So GST network provides shared infrastructure. So between central government, state government, banks and taxpayers for the purpose of implementation of GST. Basically they provide information technology infrastructure for implementation of GST, and it can be referred to as common portal, and provides services to taxpayers, central government, state government, banks and other stakeholders. So basically what are the functions of the GST network? It facilitates registration. So if you want to do registration or payment of taxes or filing of returns or settlement, just now we saw settlement of IGST. So see SGST credit for IGST liability, IGST credit for SGST liability, that is known as settlement of IGST, e-waybill, etc. So these are the functions of GST network. And don't give much importance to this because basically this is not there in the regular syllabus. It was just given as an appendix because at intermediate level to final level students, those who are coming for a refresh only, this has been given. So maybe 1 or 2 MCQs may come, otherwise it may not be. Then now we are moving on to one important chapter, that is input tax credit. And you might be knowing what is input tax credit, etc. and all, but I just wanted to give you a quick recap of that. Input tax credit basically is tax paid on inward supplies. So you can see page number 79. So you have some information in page 79 related to this input tax credit. So if you have book, you can refer, otherwise wherever you are referring, you refer from there. So input tax credit is basically what? I have some inward supplies. Inward supplies means what? My purchases. On my purchases, whatever GST that I have paid is known as input tax credit. So what is input tax credit? GST paid on inward supplies. What I can do with that input tax credit? I can utilize it for payment of GST on my outward supplies. Okay, this is basically what input tax credit is all about. So that I have some purchases. On that purchase, I paid some GST. I will take it as credit and I will set off against the GST which I have to pay on my sales. So this net GST payable is what? Gross GST payable, that is tax on outward supplies minus input tax credit is called as the net GST payable. In this, we have some returns which you should be knowing first. GSTR 1 is a return that contains the details of outward supplies. So every registered person is required to file a GSTR 1. So GSTR 1 contains what details? Only outward supply details. It will not have anything else. And these outward supply details furnished by every registered person. Basically this will have invoice wise details or consolidated details. GSTR 1 will have invoice wise details. GSTR 2A and 2B both are inward supplies. So this we will not file. So based on our supplier's GSTR 1, the portal will make us available GSTR 2A and GSTR 2B. So our supplier should have filed GSTR 1 and he should have mentioned our name as his recipient. Our GSTN should be mentioned so that it will come to us. Who are we? Recipient. While studying input tax credit chapter, you keep yourself from the recipient point of view and see the provisions. Okay. So your recipient basically and your supplier will be filing GSTR 1 and he will be reporting the details of outward supplies in his GSTR 1 by mentioning your GSTN so that it will come in your GSTR 2A and 2B. So both are containing inward supply details, but how is it different? GSTR 2A is basically, a dynamic statement which will keep on changing, keep on updating, but 2B is a static document. Now, for the purpose of availing ITC, whether 2A is relevant or 2B is relevant, which is the relevant document? 2B is only relevant, so 2A is not relevant. 2A is just a reference document only for the time being. So 2B is only the document on the basis of which ITC can be availed. So 2B is a static month-wise auto-drafted statement for regular taxpayers and it is like 2A but remains static. Static means what? So up to a particular date, if your supplier has filed the GSTR 1, then it will be made available to you. What is the due date of GSTR 1? 11th of the month following every month. And when the 2B will be generated? 13th of the month following every month. And GSTR 1, there is a quarterly return also. So, but that comes under QRMP if opted, quarterly return monthly payment. Otherwise, basically GSTR 1 is a monthly document. So, what is the time limit of GSTR 1? 11th of next month. 11th of next month is the due date. Whereas 2B, by when it will be made available? 13th of next month. 13th of next month means by 13th, whatever are the details which are required to be furnished, if it is furnished, then only the data will be made available to us in 2B. But 2A is not like that, it will keep on changing, means even if the GSTR 1 is filed late, it will be updated in 2A. Then 3B is a consolidated document that contains all outward supplies, inward supplies details, GST payable and GST paid. Now, the difference between 2A and 2B may not be important for exam, but you should be knowing it. So, type of document, if you see 2A I told you dynamic, but 2B will be static. TDS TCS details, unfortunately it is not reflected in GSTR 2B, it will be reflected only in GSTR 2A. That is another difference. Next, third difference is that details of invoices, if GSTR 1 filed after due date, what is the due date of GSTR 1? Just now we have seen 11th of the next month. If the GSTR 1 is not filed by your supplier by 11th of next month, so it will not come in 2B, but it will come in 2A. So 2A the details are reflected, 2B not reflected. However, it will be reflected in 2B of next month. So however, it is reflected in subsequent month 2B. And what is the purpose of this GSTR 2A? Just for reference purpose only, whereas 2B is for the purpose of availment of ITC. What is availment of ITC? Taking ITC. So remember three words: availment of ITC, taking ITC, utilization of ITC, set off of ITC with our liability, reversal of ITC, reduction in ITC. So availment, taking ITC, utilization, set off with liability, utilization, set off. So reversal, reducing. All these three will be done in GSTR 3B. Okay. Availment of ITC we can do in 3B. Reversal of ITC we can do in 3B. Utilization of ITC also we will be doing in 3B only. And for availment of ITC, 2B is a document, which means how much ITC we can take. Only that ITC which is reflected in 2B. How this is reflected in 2B? Based on our supplier's GSTR 1. This is what Rule 36 sub Rule 4 says. So section 41 read with Rule 36 sub Rule 4. Only those ITC which is reflected in GSTR 2B can only be taken. This is called as matched ITC. So see that. So this is the information we are trying to understand. So where is this information given? This information is given in section 41 read with. Section 41 read with Rule 36 sub Rule 4. Section 41 of CGST Act and Rule 36 sub Rule 4 of CGST rules. What does it say? So only matched ITC can be taken. What is that matched ITC? Supplier will file the details of outward supplies in GSTR 1 or IFF. What is IFF? Invoice Furnishing Facility. A person who is under QRMP, they will be filing returns on a quarterly basis. We all know that only if the GSTR 1 is filed, it will come in 2B. Means if our supplier is under QRMP, he will be filing GSTR 1 on a quarterly basis. Then this data will come in our 2B on a quarterly basis. Until that point of time, we cannot take ITC. So that's why they have launched this IFF. So your supplier, even though he files the GSTR 1 on a quarterly basis, but for the first month and second month, he can file a invoice details in IFF, Invoice Furnishing Facility, so that the data will come in your monthly 2B itself, even though he has not filed GSTR 1. So therefore, in our 2B, the data will come from GSTR 1 of the supplier as well as IFF of the supplier. So GSTR 1 or IFF, supplier reports the outward supply details and it should be filed by the due date. That is very, very important, because just now we have seen, suppose if the supplier files GSTR 1 after the due date, it will come in our 2B, but not this month 2B, it will come in next month 2B. So this is known as matched ITC. So this much only can be taken. But section 41 says, this is given in Rule 36 sub Rule 4, but section 41 says, we can do self-assessed ITC. 36 April 4 says only matched ITC can be taken. Section 41 says self-assessed ITC can be taken. What is that self-assessed ITC? Matched ITC plus the 6 adjustments is known as self-assessed ITC. What are these 6 adjustments? First 3 adjustments related to I am supposed to take matched ITC. It is reflected in 2B. It is reflected in 2B, but I should not take ITC. Why I should not take ITC? Because it is blocked credit or used for non-business purpose or used for exempted supplies. So these are the 3 things. So these 3 things basically are what? Reflected in 2B. Reflected in GSTR 2B. But ineligible. You should not take, even though it comes in 2B, but you should not take. Blocked ITC, used for non-business purpose, used for exempted. Then there are 3 things which is not coming in 2B, not reflected in 2B, but you are eligible, you can take. Not reflected in 2B, not reflected in GSTR 2B, but eligible. What are they? GST under RCM. So whatever RCM liability that I have paid, so means what? I have some inward supplies on which I am paying some GST under RCM. So my supplier may not report these details in his GSTR 1. If the supplier reports the details in GSTR 1, it will come in my 2B. Then the question of taking ITC problem will not arise. So what happened here? My supplier did not report in GSTR 1 because it was an outward supply covered under RCM on which he is not having the liability, I am having the liability. So he did not report in GSTR 1, but I have to pay the GST under RCM. Whatever GST I paid under RCM, can I add it to my ITC? Yes. Same month, yes, no need to wait for next month. Same month itself you can add it for ITC and you can adjust it only against FCM liability, because whatever GST that we have paid under RCM, so we will take it as ITC, but ITC cannot be used for RCM liability itself. ITC can be adjusted only against FCM liability. So keep that point in mind. Then next, re-availment of ITC reversed earlier. What is that? Initially we availed the ITC, that got reversed. Again we are re-availing now. It may not come in this month 2B. Why it will not come in this month 2B? Because it is not pertaining to this month. This was pertaining to some period before. We availed, we reversed. Again we are re-availing. It would have been reflected in the 2B of some that month. It may not come in this month. Even then we can take ITC. Then third one, ITC pertaining to the earlier tax periods, not availed in that period, but we are availing now. There is a time limit for availment of ITC. What is the time limit for availment of ITC? 30th November of succeeding financial year or date of filing annual return, whichever is earlier. That is the time limit for availment of ITC. By the time limit, previously it was September like that. So 30th November of succeeding financial year or date of filing annual return. Due date of filing annual return or actual date of filing annual return? Actual date of filing annual return. Whichever is earlier is the time limit. That is the time limit by which we should take the ITC. So there is a time limit for availment of ITC, but for utilization of ITC, there is no time limit. We can adjust it against our liability any time in future. Now what happens is that somewhere in April I have made the purchases and I want to avail the ITC in the month of November, this year only. So now can I avail the ITC? Yes, but it will not come in November month 2B. It would have been reflected in April month 2B. Can I take the ITC now? Yes, because you are within the time limit. Yes, and you can take ITC, but it will not come in this month 2B. It's okay. It was reflected in one month, some month before. So it's okay, you can take the ITC. These are the 3 things wherein even though it is not reflected in 2B, but eligible and you can enjoy the ITC. That is GST under RCM. Re-availment of ITC reversed earlier. ITC not availed in earlier period but reflected in 2B of that period. Now, because we are taking this extra ITC, what will happen? So, we will get a notice. Because of this, we will get a notice in terms of Rule 88D. So, that is also an amendment for this May 24 exam. Rule 88D. So, therefore, read with Rule 36.4 and Rule 88D. What does this Rule 88D says? Rule 88D says whenever you have availed ITC in your 3B more than your 2B. So when 88D will come? Whenever you have availed ITC in your 3B more than your 2B, okay, at that time you will get a notice. Sir, can I take, sir? Yes, because 3B ITC is basically editable. So we can edit that. We can enter the amount, whatever amount you want, you can enter that. But the problem is, if you are entering some number which is your lucky number and all, so we will get a notice. For what reason? Boss, in your 2B, this much only was the ITC. You have taken extra. So show us the reason why you have taken excess ITC. So one notice will be given to us. Okay. So that notice will be Form GST DRC 1C. Okay. One notice we will be getting, and based on that notice, so we need to give a reply. What is that reply we will be giving? Maybe it is genuine case. These are the 3 genuine cases. What are these 3 cases? Sir, I paid some GST under RCM. So I will reply. So this is the RCM liability. So please refer to my 3B, table 3. I have mentioned some RCM liability. So this much only I am taking as ITC, justifiable. Number 2. So re-availment of ITC reversed earlier. So in one 3B I would have reversed the ITC. So I will refer 3B of so and so month, where I have shown the reversal of ITC. Whatever I reversed only, I am re-availing now. So justifiable. Number 3. It pertains to 2B of 1 month, but I have not taken ITC in that month, but now I am taking the ITC. So you just refer in which month 2B it was reflected, so but you have not taken. So you give the reference of 2B and 3B of that month, and so that it is justifiable. These are the 3 cases it is justifiable. Other cases it is not justifiable. So accept and pay. You understood? So if you are not accepting and paying, then there will be other consequences. So what are those other consequences? The recovery will be initiated. Okay. So that is this information. Rule 88D we should refer along with this. So that rule 88D is in returns chapter. So you can give the reference of a page here. Refer page number 134. Refer page number 134. See, because you should learn it properly by interconnecting. That's why. Rule 88D, page 134. This rule 88D ka information is in 134. So basically, when 88D will come into picture, ITC in GSTR 3B greater than ITC in GSTR 2B. Now, along with 88D, first we will refer 88D in page 134. Along with that, we should also see 88C. So look into 88D, what does it says? Trigger point when 88D will come, because it's an amendment here. That's why I am going little slow. It's a May 24 amendment. Difference in ITC claimed, that is credit availed in 3B exceeds the credit as per auto generated statement in 2B. So we will get a notice. What is the format of the notice? GST, you remember. Which subject we are studying? GST. DRC, demand and recovery. They should recover it from us now. So demand and recovery, DRC. 1. Okay. So remember the alphabet before D. What is the alphabet before D? C. So DRC 1C is the form. Okay. Make an effort. Remember this, because it's an amendment. By mistake, if they ask, by mistake we write, they will think that we are intelligent. Of course not, but we will get marks. You understood or not? So that's important, because world is everywhere cheating only. So then communication by, so we get a department notice, and either it will be uploaded in our portal, plus you will also get the email intimation. What is the reaction time? 7 days. Within that 7 days, what you should do? You should give a reply. That reply is in part B. Part A they will give notice, part B of the same form. Part B of the same form you need to give the reply. So what are the options available to you? Number 1, pay the difference. If it is not the genuine credit, pay the difference. Option 2, if it is genuine credit, give the reply, explain the difference, or partly pay and partly explain the difference. Okay. Then if no response or unsatisfactory response, what will happen? That's what I told you. So you are not giving an explanation, neither giving explanation nor accepting the difference and making the payment. So then in that case, they will give a notice under 73 or 74. Mostly they will invoke 73 only. Mostly they will invoke 73 because it is clearly evident. This is a mistake that do not involve fraud. Sir, when 73, when 74? If there is non-payment of GST, short payment of GST, non-payment of GST means GST are required to pay but you have not paid. Short payment of GST, you have paid less. Wrong availment of ITC, you are not supposed to take the credit but you took the credit and utilized it. Or wrong utilization of ITC, you are supposed to take the credit, you took the credit but you have utilized it wrongly. Wrong utilization of ITC. Or erroneous refund, you are not supposed to get the refund but you got the refund. In these 5 cases, there is a payment of tax, something you have to pay. First case, non-payment, you have to pay. Short payment, you paid less, you have to pay. Wrong availment utilization of ITC, unnecessarily utilize the ITC, because of which your liability will come down. So there also there is some payment of tax. Erroneous refund, you are not supposed to get the refund, you got the refund, so you have to pay that amount. For recovering this amount, they will invoke either 73 or 74. If it is on account of fraud, fraud means what? Intention to evade, then it will be section 74. If it is non-fraud, there is no intention to evade, by mistake only it has happened, clearly evident. When there will be intention to evade, so I planned it in such a way that so no one can identify this, that is called as intention to evade. But evident clearly, in 3B I have taken more ITC, in 2B there is lesser ITC, there is no intention to evade. So therefore in that case usually they will invoke 73. You got it? So 73 will come in which case? Fraud or error? Error means no intention to evade. 74 will come in case of fraud, that is intention to evade. So what they are doing? They are giving a notice. I jolly, already one notice we got, now another notice, second notice, you understood. But they will not do recovery because this they will be testing in exam. Recovery, direct recovery can be made under section 79 if there is a difference in ITC in 3B and 2B. Explain. What will you explain? See, question itself you did not understand. Then where from you will explain? You understood. So, direct recovery can be initiated under section 79 in case of difference in ITC. That is, ITC availed in 3B more than ITC as per 2B. Explain. Like that this question will come here. Definitely it will come here. Okay. So when that question sees, you will not understand what to write. You will write about rule 88D and all. But it is like they are asking you one question but you are answering something else. So what is the correct answer, sir? Sir, see there. Recovery cannot be made if there is any difference in 3B and 2B. First a notice to be given and a 7 days time limit to pay the difference or give the explanation. If not, the another notice will be given under 73, 74. And after 73, 74 notice, one order should be passed under 73, 74. Thereafter only recovery can be made if you are not making payment within 3 months after order date. Because 73, 74 provision says first a notice will be given. After notice, they will pass a order. After passing order, they will give a time limit for you of 3 months either to pay that or go for appeal. If you are not going for appeal or neither making payment, in that case only recovery will be initiated. You understood? So that is what you need to write. So you should write that the given statement is incorrect. Recovery cannot be initiated under section 79 on account of difference in ITC in 3B versus 2B. As per rule 88D, you got it? As per rule 88D, a notice to be given in form DRC 1C and within 7 days, the taxpayer has option to either make the payment of difference or explain the reason for difference. If no action is done by the taxpayer within such 7 days, a notice can be issued under section 73 or 74, and after that notice, so an order will be passed as per the time limit under 73-74. After the order has been communicated to the taxpayer, within 3 months, if the taxpayer neither preferred an appeal against that particular order, nor he accepted the order and made the payment of tax, interest and penalty, then recovery will be initiated. Got it? So that is how you need to write the answer. You got it? Then next, impact on filing of returns or access to GST portal. Okay, until that point of time, what will happen? So because it is taking some time now, 7 days time is there, and thereafter we have to pay. So it takes some time. Till that time, what will happen? If you are not doing that, what will happen? One notice will be given under 73-74. Okay, in this 7 days, what will happen? In this 7 days, what will happen? You are not allowed to file the return in GSTR 1. Means till the time you make the payment of the difference or explain the difference to their satisfaction, you cannot file GSTR 1. So it will be blocked. GSTR 1 will be blocked. And once GSTR 1 is not filed, GSTR 3B also cannot be filed, because now we have sequential filing of returns. What is sequential filing of returns? Without filing GSTR 1 of previous month, we cannot file the 3B of the current month. Without filing GSTR 1 of the previous month, we cannot file 3B of the previous month. And without filing GSTR 1 and 3B of the previous month, you cannot file the GSTR 1 of the current month. Without filing GSTR 1 of the current month, you cannot file 3B of the current month. It's like a sequential we have. Got it? First GSTR 1 of previous month, then 3B of previous month, then GSTR 1 of current month, and then 3B of current month, like that only. So if you are not able to file GSTR 1, consequently 3B also cannot be filed. That is what it is. So you are not supposed to file GSTR 1 is given in Rule 88D. But this point is not given in Rule 88D. It is a connecting point, different place. And another connecting point, because you are not able to file GSTR 1 and GSTR 3B, so e-way bill also will be blocked. If GSTR 1 not filed for 2 consecutive tax periods, like 2 months continuously you are not able to file, e-way bill will be blocked. E-way bill facility gets blocked for your outward supplies. Also, one more consequence is there. As the ITC availed in 3B is greater than ITC availed in 2B, so your registration also will be suspended. That is one of the reasons for cancellation of registration. There are many reasons for cancellation of registration. One of the reasons for cancellation of registration is what? ITC availed in 3B which is greater than 2B. Actually, this point 2, 3, 4 not given in this rule, given in different places which I have just connected. So because this also can be tested as a question, like what are the consequences with respect to the taxpayer when the notice is served under DRC 1C or notice is served under Rule 88D. Anyway, they can ask the question. What are the consequences? You need to write these 4 points. Okay. Following are the consequences if the taxpayer has neither paid the difference nor has given the explanation within 7 days from the date on which notice has been served in DRC 1C. What is that? First point, GSTR 1 cannot be filed and it gets blocked, because of which GSTR 3B also gets blocked. If the GSTR 1 and 3B not filed for 2 consecutive tax periods, e-way bill also gets blocked. And this is one of the reasons for suspension of registration. So these 4 points we need to write. This is how 88D can be tested. Okay. Very, very important. This one big amendment which definitely they will be testing. When we read 88D, Along with that 88C also we should read. What is this 88C? 88C says that my liability in GSTR 1 is greater than liability in GSTR 3B. When this situation will happen? I have poured in lot of invoices in my GSTR 1, but not all invoices I have paid the liability in my GSTR 3B. So when there is a difference in this, for example, as per my GSTR 1, liability is 18 lakhs, but in 3B, I have paid only 8 lakhs, means 10 lakhs difference is there. You understood? Means what I am doing, I am putting the invoice in GSTR 1, but I am not discharging the liability, because at the time of filing GSTR 1, we don't have to pay tax. At the time of filing 3B only, we should pay the tax. So I have suppressed my tax liability. In that case, so they will be giving a notice in DRC 1B. Remember the alphabet before the rule number. This which rule? 88C. So C, before C is B. So DRC 1B. So what is the trigger point for 88C? Liability declared in GSTR 1 exceeds the tax payable in 3B. So we get a notice, same, but notice form only will differ. What is that notice form? Here 1B, here 1C. And communicated by way of uploading in the portal plus email. And what is the response time? 7 days. And what is the response to be filed in part B of DRC 1B? Same logic, part A, part B, part A, part B. Okay. Then options available, ditto, pay the difference, explain the difference, or partly pay and partly explain the difference. Same story. And why there will be reasons to explain the difference? So there could be some genuine reasons also. Like I have added an invoice, but I forgot to adjust the advance. Actually 10 lakhs, 8 lakhs advance. Already I paid GST, but now I added invoice for 10 lakhs. So now in 3B I will pay liability only for 2 lakhs because on 8 lakhs already I paid. But this adjustment of advances I should have done in my GSTR 1. I have not done. Because of that reason this difference may happen. So there could be genuine reason also. So pay the difference, explain the difference, or partial payment and explain the balance. If no response or unsatisfactory response, what will happen? This is the place where a direct recovery will happen. Here no notice again. No notice again. Why no notice again? This is called as self-assessed tax not paid. Self-assessed tax not paid. Direct recovery can be initiated under 79. No waiting. No waiting, boss. 7 days over, immediately they will do recovery. So this is called as direct recovery. Recovery of tax under section 79 plus liability posted in electronic liability ledger. So this is known as recovery of self-assessed tax. Recovery of self-assessed tax under section 79. Usually in 73, 74 we discuss one time limit. First they will give a notice. In case of 73, 74 what they will do? First they will give a notice. After notice they will pass an order. After order only they will do recovery. Correct? So this recovery will be under section 78. This recovery will be under section 78. And what is the time limit we have for this order to recovery? 3 months. 3 months. Okay. So within this 3 months, if you are not making the payment or you are not going for appeal, then only they will do this recovery. So this information related to recovery and notice etc. is in demand and recovery chapter. I just connected it here. So now going back to the input tax credit where we started. So page 79. So I just discussed now rule 88D. Along with rule 88D we have also discussed 88C. On this rule 88D and 88C also questions can be asked. So lot of questions are possible in these areas. Then next. One more rule is that section 41 read with rule 37A. This is also an amendment, but this was an amendment for last attempt itself, but for November 23 they have not tested much on this particular rule 37A. So because of that reason, definitely this time you can expect a question. So what is it all about? Simple. The supplier will report the details of invoice in GSTR1 and the GSTR1 is filed within the due date. Same, no change. We have seen already here. Supplier filed GSTR1 and it is filed by the due date. So supplier filed GSTR1 and it is filed by the due date. Based on this, the data of inward supply is made available to recipient in 2B, correct? ITC reflected in GSTR 2B of the recipient. And whatever ITC that is reflected in 2B of the recipient can be availed in GSTR 3B. So that is known as ITC availed in 3B, self-assessed ITC. And of course, after making these adjustments, we can take the ITC here in 3B. Now what happened? Supplier has not filed 3B. Even then, when can we take ITC? Yes, that's what section 41 says. Your supplier just to report the data in GSTR1, you happily take the ITC. The moment it comes in your 2B, your supplier has not filed 3B, it's okay. But your supplier should file 3B by September 30th of the next financial year. That's a time limit given. 30th September of next financial year. Who? Your supplier. What? 3B should be filed. If your supplier has not filed 3B by 30th September of next financial year, then whatever ITC that is availed by the recipient, so should be reversed by 30th November of the next financial year. So there is a time limit of 2 months. September 30th, supplier not filed GSTR 3B. As a recipient, what we should do? Already we took the ITC. So that we need to reverse. So why you need to reverse? It is a mistake of the supplier, na? Yes, it is a mistake of the supplier only. But you already availed the ITC, na? So that's why you reverse. So then, sir, what if I have not availed the ITC at all? No problem. So you just check whenever September 30th of next financial year, you wait till that time. And if your supplier has filed GSTR 3B, then you take the ITC, because anyhow for taking ITC there is a time limit, na? 30th November of succeeding financial year or date of filing and return, whichever is earlier. As you are taking the ITC before your supplier is filing GSTR 3B, it's like a penalty on you for the purpose of availing the ITC early itself. Okay. So therefore you reverse the ITC. Interest? No. That's an amendment. No. If you are reversing by November 30th, if you are reversing by November 30th, so we will not punish you. You reverse the ITC, but don't pay any interest. However, if you are not reversing by November 30th of next financial year, you need to pay interest. Who you are? You are means recipient. Recipient should reverse the ITC by 30th November. Otherwise, recipient should pay interest at what rate? 18% per annum. From when? From the date of utilization, not availment. From the date of utilization till the date of reversal. If not reversed by November 30th of next financial year, interest at 18% shall be payable from the date of utilization till the actual date of reversal or payment. Now, here, suppose if the 3B is filed after September 30th of next financial year, then what will happen? Then simple, whatever ITC that has been reversed earlier can be re-availed without any time limit. So the time limit is not applicable. Just now I told you there is a time limit for availment of ITC, that is 30th November of the succeeding financial year or date of filing and return, whichever is earlier. But for re-availment of ITC reversed earlier, there is no time limit. We can take any time. But interest we cannot avail. Gone. That is gone. That is the income to the government. You understood? So why they create these provisions and all? Mainly for the sake of interest income. You understood or not? So this interest income is there. Sir, interest gone, sir. Suppose you don't want to pay interest, ensure that you are reversing by November 30th. And here, interest from the date of utilization. What is the meaning of date of utilization? When is it called as ITC utilized? That month in which the balance in ITC falls below the availed ITC. I have availed 1 lakh and I maintain the balance of 1 lakh every month. I have not utilized the ITC. In any 1 month, if my balance in ITC falls below 1 lakh, to that extent I have utilized ITC in that month. Okay. So that is the meaning of date of utilization till the date of reversal or payment. This is about Rule 37A, Section 41. This is also very important. So mainly on this interest computation can be tested. Here one interest computation is possible. So this interest computation related question could be tested. Then next, Section 49 we are discussing. 49 talks about the manner of utilization, 49 subsection 5. So far we have been talking about availment of ITC. We availed, we took the credit. Now we need to use it. Use it for what purpose? Use it for payment of our liability. And for that we have certain principles. The first principle says that there is no restriction with respect to IGST. Means what? IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. There is no restriction with respect to IGST. And amongst the other taxes, what are the other credits? CGST, SGST and UTGST. Respective credits can be utilized for payment of respective liability, and cross utilization is not possible. So if I have CGST credit, I cannot use it for payment of SGST liability. CGST credit cannot be used for UTGST liability. That is the meaning of this. So what is the first principle? IGST, no restriction. Between the other 3 credits, respective credit for payment of respective liability. And then second principle, order or priority. I have IGST credit. First I should use it for payment of IGST liability. Thereafter, whatever balance that I have, I can use it for payment of CGST, SGST or UTGST in any manner and in any proportion. Then what about the other credits? CGST credit first for CGST, SGST credit first for SGST, UTGST credit first for UTGST, then the balance if any for payment of IGST. Got it? Then third principle, before utilizing CGST credit, SGST credit, ensure that the IGST credit is exhausted. The first credit that we need to spend is IGST credit. Why, sir? Because of this reason. That is, IGST credit will be in a suspense account. So we should spend it properly for either CGST, SGST. So they will dispose it off to the respective government. So that's why they wanted us to spend IGST credit first before touching CGST, SGST credit. And principle number 4, that is, I have all the credits but only one liability, that is IGST liability. First to use IGST credit as usual for payment of IGST liability. Then which credit we should spend? CGST, and thereafter SGST or UTGST credit. Now, while doing this set off, so multiple answers are possible, but you should be careful as to the manner of utilization. So the minimum cash outflow should be the objective. So what is that minimum cash outflow objective? For example, I have CGST, SGST and IGST. So gross liability, gross GST payable is somewhere like 5,000, 5,000 and 5,000, and I have an ITC of 2,500, 2,000, ITC of 2,000, 2,000 and 10,000. Now in this case, what is the answer? See, 10,000 rupees I can use first for payment of 5,000. First I should use it for payment of 5,000. Still I have some 5,000. I should use it for payment of either SGST or CGST or both SGST and CGST. Suppose if I use entirely for SGST, let's see what happens. So that the SGST will become 0 and CGST 5,000 minus 2,000, 3,000 will be there, and this SGST is 0, IGST is 0. So there is this 2,000 carried forward, because 2,000 SGST credit cannot be set off with CGST liability. You got it? Because cross utilization not possible. Due to that reason, So this answer 3000 is not the correct answer. Why it's not the correct answer? Simple. You see the total of the gross liability. What is the total of the gross liability? 15,000. What is the total of the ITC? 10,000. So 15,000 minus 14,000, 15 minus 14, 1000 rupees should be the answer. So first check that. See, total gross minus total ITC. So the net should be 1000. So this is only the correct answer. You do anything, but ensure that you are getting 1000 rupees. Okay. So what is it you need to do for this? First, gross GST payable. So gross GST payable will be 5,000, 5,000 and 5,000. So this total will be 10,000. And now minus IGST credit. So first we need to utilize IGST credit. That's what the principle says. First IGST credit should be utilized. So therefore 5,000 I will utilize for payment of IGST liability. Then I will not spend more than 3,000 for CGST. Why not more than 3,000 for CGST? Because already CGST credit we have. So the better alternative is distribute it equally. Distribute it equally because the credit is also equal. If you see the credit 2,000, 2,000 and liability also 5,000, 5,000. If you distribute in that 2,500, 2,500, then minus CGST and SGST credit. So that will be like 2,000 and 2,000. So now what will happen if you see 500, 500, 0, so 10. So actually the answer should be 1000. That should be the net GST payable. So here the answer is 1000 only. Alternative answers possible. So we can have 0, 1000, 0 or 1000, 0, 0 also alternative answers possible. But you do the total column. You do the total column and keep it like this. So that what will happen, you know, when you are doing the answers. So 10,000 and 4,000. So this will be coming to 1000. Okay. That is with respect to this. IGST credit after utilizing for payment of IGST liability can be used for payment of CGST, SGST, UTGST liability in any proportion. So multiple answers possible in the exam. So depending upon CGST, SGST liability, you apportion it. Okay. Then, sir, can GST compensations also be taken as credit? Yes, it can be taken as credit, but it should be utilized only for payment of GST compensations on outward supplies. Can it be used for payment of IGST, etc. and all? No. GST compensations is only for payment of GST compensations. Then, next one, section 16, conditions for availment of ITC. So, what are the various conditions for availment of ITC? Total 8 conditions we have. Condition number 1, only a registered person can avail ITC. Of course, unregistered person cannot avail ITC. So, because you know he cannot adjust, he don't have a liability now. So, what is the point in taking ITC? Number 2, inward supply should be used or intended to be used. Used means used for the existing. Okay. So, used now, present. Intended to be used, purchase now, which will be used in future. So, even though not put to use, even though not ready to use, we can enjoy the ITC. Because if you use now, these words, put to use is there in income tax. Correct? Put to use. Only if you put to use, you can claim depreciation. And in India, we have ready to use. Till the time it is ready to use, all the cost you add it to the asset. Correct? But we don't have any use, any use of this. Intended to be used also, you enjoy the ITC. So, to be used or intended to be used in the course means for the existing business. Furtherance for something which we are going to start in future, we can take. So, only a registered person can avail ITC. Inward supply should be used or intended to be used in the course or furtherance of business. Third condition, the person who is availing ITC should be in possession of tax paid document. So, what is the meaning of a tax paid document? Either tax invoice or debit note or ISD invoice, input service distributor invoice or bill of entry. These are the 4 tax paid documents on the basis of which ITC can be availed. possession. You should be having it. If the invoice is missing, we cannot enjoy the ITC. Even if you have availed, you reverse it. If you have not availed, don't avail it if the invoice is missing. So that is the meaning of possession. Then fourth condition, recipient should have actually received the goods or services. This is what I was referring to. So invoice is pertaining to January, but the goods are received in February. When can we take ITC? January or February? Only February, because recipient should have actually received the goods or services. Supplier should have furnished the details of invoice in GSTR1, because if he is not adding the details in GSTR1, it will not come in 2B. If it is not coming in 2B, we cannot take ITC, because only self-assessed ITC can be taken. Correct? So therefore, supplier should have furnished the details in GSTR1. Supplier should have paid tax with respect to such supply by September 30th of the succeeding financial year. That's what we have seen, section 41 read with rule 37A. What is that? Supplier should have reported the details in GSTR1 and should have filed the 3B by September 30th of next financial year. Recipient should have filed the returns, because how we can take ITC as a recipient? Without filing GSTR 3B we cannot take, because I have discussed this point. Availment of ITC, reversal of ITC, utilization of ITC, these three things happens in which place? Only in GSTR 3B. Without filing 3B we cannot avail ITC. And this is another point. GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted. Why we have? Because there is one section, section 38. What does that section 38 says? Even though your supplier reports the details in GSTR1, but it will come in 2B under ITC not available. If it comes in 2B under ITC not available column, you cannot take ITC. There are many reasons which is given in section 38. As per section 38, in few cases, ITC shall be restricted in GSTR 2B. What are those few cases? Your supplier is a newly registered person. You purchased from him, so you should not purchase from him. So whenever you are making purchase from a supplier, you ask him, are you fresh? Yes, I will not buy from you, because he is a newly registered person. If you buy from him, even though he reports the details in GSTR1, it will come in your 2B under ITC not available. Where is it given? Section 38. Why they gave? Because they were drinking something while drafting this provision. So, see this. Refer page number 134. Refer page number 134 related to this section 38. So I have given it here. So what is that? Supplier is a newly registered business. So then, second, your supplier has filed GSTR1 but not 3B for some previous periods. Your supplier for some previous periods, he filed GSTR1 but not filed 3B. Okay. Now that would have been coming in GSTR1. So you have not done the reversal. You have to do the reversal now if he is not filing 3B. As per section 41, you need to do reversal recipient. If you are not doing also, don't worry, they will put it under ITC not available in the subsequent months. Then next, your supplier liability in GSTR1 is greater than 3B. That idiot filed GSTR 3B. So section 41 read with rule 37A will not get attracted. When section 37, rule 37A will come. Section 41 read with rule 37A when it will come. If your supplier has not filed GSTR 3B by September 30th of next financial year, he filed, you understood, he filed, so this section and rule will not come. But another problem is there. What is that another problem? There is a difference in liability. When there is a difference in liability, rule 88C will get triggered on whom? On the supplier. As rule 88C get triggered, they will do the recovery from him. Okay, na sir, what is your problem? But in our 2B, it will come as ITC not available. That is this. Supplier liability in GSTR1 greater than liability in GSTR 3B. But remember, all these cases, the mistake is not done by the recipient. You are not doing anything wrong here. Your supplier is only doing anything wrong. Okay. For that only you are penalized. So why, sir? Next time onwards, don't buy from this supplier. He is a bad boy. Okay. That is the meaning here. Next, supplier ITC in 3B greater than his 2B. He has taken more ITC. Then your ITC is gone. Then supplier has received demand notices and default in payment of taxes and such default continues. Who? Your supplier. He defaulted and he has got the notices. How will I know, sir? You will not know all these things. You will know only when you are 2B, you will see it in ITC not available. So this month you will be so happy. I have 10 lakhs ITC. So 12 lakhs is my liability. So 2 lakhs I have to pay. Like that we will be prepared. The moment you see 2B, you will get a mini heart stroke. Why? 10 lakhs you thought of ITC, but in that there is only 3 lakhs. What happened to 7 lakhs? It is moved to ITC not available. Then make a fund of 7 lakhs and make the payment. You understood? So why, sir? This because of these reasons. Any one reason. He might have got one notice. That and all you will not know. But only when you see in ITC 2B you will know. Supplier has received demand notice and default in payment of tax and default continues. Supplier defaulted in payment of 1% of his liability as per rule 86B. So I told you that there is one rule 86B which says that he has to pay 1% of his gross liability through cash ledger even though he has sufficient balance in his electronic credit ledger. If he is not doing that, who? Your supplier. Then you purchased from that bad boy, so your ITC is gone. So these are the 6 cases where ITC will be restricted in 2B as ITC not available. What are the 6 cases? Mark it as important for short note. 6 cases. Supplier is a newly registered business. Supplier filed GSTR 1, not filed 3B. Supplier liability in GSTR 1 greater than liability in GSTR 3B. Supplier ITC in GSTR 3B greater than his 2B. Then supplier has defaulted in payment of tax and the default continues. And supplier has to pay 1% of his liability through cash ledger, but he did not pay. So in these 6 cases, ITC will come, but it will come under ITC not available. So first challenge of coming into 2B is what? He should have filed GSTR 1. No, there are like multiple hurdles. Like while racing, there will be hurdle match. We have to jump and go like that. Multiple hurdles. What is the first hurdle? He is not reporting in GSTR 1, or he reported in GSTR 1, but he did not enter properly. Because of which it will not come in our 2B itself. That's the first hurdle. 2B it came, but we cannot take because of this. 2B it came. He reported in GSTR 1 properly. It came, but we cannot take. Why? Again, supplier is newly registered or he has got demand notice, etc. Because of this reason. Then another twist is there. It came in 2B. We availed it. You understood? It came in 2B and we availed it. But that idiot did not file GSTR 3B by September 30th. So we need to reverse the ITC. You got it here? Understood? Okay, sir. We reverse it. Where is it given? Section 41 read with Rule 37A. All these things we escaped. Finally, it came in our electronic credit ledger. We availed the ITC. Again, one rule is there, Rule 86A, which says that whatever ITC that you have already availed in your electronic credit ledger will be suspended for a period of, like 1 year. Okay. So why, sir? There are some reasons that they have given. And 86B says, even though you have availed the ITC, but fully you cannot use, 99% only we can use. Okay. Connecting all these points. So I will tell you later. So what are the connections, interconnections between this? But try to keep in touch with this. Now, this is about section 38. So what are the 8 conditions for availment of ITC? The person availing ITC should be a registered person. The inward supply should be used or intended to be used in the course or furtherance of business. And these are the 2 basic conditions. Then in the 6 conditions, 3 conditions in the hands of recipient. What are the 3 conditions? As a recipient, you should be in possession of tax paid document. and you should have actually received the goods or services, and you should have filed your 3B to take the ITC. Then 3 conditions not in your hands, your supplier hands. What is that? Your supplier should have reported in GSTR 1, and he should have filed the GSTR 3B by September 30th of next financial year, and he should not have contravened anything as per section 38, because if he does any contravention as per section 38, it will come under ITC not available to us. Then what is the meaning of input tax? Input tax refers to central tax, state tax, union territory tax charged on supply of goods or service or both made to a registered person. Okay, everything we can take as input tax, but it also includes tax paid on reverse charge basis. So whatever GST that we pay under RCM can also be taken as ITC. Even IGST charged on import of goods, that is also literally RCM only. So importer will pay along with customs duty IGST. Can basic customs duty be taken as credit? No. Can social fare surcharge be taken as credit? No. Only IGST on import of goods can be taken as credit. It does not include tax paid under composition scheme. Properly, like this person opting for composition scheme should not first of all charge GST to us. So there are 2 disadvantages for a person opting for composition scheme. Number 1, he cannot take ITC on his inward supplies, and he should not charge the composite tax to his recipient. So now you are making purchase from a person opting for composition scheme. He should not charge composite tax to you, but he charged composite tax to you. Can you take ITC? No, because the meaning of input tax excludes, so tax under composition levy. Then what are the contents of invoice for availment of ITC? So there should be some minimum little bit details that should be there in a document to be called as an invoice for availment of ITC. What are those details? So first, it should be having GSTN of supplier and GSTN of recipient. Number 2, it should have the description. Number 3, it should have value. And number 4, tax. And number 5, place of supply if it is interstate supply. These are the minimum details that should be present in a document to be called as an invoice for availing ITC. Then what is the meaning of inward supplies? Inward supplies means inputs, input service or capital goods. Inputs means those goods which are purchased and charged to P&L is known as inputs. If it is capitalized, then it will be called as capital goods. And input service means any service received will be coming under input services. Then deemed delivery. So that is like, in this case, one condition is the recipient should have actually received the goods or services. What if the recipient has not received the goods or service? On behalf of the recipient, some other third person has received the goods or services, that is bill to ship to transaction. There is a supplier. I am the billing address, you are the shipping address. Now the goods are delivered to you, but invoice is raised to me. I cannot take ITC because I have not received the goods. One of the conditions says that I should have received the goods, but there is a deeming fiction which says that the day on which the shipping address has received the goods or services, it is deemed that the billing address has received the goods or service, and the billing address can take ITC. So it is not only for goods but also for services. For service also this will be applicable. When goods are delivered to any person or service are provided to any person on the instruction of the recipient, that is billing address, whomsoever is having the invoice, okay, the date on which such person has received the goods or service, such person has received the goods or service means the shipping address, the third person has received the goods or services, it is deemed that the recipient has received the goods or services and the recipient can take ITC. So in case of bill to ship to transaction, billing address can take ITC. The next point, if the goods are received in lots or installments, so against a single invoice, if the goods are received in 3 lots in 3 months, when can we take ITC against that invoice? Proportionately or on receipt of last lot? On receipt of last lot or last installment. Then reversal of ITC for non-payment of consideration to the supplier. So there is one proviso which says that as a recipient, this is given in rule 37, not 37A. Rule 37A is related to this. This is rule 37A. Okay, supplier not file GSTR 3B by September 30th, that is rule 37A. Which I am talking now is about rule 37. This is rule 37. Rule 37. So if the recipient has not made payment to supplier, what is that payment? Both value plus tax is not paid to supplier within 180 days from the date of invoice. So I am the supplier, you are my recipient. You have not made payment to me. Within what time? 180 days from the date of invoice. Now whatever ITC that you have already availed, because Payment to supplier is not a condition for availment of ITC. In that 8 conditions, nowhere we have a condition that the recipient should make payment to the supplier. Even though recipient has not made payment to supplier, recipient can avail the ITC. So as a recipient, you avail the ITC, but you have not made payment to me within 180 days. Now whatever ITC that you have already availed needs to be reversed along with interest at the rate of 18%. From when? From the date of utilization till the date of reversal. This 180 days should be counted from when? From the date of invoice. From the date of invoice. So now you need to reverse the ITC along with interest. Now what if you make payment to me after 180 days? So much of the payment that you have made after 180 days, you can avail the ITC back. First you have availed ITC. As you have not made payment to me within 180 days, you reverse the ITC. Again you make payment to me after 180 days, you can avail it back. But the interest is loss. Okay. There are 2 places where we have reversal and re-availment. One under Rule 37A, which we have seen. Section 41 read with Rule 37A. What is that? Supplier not filed GSTR 3B by September 30th of the next financial year. Recipient will reverse the ITC and again it can be re-availed. Whereas another is Section 16 read with Rule 37. Section 16 says that if the recipient is not making payment to supplier within 180 days from the date of invoice, so much of the ITC availed by the recipient needs to be reversed along with interest, and again as and when the payment is made to supplier, recipient can re-avail the ITC. In both these cases of re-availment, there is no time limit, and in both these cases interest will be payable at the rate of 18%. From when? From the date of utilization till the date of reversal. And in both these cases, interest cannot be re-availed, only ITC reversed can be re-availed. So that is this. If recipient has not made payment to supplier within 180 days from the date of invoice, so much of the ITC proportionate to the amount not paid to the supplier shall be reversed along with interest, 18% per annum from the first date after date of utilization till the date of reversal. However, interest not payable if availed ITC is not utilized. Correct. So I have availed the ITC, but I have not utilized at all. Then interest payment shall not arise. But this 180 days condition has got exceptions. So 3 cases, this 180 days condition is not applicable. Number 1, supplies covered under RCM 9 subsection 3. So in case of 9 subsection 3, the liability to pay GST is on recipient. So therefore 180 days condition not applicable there. Then 7(1)(c), supply without consideration. Consideration itself is not there. From recipient will make payment to supplier. Then payment to third party on behalf of supplier under 15(2)(b). That is as per 15(2)(b), a recipient instead of making payment to the supplier, so any amount that the supplier is liable to pay to a third person, recipient will make payment. So any amount that the supplier is liable to pay is incurred by the recipient on behalf of the supplier. Means indirectly the payment is received by the supplier na. So due to that reason, this 180 days condition is not applicable in this case. So these are the 3 points. And now what happens if the proportionate amount is paid? For example, so it's 60% paid within 180 days and 40% not paid. Now how much you need to reverse? 40% related ITC you should reverse, because you paid it 60% within 180 days. That component you don't have to reverse. So you have not paid how much? 40%. That component only you need to reverse. And again, say 100% you did not pay. So 100% you reverse. Thereafter, after 180 days, you paid 55%. How much you can avail it back? That 55% related ITC proportionate component only you can avail it back. So ITC proportionate to the amount not paid to the supplier. Proportionate to the amount not paid to the supplier. ITC can be re-availed as and when payment is made to supplier after 180 days, but interest paid cannot be availed as ITC because there is no time limit for re-availment, but interest gone. ITC we can re-avail even if it is pertaining to some 2 years, 3 years before also. Then in case of depreciation under Income Tax Act, section 16 subsection 3, what does it say? Suppose if I follow the block of assets method, and in that block of assets method, if I add the asset value along with GST, then I would have already claimed the depreciation under Income Tax Act. So which means I should not avail the ITC here. Suppose if I added in the block of asset only the asset value excluding GST component, then the GST component can be taken as ITC, because you cannot have the double benefit. So if you cannot like enjoy the depreciation also there, and you cannot enjoy the ITC here, because depreciation leads to reduction in income tax. Due to that reason, this cross provision has been created. For example, you purchase a capital goods for 10 lakhs and GST is 1,20,000. So if the depreciation is computed on 11,20,000, that is 10 lakhs plus 1,20,000, then ITC with respect to 1,20,000 is not available. You got it? Then, because we are computing depreciation on 11,20,000. What if depreciation is computed on only 10 lakhs? Then ITC of 1,20,000 will be available, and we are talking about depreciation under accounting or depreciation under income tax act. Here they gave depreciation under income tax act, but as per India is also the logic is same. There is no difference in that, but here while discussing they gave only under income tax act. But the similar provision is there in India is also. Recoverable taxes should not be forming part of the asset. So I think in India is 10 PPE. So this point is there. So where they are telling that recoverable taxes should not form part of the asset value. Okay. Then time limit for availment of ITC. So 30th November of next year or date of filing and return, whichever is earlier. But what is the exception to this? Re-availment of ITC reversed earlier. And in case of debit note, so whenever we have a debit note, don't see its invoice date for determining the time limit, you see the debit note date only. For example, debit note date is 28th January 2023. For which financial year the debit note is given? 22-23. So based on that only you determine the time limit for availment of ITC. Don't see the invoice pertaining to this debit note. So you interpret the debit note independently. In case of debit note, availment of ITC depends on the debit note date, but not the date of invoice related to such debit note. So this is about section 16. Then section 17 talks about apportionment of credit and blocked credits. So apportionment of credit says that if I have some inward supplies which are used for taxable outward supplies, I can enjoy the ITC, no issue. If I have some inward supplies which are used for exempted outward supplies, can I take ITC? No. Again I am repeating, inward supply used for taxable outward supply, can I enjoy ITC? Yes. Inward supply used for exempted outward supply, can I enjoy the ITC? No. Inward supply used partly for taxable and partly for exempted, can I take ITC? Yes. Proportionate ITC I can take, same way. Inward supply used for business purpose, can I take ITC? Yes. Inward supply used for non-business purpose, can I take ITC? No. Inward supply used partly for business and partly for non-business, can I take ITC? Yes. Proportionate ITC I can take, that is this. Inward supply used exclusively in taxable or business purpose, ITC available. Exclusive used for exempted or non-business, ITC not available. Used for both taxable and exempted or both business and non-business, proportionate ITC available. Now where the zero rated supply should be brought? Zero rated supply should be treated as taxable. So it should not be treated as exempted, because zero rated, even though the rate of GST, like the burden of GST will become zero. What are considered as zero rated supplies? Export of goods or services, supply of goods or services to SEZ is considered as zero rated. In case of zero rated, I have two options. What is the two options? Option number one, I will pay IGST and I will get that IGST as refund, which means the burden will become zero. Or I will not pay GST, I will sell it under bond or LUT, and whatever ITC that I have, that ITC I will get as a refund. So which means the burden will become zero, but even then it should be treated as taxable. Means when outward supply is zero rated, can I enjoy the ITC on inward supply? Yes. In this regard, one more point also remember. Basically when my outward supply is exempted, I cannot take ITC on inward supply. But the same product or service is exported or supplied to SEZ, it will become zero rated. When it becomes zero rated, I can enjoy the ITC. Okay. So say this, there is a product X. There is a product X and that product X is exempted. Product X is exempted. And as the product X is exempted, can I take ITC on inward supply? ITC not available on inward supplies, correct? Not available on inward supplies. Okay. Now this product X which is exempted, the product X which is exempted is being exported. Exported or supplied to SEZ, then it will become zero rated. As it becomes zero rated, Whether ITC available on inward supplies? Yes. ITC available on inward supplies. Reason being the character changes. Previously product X was exempted, so ITC not available. But the moment it is exported or supplied to SEZ, the character of this product X is 0 rated. So therefore we can take the ITC on inward supplies. So be careful with respect to this. So they will give a product is exempted and the inward supply used for that exempted product. But the product is exported. When the product is exported, we will think that ITC not available, but actually ITC is available because the character of that product is now not exempted, the character changed to 0 rated. So that is about this. So 0 rated supplies will be covered under taxable supply for the purpose of availment of ITC. Now, what is the meaning of exempted supplies? So because if inward supply is used for exempted, we cannot take ITC na, or inward supply used for taxable and exempted, we can take proportionate ITC. So what is the meaning of that exempted supplies? So supplies notified as exempted. So there are some exempted supplies as per the definition for payment of GST. What are they? Notified as exempted, nil rated and non-taxable. These three are exempted even for ITC also. So notified as exempted means what? From time to time government will be giving certain exemptions by way of notification, that is known as notified as exempted. Nil rated means the rate of GST is nil. Non-taxable means alcoholic liquor for human consumption and 5 petroleum products. What are the 5 petroleum products? Crude oil, petrol, diesel, aviation turbine fuel and natural gas. These 5 petroleum products. Okay. So these are the 3 exempted supplies even for payment of GST as well as for availment of ITC. Then supply covered under RCM. So my outward supply covered under RCM, actually it is taxable for payment of GST. I will not pay GST, my recipient will pay GST, but for me it will be treated as exempted for ITC purpose. If I have some inward supplies used in this outward supply, I cannot take ITC. For example, I am covered under RCM, say I am an advocate and my outward supply is covered under RCM. Now, as I am not having the liability, on my inward supplies, can I take ITC? No, I should not take ITC because for me it will be treated as exempted for ITC. Supplier of RCM supplies cannot take ITC, but recipient can take ITC. So now you are paying GST under RCM. That RCM liability can you take as ITC? Yes. Then sale of land, sale of building, sale of securities. Now one more point, supply of warehoused goods under customs. So these 4 transactions are excluded from supply. They are not treated as supply. Excluded from supply. What are the 4 activities excluded from supply? Sale of land, sale of building, sale of securities and supply of warehoused goods under customs. What is this warehoused goods under customs? Imported goods kept in the warehouse without payment of customs duty. And the document of title called as warehouse receipt is transferred to some other person. Now, this particular transaction is not a supply for me. Why it is not a supply for me? Because the subsequent buyer is going to file the bill of entry and pay the customs duty. So for me it is not a supply, but for exempted supply under ITC definition it is added as exempted supply. So 4 activities not treated as supply but treated as exempted supply for ITC purpose. Sale of land, sale of building. Which building? Sale of building where entire consideration is received after obtaining completion certificate or first occupation, whichever is earlier. Sale of securities and sale of warehoused goods under customs. Now, in case of sale of building and sale of land, what should be taken as the value? Value should be stamp duty value. So why for land, building and securities only we are talking about value, by why for not others? Because others are already supply, means it will have a valuation, but these activities are basically not a supply, so there won't be any value, so we need to take the value. So land and building you take the stamp duty value, but in case of securities we need to take 1% of the sale value of that securities. Sir, what about the supply of warehoused goods? Normal sale value or transaction value at which the goods are sold, that should be taken. So this is about the 8 points. So what are the 8 exempted supplies? First, notified as first 3. First 3, remember, these are basically exempted for payment of GST even for ITC purpose. Notified as exempted, nil rated, non-taxable. Then supply covered under RCM. Then 4 points you remember which are not a supply but treated as exempted. So sale of land, sale of building where entire consideration received after obtaining completion certificate or first occupation, whichever is earlier, and sale of securities, supply of warehoused goods under customs. Then you remember this, even though interest on loans, advances, deposits is exempted, but it will not be treated as exempted while computing the exempted turnover for ITC, means it will be treated as taxable. It will not be kept under exempted, it will be treated as taxable. Which one? Interest on loans, advances, deposits, in so far as the consideration is represented by way of interest or discount, but this is except in case of banking company, financial institution or NBFC. It's like these 4 transactions are not a supply but treated as exempted supply, because of which what will happen? Our ITC balance will come down. How our ITC balance will come down? Say this, I have a common input tax credit. So the common ITC is 1,50,000. This is the common ITC, and I have some exempted supplies. So or exempted turnover. Exempted turnover is somewhere like 10 lakhs, and taxable turnover is 15 lakhs. Now how much is the net eligible ITC? How much is net eligible ITC? How to compute this net eligible ITC? First we need to take ITC availed. What is the ITC availed? Full ITC we will avail. 1,50,000 we will avail as ITC in 3B. Thereafter proportionate to exempted we need to reverse. So first you take the entire ITC, then proportionate reversal based on exempted. So what is that proportionate reversal? If you see 1,50,000 into exempted turnover divided by total turnover. Exempted turnover is what? 10 divided by total turnover, 10 plus 15, 25. So this is the proportionate ITC related to exempted that I need to reverse. First take the full ITC and then reverse proportionate to exempted. So 1,50,000 into 10 by 25 is how much? 60,000 I need to reverse. So the balance is called as net eligible ITC. So the net eligible ITC is 1,50,000 minus 60,000, that is 90,000 is net eligible ITC. Now here what happens is that there is some sale of land. Okay. So continuation to above. Continue to above. Sale of land for 25 lakhs. Sale of land for 25 lakhs. Now what will happen to the net eligible ITC? ITC availed same, no change. So ITC availed in GSTR 3B is 1,50,000 minus proportionate reversal. So what is that proportionate reversal? Proportionate reversal, if you see, 1,50,000 into exempted divided by total. What is the exempted turnover? Already 10 lakhs we have now. Now this 25 lakhs will also be treated as exempted turnover, correct? Sale of land, even though sale of land, here 25 lakhs is stamp duty value. This 25 lakhs will be SDV, stamp duty value. So 25 lakhs even though not a supply, but treat it as exempted turnover. Now what will happen to the numerator exempted turnover? Already 10 plus 25, it will become 35 divided by, so now what is the total turnover? So 35 already exempted, taxable no change, 35 plus 15, that will be 50. So 1,50,000 into 35 divided by 50, please do the computation. How much? 1,05,000. Then what is the net eligible ITC? Net eligible ITC. Net eligible ITC is 40,000. Just 45,000. Okay. Just because there is some sale of land, so our ITC balance has fallen to 45,000 from 90,000. So this is only because of what? Sale of land. So because of bringing some not a supplies into exempted supplies, our ITC balance will come down. Same way, actually interest is exempted, because of which ITC should come down. But interest income is treated as taxable, and they are asking us to enjoy the ITC. You got it? Enjoy. Interest is actually exempted, but we are keeping it under taxable. Enjoy that ITC, celebrate the happiness. Okay, take dairy milk and celebrate the happiness. But sir, interest income will be this much only. Correct? What they have taken from us is this much. What they have given is this much. To whom interest will be this much? For them, this is not applicable. Okay. This provision is not applicable for them. We will not. When we give, we know how much to give. So, to whom really they need to give, they have not given there. Service by way of accepting deposits, extending loans or advances in so far as a consideration is represented by way of interest or discount, except in case of banking company or financial institution or NBFC. Then one more point also I just wanted to highlight here, that is that I have given in a different place, you can write here itself. Even sale of duty credit scrips. Sale of duty credit scrips also should not be treated, actually it is exempted, but it should be treated as taxable. Okay. So, this supplies notified as exempted other than interest on loans, then other than interest on loans or sale of duty credit scrips. Sale of duty credit scrips. Duty credit scrips means, so we will get under foreign trade policy some duty credit scrips which can be adjusted against our customs duty liability. Either you can adjust against the customs duty liability or you can transfer the duty credit scrips to some other person. Now, when you sell the duty credit scrips, so we have a concept of electronic duty credit ledger in customs. As per that electronic duty credit ledger, whatever incentives that we are getting from the government, instead of giving to us in our bank account, they will put it under electronic duty credit ledger. This amount, whatever is there in duty credit ledger, will be given as a scrip amount. So, scrip number, this much amount will be the duty credit. So, now what I can do with this duty credit? I can adjust with my customs duty liability. What if I don't have the customs duty liability? I will sell this duty credit scrips to some other importer. I can transfer it. When I sell this duty credit script to some other importer, I will receive some money now for this. I am selling means someone is buying now, I will get that money. So, this particular transaction of sale of duty credit script is basically exempted. We don't have to pay any GST on that. But while determining the ITC, it will be treated as what turnover? It will be treated as taxable turnover. You understood? So, that is the meaning of the sale of duty credit scrips. It will not be treated as exempted turnover. You understood? Then, that is the meaning of this. So, we will take a break and thereafter we will continue with this rule 42 and rule 43. That is a very important discussion. We will take a break for 15 minutes and then continue thereafter. Meanwhile, those who are watching in YouTube, if you have any doubts related to the discussion so far, you can just type it over there. Doubts. Okay, we'll start. So there is one query like sales at duty free shop. So just wanted to show you one amendment. So we have discussed about sale of warehoused goods under customs. That sale of warehoused goods under customs point only is this. So they are telling for the purpose of rule 42 and 43, the value of activities or transactions mentioned in paragraph 8A of schedule 3, which is required to be included in the value of exempted supplies. So this, rather than giving us sale of warehoused goods under customs, they gave it in a different way. That is supply of goods from duty free shops at arrival terminal in international airports to the incoming passengers. Basically what is that? So this duty free shops which is there in the international airports itself is like a warehouse. So in international airports there will be something called as duty free shops. Those duty free shops should be treated like warehouses. So any goods which are imported and kept in that warehouse is actually not chargeable to any duty. Okay, that's what basically duty free shops. Whenever they are selling it to any person over there, they will not charge any duty or tax, etc. Means in a way it is like not a supply because it will come under sale of warehoused goods under customs. But for the purpose of ITC, it will be treated as exempted. So in this point, sale of warehoused goods under customs to any person before a clearance for home consumption, it also includes sale of goods by a duty free shop in international airport. So because this duty free shop itself will be coming under warehouse for the purpose of customs. Okay, that is one point. Next, will questions be covered in this rocket revision? Why? Regular batch itself I will take in 4 days. How can I take care? Let me complete the revision first fully. Okay, I don't know whether that I can do in 4 days. Then, if any lawyer is getting service from any other RCM supplier, does the RCM supplier need to pay GST on FCM basis? No, not like that. For example, I am an advocate. My outward supply is covered under RCM. Okay, now I have some inward supplies on which I need to pay GST under RCM. It does not mean that I will not pay. So it's like I am exempted from registration. Why am I exempted from registration? A person who is making exclusively exempted supplies or exclusively RCM supplies is exempted from registration as per section 23 of CGST Act. So in this case there is an advocate. So that advocate is providing outward supplies, and these outward supplies of advocate is covered under RCM. So when it is covered under RCM, this advocate is exempted from registration. He is not required to get registered. So exempted from registration under section 23. Now advocate is making some import of services. Some inward supplies are there, and on that inward supplies advocate is required to pay GST under RCM. Now, so every person who is liable to pay GST under RCM is compulsorily required to get registered. So compulsory registration under section 24. Then whether the advocate is required to register and pay GST? No. So why advocate is not required to get registered? So because not required to get registered. What is the reason behind this? Section 23 overrides section 24. So when section 23 overrides section 24, so he is not required to get registered. Consequently, he will not be paying any GST. But don't change the character of the service. The character of the service is taxable only. It will be taxable under RCM. but only thing GST will not be payable. Okay. Now, for advocate, first of all, he is not required to get registered. So, the question of ITC will not arise. Suppose if advocate is registered, then will he pay GST under RCM? Yes, he will pay GST under RCM if he is registered. Actually, he is not required to register. If he is registered, will he pay GST under RCM? Yes. But can he take ITC on his inward supplies? No. Why he cannot take ITC on his inward supplies? Because the outward supply is covered under RCM. When the outward supply is covered under RCM, it will be treated as exempted. So, ITC cannot be availed. So, that is the clarity here. Okay. Then, and some students are asking me to upload the amendments video also. This revision itself covers amendments as well. Wherever it is amendments, I am highlighting that as amendment and I am discussing in detail. So, separately I am not uploading, because if I need to upload amendments video, 50% of this revision video itself I have to upload. Okay, that I will try if required, but not required. This itself is sufficient. So, please attend the amendments video, not separately. This revision itself sufficient. Okay. So, I think these are your queries. Now, moving on to Rule 42. What does Rule 42 talks about? I have some inward supplies which are commonly used for taxable and exempted. What is the manner of availment and reversal of ITC? For the purpose of this Rule 42, you need to follow a particular procedure. So, in this procedure, we need to know the meaning of certain terms. First, we need to know T. What does T refers to? T refers to total ITC, that is total GST paid on inward supplies. So, you can just put the numbers over there so that you will understand what it is about. The total GST paid on inward supplies is 4 lakhs. The total GST paid on inward supplies is 4 lakhs. And this 4 lakhs we should segregate into 4, that is inward supplies used for non-business purpose. Inward supply is for non-business purpose. Can we take ITC? No. While discussing section 41 read with rule 37A, what is that we have seen? Self-assessed ITC, I told you. In that self-assessed ITC, what is the discussion I have been making? So, matched ITC, and 3 things, even though comes in 2B, we should not take. What are those 3 things? So, inward supplies which are used for non-business purpose, exempted supplies and blocked ITC we should not take, correct, even though it is coming in 2B. Say for example, non-business purpose is 50,000 and inward supply used for exempted supplies is 75,000 and inward supplies which are blocked credit is 25,000. Now, this 50 plus 75 plus 25, can we take ITC or we cannot take ITC? We should not take ITC. Now, based on this, you tell me what is ITC availed in GSTR 3B. What is ITC availed in GSTR 3B? 4 lakhs minus 50,000 minus 75,000 minus 25,000. So, therefore, this will be 1,50,000 you take out. So, 1,50,000 if you are taking out. So, what is the remaining amount that is left? 2,50,000. This 2,50,000 is what? ITC availed. 2,50,000 is called as ITC availed. Okay. Understood up to this? What is the first step or first process? First T. T minus T1, T2, T3. What is T1, T2, T3? Non-business, exempted, blocked ITC. Remaining ITC we will take in 3B, 2,50,000. Now, this 2,50,000 can we enjoy fully? No. Why we should not enjoy fully? Because this 2,50,000 we don't know fully used for taxable or what. So, we cannot enjoy it. Okay, but we have availed it. We have availed it. Out of this 2,50,000, how much is used for taxable purpose? 2 lakhs. So, can we enjoy this 2 lakhs fully? Yes. Yes. Now, what is a common credit? What is a common credit? 50,000. How we got common credit? 2,50,000 minus 2 lakhs, which you could not segregate in these 4 places, is known as common credit. So, the common credit is 50,000. This 50,000 we can arrive in 2 ways. Number 1, you take 4 lakhs. From 4 lakhs, you reduce everything. That is 50,000, 75,000, 25,000 and 2 lakhs. So, the remaining is 50. Either you do this way or you take. So, 2,50,000 is the ITC avail. From that ITC avail, you separate fully used for taxable, that is 2 lakhs. So, the remaining is also common credit, 50,000 rupees. Now, this common credit you cannot enjoy fully. So, proportionate to exempted you need to reverse. So, that is what we did in this question. So what we did is that first we have taken the ITC. After ITC avail, we reduce the proportionate reversal. Proportionate reversal, how we calculated? Common ITC into exempted by total. So common ITC into exempted by total we need to reduce. Say for example, so common ITC is 50,000 into exempted turnover is 10 lakhs and the total turnover is 25 lakhs. This is what we have taken. So 10 divided by 25. How much is the ITC that we will reverse? 50,000 into 10 divided by 25. 50,000 into 10 divided by 25. How much? 20,000 we need to reduce. So means this 20,000 we cannot enjoy as ITC. Then common credit with respect to non-business purpose. So 50,000 into 5%. So that will be how much? 2,500. So 2,500 we need to reduce. Now this is what we need to do. So remember, first we need to take T. T refers to total ITC on inward supplies. It is total GST paid on inward supplies minus T1, T2, T3. T1 non-business, T2 exempted, T3 blocked. These three we should not take. These three we should not take. So how much we should take in the GSTR 3B, ITC availed in GSTR 3B? 2,50,000. So 2,50,000 is the ITC availed in GSTR 3B. Now after availing this, now you need to do the computation of common ITC. How we will get the common ITC? From this ITC avail you take out exclusive list for taxable and business purpose, that is 2 lakhs. If you take out, so remaining 50,000 is the common ITC. This 50,000 proportionate to exempted. So into 10 divided by 25. What is this 10 and 25? 10 is exempted turnover, 25 is total turnover, that you need to check in the question. Okay. Then we will be getting 20,000. Then the common ITC attributable to non-business purpose, because if you are using partly for business and partly for non-business, you can take proportionate ITC. So non-business purpose is 5%. So 2,500. Now how much we need to reduce? From the availed ITC, how much we need to reduce? 22,500 we need to reduce. So 2,50,000 minus 22,500, what is the balance that will be net eligible ITC for set off? 2,22,000, 27,500 will be the net eligible ITC for set off. So this is how we need to arrive at the answer. So you need to remember the format T. That is total GST paid on inward supplies. While reading the question itself, you put T1, T2, T3, T4 properly. In the solved workbook, already I have given few questions related to that along with the QR code. So you try that questions. Okay. So first you need to take T. T is total GST paid on inward supplies minus T1, that is inward supply used for non-business, minus T2, inward supply used for exempted, minus T3, blocked ITC. The balance is known as C1. What is C1? ITC availed in GSTR 3B minus T4, fully used for taxable purpose, that is 2 lakhs in this case. So 2,50,000 minus 2 lakhs, common ITC 50,000. Next we have D1, common ITC attributable to exempted, that is C2, common credit into E by F, exempted divided by total. Then common credit attributable to non-business purpose, C2 into 5%. Okay, but why sir 5% only? Because you don't know how much is exactly used for business and how much is for non-business. If you know exactly how much is business, how much is non-business, that you will divide in the T1, T4 stage itself. For example, 1/3 non-business, 2/3 business, means 1/3 you will put in non-business T1 and 2/3 you will put it in T4. So it will not come in common credit. If it is not coming in common credit itself, you don't do into 5%. Okay, and here 5% of the total common credit. If we have 10 invoices in the common credit, in the 10 invoices, only one invoice is used for partly business, partly non-business, but all these 10 invoices into 5% we need to do. So it is not only that particular purchase or inward supply used for business and non-business, we need to multiply 5%. Total common credit we need to multiply 5%. Why is it so, sir? Because that is a ad hoc assumption that we are taking. If you don't want that 5% to happen, then you ascertain how much is used for business and non-business, that you segregate in the beginning stage itself, that is T1 and T4 stage itself. So this is how you need to arrive at the answer. Then here C3 will be computed separately for CGST, SGST, means this computation whenever in exam you do it separately for CGST, SGST and IGST, and then this computation majorly this is our focus, D1 and D2. So this is the ITC avail, this is the ITC reversed. So this D1 and D2, so we will do on month, every month we will do this computation. Again at the end of the financial year, we need to do this computation once again, and we need to compare it between month on month versus D1 and D2 compute at the end of the year. Say this, D1 and D2 compute for the whole year by taking exempted turnover and aggregate turnover for the whole year. For example, D1 and D2 that we have computed month on month. So that is called as provisional D1 and D2. Say the provisional D1 and D2 which is computed every month. So the total is 15 lakhs. And final D1 and D2. This final D1 and D2 that we are computing at the end of the financial year is say 12 lakhs. Means how much we have reversed? This 15 lakhs is already reversed. This 15 lakhs is already reversed. Whereas this 12 lakhs is to be reversed. This 12 lakhs is to be reversed. Now already reversed 15 lakhs. But actually you need to reverse only 12 lakhs. What is the excess reversed? Excess reversed is 3 lakhs. And this 3 lakhs can be availed as ITC. You understood? Availed as ITC. And when we will do this computation, say this computation we will do from April 2023 to March 2024, we do provisional D1, D2. Every month we will do. Whereas this final D1 and D2 is there na? This final D1 and D2 we do it by 31st March 2024. At the end of the year we will do. And the excess reverse we will arrive. And that excess reverse we will avail as ITC by 30th September, not November. Usually the time limit for availment of ITC is 30th November of the next financial year. But in this case it is 30th September of next financial year, that is 2024. By 30th September 2024, we should avail this ITC. Not return of September. Any return. But that return should have been filed by 30th September of the next financial year. So because what happens is that in MCQ, we will think time limit for availment of ITC 30th November. They will give 30th September, 30th November, 31st October and some other date. We will think time limit is 30th November only and we will select 30th November. But in this place it is not 30th November, it is 30th September. Okay, say this. D1 and D2 will be computed for the whole year by taking exempted turnover and aggregate turnover for the whole year. If this amount is more than the amount already added. So actually we have seen the next point. If this amount is less than the amount added to output tax liability every month, the additional amount has to be claimed back as credit in the return of any month till September of the succeeding financial year. Then next, suppose if it is like reverse, what if the provisional amount, the provisional D1 and D2, the provisional D1 plus D2 is say 15 lakhs. This 15 lakhs is already reversed. Whereas the final D1 and D2, this final D1 and D2 that will be like say 18 lakhs, this is to be reversed. So this computation we are doing from April 2023 to March 2024. And this computation we will do by 31st March 2024. And now what is the shortfall? Shortfall in reversal. Shortfall in reversal is 3 lakhs. Okay. And this 3 lakhs shortfall in reversal we need to reverse. Why we need to reverse? Actually we should have reversed 18 lakhs, but how much we already reversed is 15 lakhs. So the 3 lakhs should be reversed. By when? So it should be reversed by September of the succeeding financial year, same date. It should be reversed by 30th September 2024, but here along with interest. When we reverse excess, we will not get interest and all. Don't expect interest from government. So you are getting this ITC itself, that itself is greater. But when there is a shortfall, you need to pay along with interest. at the rate of 18% per annum from 1st April 2024, because we should do this computation by when? March. So they are asking us to do the interest computation from 1st April 2024 till the date of reversal. And in many places they use the word reversal or payment interchangeably. Both are same. If you have balance in ITC, you will reverse. If you don't have balance in ITC, you will make the payment. Okay. So that is this. So here what they are telling, you see. So if the amount already added to output tax liability, if this amount is more than the amount already added to output tax liability, so we need to do it till September of succeeding financial year along with interest at 18% from 1st April of succeeding financial year till the date of payment. Again here we need to do reversal by September. What if we are not doing it by September? Then recovery will be made. So in this case, if you are not availing ITC by 30th September, it will be lapsed. Whereas in the second case, second example what we have discussed, if you are not reversing by 30th September, what will happen? They will initiate recovery. When they initiate recovery, even they will levy the penalty also. Okay, that is with respect to this. Then this is about rule 42. Then rule 43. Is it necessary to remember all the sections? Not required, but I don't know what is your objective. Your objective is 40 marks, not required. If your objective is 40 marks, really not required. So just this revision lectures will help you. You don't have to remember any section number or rule number, etc. and all. Just happily go to the exam. You will definitely get 40, 45, etc. and all. So you don't have to remember. But what is your objective? Depending upon that objective, it will be. So no student will read indirect taxes with the objective of 40 to 45. So because there are other subjects as well, so called as DT and IBS, etc. and all, and which are not actually bankable subjects and all. So due to that reason, IDT, if you are targeting 80 plus only, so you will be on a safer side, so that aggregate problem will not happen. For that reason only, even though it is a throat pain for me, I am repeating it 1000 times. So the same point, okay. So like by mistake that number may come in the exam and you will write it, okay. So say this, rule 43. Rule 42 is the manner of availment in case of inputs and input services. So there is a process you need to follow. Just because my name is THARUN'S, I did not keep T and all. Law itself they gave T, I did not keep, okay, because one student messaged me, why sir T? Because your name is THARUN'S, R also you can give na. Arey yaar, this T, T1, T2 I did not give here. It's a coincidence my name matches here, you understood. So but actually this is given in the law itself. So even in exam also you should write this only, T, T1, T2, T3. Then rule 43, manner of availment of ITC with respect to capital goods. What does it say? So I have capital goods which is used for taxable or business purpose. Can I enjoy ITC on this capital goods? Yes, no restriction, we can enjoy it because it is used for taxable and business purpose. Okay, I have some capital goods which are purchased and used for exempted or non-business purpose. Can I take ITC on this capital goods? No, you should not take ITC on this capital goods because your outward supply is exempted or non-business. Okay, I have purchased some capital goods which is partly used for taxable or business and partly for exempted or non-business. Can I take ITC? Yes. Take ITC, but conditions apply. This ITC is not enjoyable fully. So you have to reverse it over a period of next 60 months. For example, you purchase this capital goods, you can write the numbers over there, 10 lakhs excluding GST at 12%. So this is the value of the capital goods that you have purchased, 10 lakhs excluding GST at 12%. So what is the ITC? What is the ITC? 1,20,000 is the ITC. Now this 1,20,000 what you should do? Can you enjoy the ITC? Yes. Avail the ITC. 1,20,000 you avail ITC on the month of purchase itself. This month you purchase, this month itself you take the ITC. But you are using it for both taxable and exempted. So for the next 60 months, you need to do the reversal. So what is the monthly ITC? 1,20,000 divided by 60. So that will be how much? 2,000 rupees is the monthly ITC. Sir, should we take 60 only? That is usual assumption which is given in the law. The law says up to 60 months, which means you can take 48 months also, 36 months also, but go by the question. If the question says 36 months, you take 36 months. If the question says 48 months, you take 48 months. If there is no information in the question, you take 60 months. Okay. So 60 months should be taken standard as per the assumption. But if there is a lesser period given in the question also, you can take that lesser period. Otherwise, you take 60 months. So the monthly ITC will be 2000 rupees. Now, what you should do with this monthly ITC? You should reverse. Proportionate to what? Exempted to total. Exempted to total of that month, every month. Say for example, first month 2000 into exempted turnover say 10 divided by total turnover say 25. So 2000 into 10 by 25, how much? 300? 800. 800 rupees you need to reduce. 800 rupees you need to reduce from where? 1,20,000. 1,20,000 is the availed ITC na? Minus 800 rupees. That much only, sir. No, this for month 1. Like that we need to do for 60 months. Okay. And 800 rupees you need to compute interest. How much you reversed? 800. But this 800 is out of this 1,20,000 already availed. So you need to compute interest at what rate? 18%. From when? From the date of availment. Usually interest we need to compute from the date of utilization till the date of reversal or payment. Everywhere, correct? But in rule 43, we need to do it from the date of availment. Usually on account of interest in ITC, you should compute it from the date of utilization till the date of reversal. In this place alone, we need to do it from the date of availment till the date of reversal, because it is specifically given in rule 43 like this. Due to that reason only we are doing this. So the above amount to be added to output tax liability for every month for the next 60 months along with interest at 18%. So this 800 into 18% into number of months. Number of months we have divided by 60. Number of months divided by 12. For example, if this is pertaining to third month, if it is pertaining to third month, first month you avail the ITC. So first month to second month to third month, that is 2 months we need to compute interest. Okay, means for 60th month, sir, 59 months we need to compute interest into 59 divided by 12, 18% per annum over the period. Date of availment first month, date of reversal is 60th month. So which means for 59 months we need to do the interest computation. Then this procedure is not applicable from when? During the 60 months, any 1 month, the asset is sold. Then the asset itself is not there. Why I should do the reversal? I don't have to do the reversal. Or the asset got converted into capital goods 1. The asset got converted into capital goods 1. Means it is used only for taxable. So again, don't do the reversal. Okay. That is what I have given note. The above procedure is not required from the month in which capital goods are sold. Why? Because GST anyhow you are paying under 18 subsection 6. So what is this 18 subsection 6? Whenever capital goods are purchased on which ITC has been availed and that capital goods are sold or disposed. Now you need to apply 18.6. What does 18.6 says? GST payable will be highest of the following. A. ITC availed minus 5% depreciation for every quarter or part thereof. From when to when? From the date of purchase till the date of sale, or GST on sale value, whichever is higher. Anyhow, I am going to pay the GST on this, which is higher of what? Unutilized ITC. How we got unutilized ITC? ITC availed minus 5% for every quarter. From when to when? Date of purchase till the date of sale. For example, you used for 2 years, boss. You used for 2 years and you are selling it. So let's see what will happen in this case. Say 1st April 2020 you purchase capital goods and you purchase capital goods for 10 lakhs excluding GST at 12%. Okay. Now you are using it. What is the life of the capital goods? Life of the capital goods is what? 60 months or 5 years. So that is what? 31/3/2025. This is the life of the capital goods, correct? Now what happened somewhere after 2 years? So that is 31/3/2025. 2022. Okay. So you are selling the capital goods. Sale of capital goods. Sale of capital goods for 6 lakhs. 6 lakhs excluding GST at 12%. You tell me what would have happened in this case. And this is common capital goods. This is common capital goods. 1/4/2020 itself ITC availed, correct? How much is the ITC availed on 1/4/2020 itself? 1,20,000. Now from 1/4/2020 to 31/3/2022, how many months? 24 months, 2 years. What we would have done in these 2 years? So monthly reversal, correct? Monthly reversal. Now you are selling the capital goods. When you sell the capital goods, at this stage itself, GST payable under section 18 subsection 6. What is it? GST payable under 18 subsection 6. ITC avail minus 5% for every quarter or part thereof from the date of purchase till the date of disposal. That is 24 months means how many quarters? 8 quarters. 2 years here, 1 full 4 quarters here, 2 fulls means 8 quarters, correct or not? So 1,20,000 minus 8 quarters into 5%. Okay, how much that comes to? 8 5s are 40. 1,20,000 minus 40%. 72,000 or B. So what is the sale value of the capital good? 6 lakhs into 12%, that is 72,000. So exactly it is the same. So I will just change here, instead of 6 lakhs. So CG, sale of capital goods for 6,50,000 excluding GST at 12%. So that will come to 78,000. So whichever is higher, not lower, 6 lakhs into 12%, sorry, 6,50,000 into 12%, 78,000, whichever is higher. So which is higher? That is 78,000 is the GST payable. So you are paying, actually 24 months you reverse, and here at this stage you are paying 78,000. You got it? Now for the remaining life, what is the remaining life? 36 months. For this 36 months, whether monthly reversal required or monthly reversal not required? Huh? Not required. Monthly reversal not required. Why monthly reversal not required? Because already you paid the GST here at the time of sale of this capital goods. You got it? So somehow my intuition says that this concept will be tested. So this concept might be tested. So in the forthcoming exam for May 24, because quite a long time they didn't touch on capital goods. On inputs and all they have been testing, but not on capital goods. So merging these two concepts, they can check a question on 18.6 as well as on monthly reversal. Then next, another point we will see. So look into the next below discussion. There are two situations: initial purchase CG1 and at a later point of time CG2, and another case is initial purchase CG3 and at a later point of time CG2. Okay, and here one query, whether we need to take this as calendar quarters or 3 months should be counted as 1 quarter. Calendar quarters. Calendar quarters means what? So it's like any 1 day in that quarter you should take it as a full quarter. For example, instead of 31/3/2022, if it is 4/4/2022, then automatically it will become 9 quarters. How it will become 9 quarters? In the next quarter, see, up to 31/3/2022, 8 quarters here, path thereof. Now in April few days came na, so that should also be counted as 1 quarter. You understood? So therefore be careful while doing the quarter computation. Everywhere, actually only one place there was a difference. Duty drawback alone, we should count 3 months as 1 quarter. Like say for example 15th January means, how we will count quarter is 15th January to 15th April, 1 quarter, like that we used to count, where in duty drawback. But now duty drawback chapter is removed. So everywhere in GST and customs, we have calendar concept only, calendar quarter only. So 15th January means it should 15th January to 15th April. How many quarters? 2 quarters. How 2 quarters? Jan, Feb, March 1 quarter, April few days are there, that will be counted as 1 quarter. Got it? So everywhere in GST and customs, it will be calendar quarter only. Now, so look into this initial purchase CG1 and later point of time CG2. CG1 means what? It is used fully for taxable. And at a later point of time, it is used for common. Now what will happen in this case? So the logic is simple. That is, I purchase the capital goods. So on 1/4/2020, and the life of the capital goods is 31/3/2025. So the life is 5 years or 60 months. Now somewhere on 31/3/2022, that is 24 months, 24 months and 36 months. Initially I purchased it and used it for taxable. Okay, initially I purchased it and used it for taxable. So 10 lakhs is the worth of capital goods, excluding GST at 12%, and it is used for taxable. Used for taxable. Now what happened on 31/3/2022 is that I am not selling. In the previous example I took for sale. Now I am changing the situation. I am not selling, but I started using it for common. Used for taxable and exempted. Used for taxable and exempted. Now what will happen in this case? So 1/4/2020 itself, ITC availed or not availed? ITC availed. Why ITC availed? At that time we have purchased and used it for what purpose? Taxable. So we would have availed ITC at that time itself. How much is the ITC availed at that time? 1,20,000 itself we have taken ITC at that time. And for 24 months we are using it for taxable. Whether any reversal required for this 24 months? No. Reversal not required. Why reversal not required? Because you are using it only for taxable purpose. Now from 31/3/2022 till 31/3/2025, for 36 months, whether reversal required or not? Yes. Why reversal required? Because we are using it for both taxable and exempted. So monthly reversal required. Monthly reversal is required. And when you do the monthly reversal, how much we will take as ITC? So we will avail the ITC now. At the time already availed or not availed? Already availed. So whether we will avail the ITC? No, we will not avail any ITC. So at this stage, ITC not availed. Why ITC not availed? Because already we have taken in the beginning. Now don't take any ITC. Just consider as common ITC. 1,20,000, whatever is there, 1,20,000, consider as common ITC. Don't do anything else. Just consider it as common ITC. For the next 36 months, we will do the monthly reversal. That's it. Got it? So initial purchase we are using it for CG1, taxable. So ITC already availed at the time of purchase, so no need to avail common credit. No need to avail common credit. Just consider it as common credit. And what is the monthly ITC? Same, no change. Original ITC divided by 60, because the life of the capital goods cannot be more than 60 months. Now proportionate reversal from the date of conversion for the balance useful life. So what is the balance useful life here? 36 months. For 36 months we need to do the reversal, monthly reversal required. Then another situation, initial purchase CG3 and at a later point of time CG2. Now same scenario, but there is a change here. What is that change? That is 1/4/2020. I purchased the capital goods and the life of the capital goods is what? 31/3/2025. And I purchased capital goods for 10 lakhs, excluding GST at 12% and used only for exempted. And what will be the life of the capital goods? So 5 years. Now somewhere on 31/3/2022, that is for 24 months. Okay. After 24 months, I started using it for, used for both taxable and exempted. Used for both taxable and exempted. Now, you tell me whether ITC would have been availed at the time of purchase. No. Why not availed? Because it was used only for exempted. That's what we have seen. If capital goods are purchased and used only for exempted, we should not take ITC. So we have not taken ITC. Here ITC not availed. So ITC not availed at the time of purchase. But are we supposed to take the ITC now? Yes. Why we are supposed to take the ITC now? Because we have not taken at the time. Now you are using it for both taxable and exempted. So ITC availed. How much is the ITC that will be availed? 1,20,000. You avail now. But last 24 months you are using it for what? Exempted. Now can you enjoy the ITC for this period? This 1,20,000 you should have taken 1/4/2020, but you are taking it now. But this 1,20,000 contains the component of 24 months, yes or no? So this 24 months you used it for what? Exempted, which means you should not enjoy the ITC. So therefore ITC reversal, this is for the past period. For the past karma, we are reversing it now. You understood? So ITC reversal. How much is the ITC reversal? 1,20,000 into 5% into how many quarters? 8 quarters. So please do the calculation. 1,20,000 into 40%. That is 48,000. Now you are availing the ITC 1,20,000. Sir, should I avail 1,20,000 or I should avail 1,20,000 minus 48, 72,000. How much I should avail? Avail 1,20,000. Thereafter you reverse for the past period. You understood? And then you consider it as common ITC. Consider as common ITC, and for the next 36 months. For the next 36 months, you need to do the monthly reversal. Monthly reversal required. Sir, why should I do, sir? This is for the future karma. You understood? Past sin, wipe off fully. Future sins, as and when you do, you wipe off. You understood? So monthly reversal over the next 36 months. Last 24 months, now itself you reverse. Okay. So 2 reversals will come. But in the previous situation, only 1 reversal. Why? Because for the past 24 months, you did only good deeds. You understood? You don't have to wipe off anything. So full good deeds, taxable only you did. Only future you are going to commit some sins. For that only you need to do the reversal. You understood or not? But here, past also bad, future also bad. So therefore, first clear the past fully. So that's what 24 months you are fully reversing. Then for the remaining 36 months, month on month you do the reversal. You got it? That is about this. So ITC not availed at the time of purchase. So we are availing it now. What is that? Original GST paid. Ineligible ITC to be reversed. For the period it was used for exempted. Past. Used for exempted. How much? GST paid into 5% into number of quarters or part thereof from the date of purchase till the date of conversion. And monthly ITC, same, proportionate reversal for the balance life. So this is about capital goods, 3 special cases. So these 3 special cases can definitely be tested, possible. So these are the 3 special cases. First special case we saw was that common capital goods, at a later point of time we sold it. Next one, initial purchase for taxable and then used for common. Then initially purchased for exempted and used for common. These 3 can be tested for May 24, which is a very important area, untapped area, that's why. Then we are moving on to 17 subsection 4. 17.1 and 17.2 talks about proportionate ITC. 17.3 talks about the meaning of exempted supplies. Rule 42-43 talks about the manner of availment and reversal of ITC in case of inputs and input service. Rule 42, capital goods, Rule 43. Now 17.4 talks about special provision for availment of ITC by a banking company and financial institution, including NBFC. Basically, for a bank, financial institution or NBFC, they will be having 2 incomes, 2 major incomes, that is interest income and other income. Interest income will be exempted income, no need to pay GST on that, and the other income will be taxable income. Why? Because any bank or financial institution or NBFC, interest on loans, advances and deposits other than interest involved in credit card is exempted. So interest in credit card will be taxable, but interest on loans, advances, deposits will be exempted, and all other income for the bank will be taxable. We don't have any exemption like check collection charges, demand draft commission, or NEFT charges, RTGS charges, debit card charges, like that. Every charges will be taxable. So therefore, interest income exempted, other income will be taxable, which means bank cannot take full ITC. They can take only proportionate ITC, because part of their outward supply is taxable and part of their outward supply is exempted. So they have to do the proportionate computation. How they will do the proportionate computation? Total ITC into exempted turnover divided by total turnover. That is for inputs and input service. For capital goods, just now we discussed now rule 43 that they need to follow. But bank, it is difficult for them to follow this rule 42 and 43, because they have lot of documentation and administration work. For them, they have been given one special option that is called as ad hoc ITC option. Under that ad hoc ITC option, flat 50% of the eligible ITC they will be getting, which means assumption is what? 50% of their outward supplies will be taxable and 50% is exempted. So now they need to choose between either option 1 or option 2. Now whichever is feasible for them they can choose, but they have to choose it when? Beginning of the financial year, and that will be applicable throughout the financial year. Month on month they cannot choose. So beginning of the financial year. Option 1's exercise cannot be withdrawn during remaining part of the year. Option 1 is what? Proportionate ITC option. In proportionate ITC option, they will follow rule 42-43. Option 2, avail 50% of the eligible ITC. That is ad hoc ITC option. Now, in case of option 2, see this, usually in option 1, what is common ITC? Listen carefully. Inward supply used for taxable, fully you can take. Where? In option 1. Listen, very, very important discussion. Inward supply is used for taxable. Option 1, enjoy fully. Inward supply used for exempted, don't take. Common ITC, proportionate, correct. Whereas in option 2, inward supply used for taxable, inward supply used for exempted, as well as inward supply used for both taxable and exempted. All three will be treated as common only. So I am having some inward supply used for taxable, treated as common. Inward supply used for exempted, treated as common. Inward supply used for both taxable and exempted, that is also treated as common. So the meaning of common ITC will differ. That's what I am trying to convey here. See this. In case of option 2, exclusively used for non-business and blocked ITC, ITC should not be availed. Same, option 1 also same, correct. But what is extra? 50% computed on remaining ITC, means exclusively used for exempted and exclusively used for taxable, both will be treated as common ITC. Okay. For example, say this. So ITC used for taxable, ITC used for taxable outward, ITC used for taxable outward is 1 lakh. ITC used for exempted outward, exempted outward is 50,000. ITC used for both taxable and exempted, both taxable and exempted. Kindly make note. ITC used for both taxable and exempted, 2 lakhs. Okay. So these are the 3 inward supplies that we have, used for taxable outward, exempted outward, and both taxable and exempted. Now interest income. Interest income is 60 lakhs and other income is 40 lakhs. Now what will happen in case of option 1? What will happen in case of option 1? Option 1, how much is the proportionate ITC? Net ITC eligible, eligible ITC, net ITC, net ITC. What we will do? 1 lakh we will take fully, 50,000 we will not take, correct. Why 50,000 we will not take? Inward supply is for exempted, so we will not take. Okay. Then option 1 is what? Proportionate ITC, correct. Are you able to understand? Inward supply used for taxable, can we take full ITC? Yes. So 1 lakh into 100% you take fully. Whereas 50,000, don't take 0. And 2 lakhs, you take proportionate ITC. How much proportionate you will take? 40%. Why 40%? Other income is only 40%. Interest income is exempted, na? Interest income is exempted. Other income is taxable. So how much ITC you will take? Only 40%. Means first you will take full ITC minus reduce exempted. So 40% literally you will take. So how much is the net ITC? 1 lakh into 100%, full 1 lakh. 2 lakhs into 40%, 80. So how much is the net ITC? 1,80,000. This is under which option? Option 1. But option 2, what you will think? You will think as net ITC equals to 1 lakh into 100% plus 0 plus 2 lakhs into 50%. No, wrong answer. Wrong answer. All three, 1 lakh plus 50,000 plus 2 lakhs, everything treated as common, which means 3,50,000 into 50%. 3,50,000 into 50% is what? 1,75,000. 1,75,000. So this will be the net ITC. Okay. So there is a change in the answer. So don't blindly take into 50% only. So exclusively for taxable, exclusively for exempted is also treated as common under option 2. But exclusively for taxable treated as taxable exclusively only, and exempted we will not take, remaining only common for option 1. So this is another difference. Sir, what about blocked ITC and used for non-business? That is common. Like that is treated as not eligible, ineligible only in both the places, option 1 as well as option 2. Then what is the first difference we have seen in case of option 1, option 2? Option 1 proportionate ITC, option 2 50% ITC. Second difference is what? Fully used for taxable and fully used for exempted also treated as common in case of second option, but we will not do that in case of option 1. Then another difference, in case of option 2, restriction of 50% shall not apply to inward supplies from a distinct person. For example, there is a bank, so IDFC bank in Tamil Nadu, so which is receiving services from its branch in Karnataka. So this is an inward supply from a distinct person. In that case, no need to reverse 50% if it is option 2. Option 1 proportionate ITC, proportionately we will take. But in case of option 2, 50% shall not apply. So which means no need to reverse 50% with respect to inward supply from a distinct person. So these are the three differences that we have between option 1 and option 2. And you need to do this computation, and finally you need to decide so which option you want, and that you need to follow throughout the financial year. So this is about 17.4. Again in this 17.4, this area is important. This can be tested. Whatever you have written now, this is something which is not tapped in exam, either in MCQ or somewhere. So in MCQ I feel it can be tested because we will do mistake. In MCQ they can highlight this. Then next one, blocked ITC. And there is one very good query. One student has asked me, sir, here you are availing the ITC, sir. Here you are availing the ITC. There is a time limit for availment of ITC. That is, so you purchased it on 1/4/2020, means it pertains to financial year 2021. So 2021 means the maximum time limit for availment of ITC is 30th November 2021 only, na sir. How you can take ITC on this date? So here Rule 43 is overriding any other general provision. Rule 43 here is a specific provision in case of conversion. So as they have given clearly that we can take ITC, which means it will be like an exception to section 16 subsection 4, time limit for availment of ITC. Usually when there is a general provision and a specific provision, always specific provision will prevail over general provision. Due to that reason, we can take this ITC. Okay, no restriction of time limit. Then look into blocked credit 17 subsection 5. So the first block credit is motor vehicles related blocked credit. So total block credits means what? Ineligible credits. When you are making some purchase, you should not take ITC with respect to this. So that is block credit. We have motor vehicle related block credit, and then construction related block credit, and other block credits. These are the three divisions that we have. Now first we will see motor vehicle related block credit. Motor vehicles basically divided into three. motor vehicles for transportation of persons, that is 2-wheelers, 4-wheelers, 3-wheelers will come under motor vehicles for transportation of persons. Then vessels and aircrafts, so ships, aircrafts, helicopters, all these things will come under vessels and aircraft. Then other motor vehicles means other than these two, that is trucks, road rollers, JCB, crane, etc. will be coming under other motor vehicles, lorries and all. So other motor vehicles we don't have any restriction, ITC always available. So the restriction is only in case of transportation of persons, vessels and aircrafts. Other motor vehicles ITC always available. Whereas motor vehicles for transportation of persons divided into two. Capacity does not exceed 13 and capacity exceeds 13. Suppose if capacity exceeds 13, example buses, tempo travelers, mini bus, etc. So ITC available, we don't have any restriction. But the capacity does not exceed 13 is the blocked credit. So what is the first block credit in case of motor vehicle? Motor vehicle for transportation of persons, capacity does not exceed 13 is the block credit. However, we have 3 exceptional cases where ITC available for this block credit. What are the 3 exceptions? Number 1, if the motor vehicles is used for further supply. For example, a car dealer who is buying the cars and selling the cars. Car is a motor vehicle for transportation of persons. Capacity does not exceed 13 and it is coming under further supply. So ITC available. I am into the business of renting of motor vehicles. I purchase a car. So car is a motor vehicle for transportation of persons. Capacity does not exceed 13, but it is coming under further supply. Further supply. Supply does not mean only sale. Supply includes renting, leasing, hiring also. So therefore, I can take ITC. Second point, used in the business of transportation of passengers. I am running a travel agency or Ola, Uber, etc. and all. Now in that case, I purchase a car. Again, car is a motor vehicle for transportation of persons. Capacity does not exceed 13, but it comes under the second exception, used for transportation of passengers. So ITC is available. Then third exception, driving schools, imparting driving schools. So these 3 cases, basically capacity does not exceed 13 means ITC not available. But in these 3 cases, ITC available. For example, a Rapido driver purchases a 2-wheeler for the purpose of using it in the business of transportation of passengers. Can he take ITC? Yes. Because capacity does not exceed 13, even though it is a block credit, it comes under the exception. Now, Pizza Hut is purchasing, Pizza Hut or Domino's, etc. is purchasing a 2-wheeler for the purpose of food delivery. Where it will come? It will first of all not come under transportation of persons, it will come under other motor vehicles and ITC can be availed with respect to that. And remember, motor vehicle means capacity should be exceeding, that is greater than or equals to 25 cc. So if it does not exceed 25 cc, it will not be called as a motor vehicle. Okay, 25 cc, because this point in one attempt they have tested. So they tested, a company purchased a 2-wheeler which is having a capacity of 10 cc. Okay, I don't know what motor vehicle is available on earth which has 10 cc. Okay, but they have given a question like that. Now ITC available or ITC not available with respect to that? Yes, because first of all it is not a motor vehicle, because to come into the definition of motor vehicle, so the capacity should be how much? Greater than 25 cc. Okay, so that will only be coming and therefore it will not. And what if Dunzo, Zepto, etc. people or Flipkart, they buy a 2-wheeler and they use it for delivery of goods? Can they take ITC with respect to this? No. Why? Because in case of Pizza Hut or Domino's or food delivery, they will make one box on the back side, which means that it cannot be used for transportation of passengers. Consequently, it will come under other motor vehicles. But these people will not fix any box on the back, but they carry one bag with them, means the same vehicle they can also use it for transportation of persons as well. So due to that reason, it will not come under other motor vehicles, it will come under for transportation of persons, 2-wheelers, and capacity does not exceed 13. And it will come under these 3 exceptions? No. So due to that reason, ITC not available. So some companies and all will buy 2-wheelers for the purpose of giving it to collection agents. This is also one attempt they have tested. Collection agents. A company is having a lot of collection agents. For the sake of that collection agents, 2-wheelers are purchased and they are giving it to these collection agents for collecting the money. Now, these collection agents are basically employees of that company. Can the company take ITC on these 2-wheelers? No. Why they cannot take ITC on 2-wheelers? Because it is for transportation of persons. Correct or not? Persons only, na, people only, na, they will transport in that. And capacity does not exceed 13. So due to that reason, it will not be available because it will not come under the exceptions. Okay. So Rapido Why ITC available? Rapid also transportation of persons, but it comes under the second exception. What is that? It is used in the business of transportation of passengers. That's why ITC available. You got it? Then next, vessels and aircrafts. Vessels and aircrafts is also blocked credit. We have 4 exceptions for this. These 3 exceptions common. So further supply used in the business of transportation of passengers, imparting driving skills. Extra what we have is that used for transportation of goods. So for example, there is a diamond merchant. This diamond merchant purchased an aircraft for the purpose of transporting the jewelry and diamonds from one shop to another shop. Can they take ITC with respect to the aircraft purchased? Yes. Mainly it is used for transportation of goods. So due to that reason they can take ITC. Then next, second part in this is that there are 4 services in relation to motor vehicles: repair and maintenance, insurance and servicing. Repairs and maintenance, servicing, difference is that servicing is usually done in the authorized service center, whereas repair and maintenance will be done in the private workshops. Then insurance is general insurance which is taken on the motor vehicles. Then hiring, renting and leasing of motor vehicles is like taking motor vehicles on rent. These 4 services are in relation to motor vehicles, vessels and aircrafts. If motor vehicles, vessels and aircrafts is eligible for ITC, then on these 4 services also ITC available. If motor vehicles, vessels and aircrafts not eligible for ITC, then on these 4 services also ITC not available. For example, there is a chartered accountant who purchased a car for use in his profession. Can he take ITC on the car purchase? No. Why? Because car means capacity does not exceed 13 and it is not coming under the exceptions. Now that chartered accountant takes the insurance on that car, and along with insurance he paid the GST on insurance. That insurance GST cannot be taken as ITC. Why? As motor vehicle purchased is not eligible for ITC, even insurance service is also not eligible for ITC. Then another example, a company purchased a car for transporting its employees. Can they take ITC on the car purchase? No. Car means capacity does not exceed 13 and it is not coming under 3 exceptions. Therefore, ITC not available to the car purchase. Now, instead of purchasing the car, if they take a car on rent, can they take ITC? No, they cannot take rent ITC, because as the car purchased is not eligible for ITC, renting of motor vehicle also not eligible for ITC. So that is what we need to learn. So what are the 4 services? Repairs and maintenance, insurance services, servicing, hiring, renting and leasing of motor vehicles. If the motor vehicle purchase is eligible for ITC, then these 4 services to that motor vehicle also eligible for ITC. If the motor vehicle purchase is not eligible for ITC, these 4 services also not eligible for ITC. Then see these key points. While determining the capacity, driver should be included. That is, while determining this 13 capacity, 13 is including the driver seat. Okay. Then next, further supply includes purchase and sale of motor vehicles or motor vehicles used in the business of renting or hiring or leasing. And repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Second point already I explained. Further supply means what? Further supply means not only sale but also renting. So that's what I said. I am into the business of renting of motor vehicles. I purchase a car and I give it on rental basis. Can I take ITC? Yes, I can take ITC because it is used for further supply. So it is eligible. That is the second point. Okay. So further supply includes not only sale but also renting. Then what is this third point? There is an insurance company. Say for example, I purchase one car, and for that car I have taken a bumper to bumper insurance, and this car has met with an accident. Now what I will do? I will take the car to the service center and I will not pay 1 rupee also, as it is covered in the insurance. Now the insurance company will do the repairs, and in the sense the service center will do the repairs and they will raise bill to the insurance company. Now the insurance company will make the payment. I will not make any payment. Now the insurance company can take ITC with respect to this bill. Yes. The restriction is not there for insurance company. The restriction is there only for the owner of the car. For me, I cannot take ITC on the car purchase, correct? So as I cannot take ITC on the car purchase, on insurance or repairs and maintenance also I cannot take ITC. But this restriction is not there for the insurance company. Repairs, insurance and servicing of motor vehicles received by a general insurance company is always eligible for ITC. Then next, hiring or renting or leasing of motor vehicle as a statutory obligation by employer to employee is also eligible for ITC, and the statutory obligation can be under any law. For example, say there is a government order which says that companies which are working in night shifts should mandatorily provide cab facility to their employees, because of which they have received a rent-a-cab service. Generally, car is a motor vehicle for transportation of persons. Capacity does not exceed 13. So, car is not eligible for ITC because it is not covered under these 3 exceptions. As car is not eligible for ITC, repairs, hiring, renting and leasing of car also not eligible for ITC. So, rent-a-cab is a block credit. But what is the exception here? As that rent-a-cab is under a statutory obligation, so ITC can be availed. Understood how to interpret? So, as the rent-a-cab, generally rent-a-cab block credit. Why rent-a-cab block credit? If the car purchased is eligible for ITC, no. So, rent-a-cab also block credit. But if the rent-a-cab is under a statutory obligation, ITC available. Then, what if a bus is taken on hire? Bus taken on hire for transporting the employees. Can they take ITC on that rent? Yes. Because if bus is purchased, eligible for ITC? Yes. As bus purchase, because bus means what? Capacity more than 13. As bus purchased is eligible for ITC, so even renting of the bus is also eligible for ITC. We don't have any restriction there. Then ambulance and caravan are not motor vehicles for transportation of persons, because ambulance and caravan will come under other motor vehicles, because ambulance and caravan is not for transporting the persons. It will come under other motor vehicles, because the primary purpose of ambulance is to provide first aid during the travel, and caravan is for the purpose of short-term accommodation. So, it will come under other motor vehicles, ITC can be availed. But the problem with ambulance is that as the hospital's outward supply is exempted, transportation of patient in ambulance is exempted services. Due to that reason, even though ambulance as per blocked credit, we don't have any blocked credit on that, ITC available, but there is another restriction which will come, because as the hospital's outward supply is exempted, so they cannot take ITC on inward supply, because that is what we have discussed in section 17. If my outward supply is exempted, I cannot take ITC on my inward supply, that discussion. Then, sir, what if the same motor vehicle is used for both Dunzo and Rapido? Then ITC blocked or allowed? Simple. If I am using the motor vehicle partly for transportation of persons and partly for delivering the food items, etc. Now, I need to divide the turnover into 2. Whatever turnover, that is whatever money that I got by way of transportation of passengers, that proportionate ITC available. Whatever money that I have collected for delivering the parcels, etc., that is as Dunzo or Zepto, ITC not available. So, what is the ratio of my receipts? If the ratio of my receipts is 80-20, means proportionately I will take. This is as good as inward supply used for partly taxable, partly exempted we have, na? Same way we need to do. Okay. Then another point, e-bike will be given on rental basis or kilometers, whether it is eligible for ITC. Yes, because the process is like renting. They are buying electrical bike and they are giving the electrical bike on rental basis. Rental means it will come under further supply. Further supply means no restriction, and we can take ITC with respect to that. Then look into the second area, that is construction related blocked credits. What is this construction related block credits? I have 3 inward supplies used for construction of an immovable property. ITC not available on those inward supplies. What are they? Any service, works contract service, or any goods purchased. So, what is the difference between works contract service and any service? Usually in works contract there will be both transfer of property in goods as well as construction. So, it will be for a lump sum amount. A contract involving both transfer of property in goods as well as provision of service in relation to an immovable property for a single consideration, then it is called as works contract. For example, I want a building to be constructed. I can buy the material required for construction from the market and I can appoint a construction contractor. That will be called as a pure labor contract, wherein the service provider will provide only the construction service. Suppose if I am not buying the material from the market, I ask the supplier only to buy the material from the market and he also provide the construction service, then the name of that contract is known as works contract. So, whether it is any service, construction, interior decoration, architect, any service, or works contract service, including goods purchased for construction of an immovable property is blocked credit. These are the 3 blocked credits. However, we have 3 exceptions to this where ITC available. What is the first exception? The above discussion is not applicable to supplier. That is, works contractor will buy the material, he can take ITC. There is no restriction. Works contractor will receive interior decoration service. Works contractor will receive construction service. He can take ITC. The restriction is only to owner of the property. Owner of the property cannot take ITC with respect to the inward supplies. And second, construction of plant and machinery. For example, construction of lifts and escalators or construction of any machinery, etc. We can receive these goods or works contract service or any service, we can take ITC. But plant and machinery excludes telecommunication towers and pipelines laid outside the factory gate. Suppose if the pipelines are laid inside the factory gate, and for that pipelines if you receive construction service, can you take ITC? Yes, it will come under plant and machinery. Suppose if we are constructing a telecom towers, for telecom towers we will construct a foundation, cement foundation. For that cement foundation we purchase a cement. Can we take ITC? No, because plant and machinery excludes telecommunication towers. And for laying down pipelines outside the factory gate, we receive some construction service. Can we take ITC on that? No. Why we cannot take ITC on that? Because plant and machinery excludes pipelines laid outside the factory gate. Then, suppose if construction expenditure is charged to P&L, then also ITC available. So, because if construction expenditure is capitalized, then only ITC not available, but if it is charged to P&L, ITC available. Okay. Now, in the absence of information in the question, you assume that the construction expenditure is capitalized. Unless it is given specifically that construction expenditure is charged to P&L, so don't take the assumption. So, this is common for all blocked credits. Remember, in everywhere in the blocked credit, they have given an exception. Now, in the question, they gave the blocked credit, but they did not give exception, which means that exception is not satisfied. You understood? Example, they gave construction of building. So much is the GST paid, like that they have given. Now, generally construction of building block credit, there is an exception when if the construction expenditure is charged to P&L. Is the exception given in the question? Not given in the question means that exception is not satisfied, and which means it is blocked credit only. You got it? Then another case, we have seen motor vehicles, car purchased and used in the business. They didn't give anything. Means the exception should be given, na? What is that exception? Used in the business or transportation of passengers, or used for driving skills or further supply. They have not given, means exception not satisfied. Exception not satisfied means blocked credit only. Got it? And then they will give, so a factory purchased a car for transporting its workers, but they did not tell statutory obligation. If they have given statutory obligation, then only it will be exception. Otherwise, exception not satisfied. You got it? Be careful in the way you read the questions. Okay. Same way here, nothing given. Plant like construction expenditure they gave, but they did not give. Construction of a factory shed, GST paid 2 lakhs. What is your answer? Blocked credit. Why blocked credit? Because factory shed definitely capitalized. Suppose if they say construction of a factory shed where the expenditure is charged to P&L, then ITC available. That is this. If construction expenditure is charged to P&L, then also ITC can be availed on above inward supplies. Now, in this regard, I want to add one more point. Basically, these builders who are constructing residential buildings, generally builders don't have any blocked credits. Builders can enjoy the ITC. So, because first exception, the above discussion is not applicable to a supplier. Means if a builder is purchasing the material, if builder is receiving the construction service, they can take ITC. Now, that builder is constructing a residential apartments. Residential apartments, the rate of GST is 1.5% or 7.5% without ITC. You can see sale of building by a promoter or builder when covered under supply, GST 1.5% or 7.5%. In which case it is 1.5% or 7.5%? Residential apartments or units will be having the rate of GST 1.5%, 7.5%. So, usually the rate of 1.5 or 7.5 is without ITC. Means can they take ITC on the inward supplies? No. even though there is no restriction for the builder, but as the builder is doing residential construction, the rate of GST for residential construction is 1.5, 7.5 without ITC, so they cannot take ITC on inward supplies. ITC not available even though such inward supplies are not blocked credit. Suppose if the outward supplies are taxable at 12% or 18%, which one? Commercial constructions. Commercial constructions like bridges, roads, and then commercial complexes, etc. The rate of GST will be 12% or 18% with ITC. So can they take ITC with respect to this inward supplies? Yes. ITC available on inward supplies other than blocked credit. So they don't have any blocked credit now. So ITC they can enjoy. Got it? That is with respect to this. Next, other blocked credits you see. Other blocked credits. Membership of a club, health and fitness center is the block credit. And what is an exception for that? If it is provided by employer to employee under a statutory obligation. Membership of club, health and fitness center. Gym membership, blocked credit. Social club membership, blocked credit. But on the GST paid, sir, yes, GST is paid on that, but it will be a blocked credit. So like lot of people, but it's a business expenditure. I'm not talking about personal expenditure, because if it is a personal expenditure, anyhow it is not eligible for ITC, because section 16, the second condition says the inward supply should be used or intended to be used in the course or furtherance of business. So here it is a business expenditure only, but even then it is blocked credit. Membership of a club, health and fitness center. What if government has mandated the company to take membership of a social club on behalf of their employees? And in that case, on the GST paid can be taken as ITC? Yes, that comes under the exception employer to employer under statutory obligation. Then second point, travel benefits extended to employees on vacation. So employee is going on a vacation and the travel expenditure borne by the company. Now company cannot take ITC with respect to the travel expenditure. However, same exception, if it is incurred under a statutory obligation by employer to employee. Suppose if the law mandates that the employer has to mandatorily provide the travel facility, leave travel facility. In that case, if the employer has borne that expenditure, can he take ITC? Yes, because this is under a statutory obligation. Now, the employee is going on a business visit. Can the ITC be taken? Yes, ITC can be taken because the point given is employee is on vacation. The next one, non-resident taxable person, NRTP. So non-resident taxable person is a person who is coming from outside India to India, who is not having any fixed place of business in India. So this NRTP can take ITC only on import of goods. Exception is only import of goods by the NRTP. So basically these NRTPs can come into India for the purpose of providing any services or supplying any goods. Example of NRTP you remember. So these cricketers basically who come to India to play IPL matches will be coming under NRTP. Now that it is IPL season, so lot of foreign cricketers and all will be coming to India. And what is the stay? Will the stay be for a period more than 180 days? No, definitely not more than 180 days. Hardly 90 days they will stay. So that too depends upon which team they are playing and which team will go for qualifiers, playoff, etc. and all. So therefore, so why they will stay for 180 days and all? They will not stay. So which means they are called as a NRTP, non-resident taxable person. They are coming from outside India to India. Except Warner, every other person will come under NRTP only, because Warner will behave as if he is Indian only. All his reels and all will be based on Indian movies reels only, okay. So except David Warner, every other person literally NRTP. They don't have any fixed place of business in India, and they will enter into India to make supply of goods or services. Now can they take ITC on any inward supply that is in India? No. Only on import of goods. What goods they will import, sir? Their cricket kits, garments, etc. and all they will be importing. Why they will import that? Yes, baggage and all they will not be bringing, because recently one Ambani great Indian fat wedding has happened. So in this wedding, so one person has come for dancing, you understood? No, singing. So I don't know what is her name also. Rihanna, okay, Rihanna came. And when Rihanna came, Rihanna was not great news. So her costume was a great news. Like, some big luggages came, cargo containers, luggage and all came in cargo containers. Like that, these cricketers and all will be bringing their luggage in cargo. That will be import of goods. On import of goods, customs duty along with IGST paid, that IGST can be taken as input tax credit. Apart from that import of goods, no other inward supplies they can take ITC. That is about NRTP. Then food and beverages. Remember, food, beauty, insurance. Food, beauty, insurance. So food and beverages, outdoor catering related to food. Beauty treatment including cosmetic surgery, plastic surgery, hair transplantation. Number 3, insurance, life insurance and health insurance. These 3 are blocked credit. Food, beauty and insurance is block credit. However, we have 3 exceptions to this. First exception, common, statutory obligation. Statutory obligation, that exception is there, provided by employer to employee under a statutory obligation. Example, there is a factory which is providing food to their workers, which is under the statutory obligation under Factories Act. Now they purchase the food. Can they take ITC on the food purchase? Yes, because it is under the statutory obligation even though it's a block credit. Then first exception, inward supply, outward supply in the same category. So for example, there is a hospital which is providing cosmetic surgery to its patient. Cosmetic surgery is taxable. Now they don't have a surgeon, so they approach another hospital. Another hospital provided the cosmetic surgeon and billed to this hospital. Can this hospital take ITC with respect to that? Yes, because inward supply, generally cosmetic surgery is block credit, but inward supply, outward supply in the same category, so ITC will be available. Then inward supply is part of composite or mixed outward supply. There is an airline company which is into the business of transportation of passengers and providing food to their passengers. Now they purchase the food for providing it to their passengers. As inward supply is part of outward supply, they can take ITC on food and beverages purchase. So first block credit is what? Food, food related to food, food and beverages, outdoor catering. Related to beauty, beauty treatment, cosmetic surgery, plastic surgery, hair transplantation. Related to insurance, life insurance and health insurance. These 3 are block credits, but 3 exceptions. First exception, inward supply, outward supply, same category. Inward supply, part or component of outward supply, and statutory obligation, employer to employee. Then balance blocked credits. Suppose if you are purchasing from a person opting for composition scheme, it's a blocked credit. Moreover, it is already given there in the meaning of input tax. Input tax excludes tax under composition scheme. Then if you are making purchases and used for personal consumption, you cannot take ITC. It is also already given in section 16. Inward supply should be used or intended to be used in the course or furtherance of business. If it is used for personal purpose, we cannot take ITC. Again, it is repeated as blocked credit. Suppose if it is used in obligations under CSR, corporate social responsibility under Companies Act. So there every company has to spend their 2%, I think, some average profits, 2% they need to spend for CSR. So this amount of spending involves, some expenditure. On that expenditure, there will be some GST paid. So these expenditures, what and all will be constituting CSR, like that one schedule is there. So in that schedule, they will specify these activities they can do. For these activities, some spending will be involved. In that spending, every expenditure will have a GST component. Can the GST component be taken as ITC even though it is like a business expenditure? No, it cannot be taken because it is a blocked credit now. That's an amendment. Then goods lost, stolen, destroyed, written off or disposed of by way of gifts or free samples. I am purchasing some goods and that goods got stolen. I cannot take ITC. And that goods got destroyed because of fire accident. I cannot take ITC. So that can be even destroyed on account of natural calamities also. Normal or abnormal, it is irrelevant. So therefore, whatever the goods purchased are lost, stolen, destroyed, written off for any reason, ITC not available, or disposed of by way of gifts or free samples. So I purchased some goods and I disposed of those goods as gifts or free samples. I cannot take ITC on those goods purchased. Suppose if that gifts or free samples constitute supply, can I take ITC? Yes, that's an exception that we have. See the note. If gifts or free samples state as supply under 71C, then ITC not required to be reversed on inward supplies. For example, there is a company. So that company wanted to give a mobile phone as a gift to their employee. So there is a company which is giving a mobile to their employee, gift of mobile. Gift of mobile. Okay. And they have to buy the mobile na. So therefore, from a supplier, so this company has purchased mobile, purchase of mobile, and the value of this mobile purchased is 60,000 plus 12% GST. Now, gift of mobile to employee. Is this supply or not a supply? This will become supply. Why it will become supply under 71C? Because the value of gift exceeds 50,000. So, as value of gift by employer to employee exceeding 50,000 per annum per employee is a supply, and employer and employee are treated as related parties. So, value of gift exceeds 50,000 per annum. So, it is supply. As it is supply, can the company take ITC on the mobile purchase? Yes, ITC available. Okay. So, that will be 60,000 into 12%. That is 8,000, 7,200. So, they can take this 7,200 as ITC. There is no restriction with respect to that. That is what I said. Generally, gift of mobile is blocked credit. But if gift of anything is blocked credit, but if that becomes supply because of 71C, then they can take ITC on the gifts purchase. There is no restriction. So, that is this note. Basically, gift or free sample block credit. But if gift or free sample treated as supply under 71C, then ITC not required to be reversed on inward supplies. And then one more point, if GST is paid under section 74, 129 or 130, 74 talks about short payment of GST, non-payment of GST or wrong availment of ITC, etc. on account of fraud, okay. Then 129 is we are transporting the goods without valid documents, then the officer will stop that vehicle and will seize those goods and will recover the penalty from us. 130 is confiscation. In these three cases, supplier has not paid the GST voluntarily, but it has been recovered from him by the government. Now, you cannot take ITC as a recipient, but logically this point is meaningless now. Why it is meaningless? Sir, if he has not voluntarily paid, he would not have reported in GSTR 1. Correct? He has intention to evade boss, means he would have not reported in GSTR 1, means it will not come in 2B. If it is not coming in 2B, you cannot take this as ITC. You got it? Had he reported in GSTR 1, these sections will not come. These sections are coming in which place? Only when he is not reporting in GSTR 1. Okay. So, it has been recovered from him, GST paid under these sections, and such GST is not matched ITC. Basically, it is not a matched ITC. Why it is not a matched ITC? Because he will not report it in GSTR 1 and it cannot be availed. Sir, but he can rectify now, sir. He voluntarily did not pay, but thereafter it has been recovered from him. Now, can he rectify the return, sir? Usually there is a concept of rectification of return. GSTR 1 we can rectify and in amendment we can add now, sir. Yes, yes, but that amendment should not be on account of any audit or investigation or any enforcement activity. Voluntarily, if you made a mistake and you identify that, you can add, because this point is there in rectification of returns. So, in the returns chapter, if you see page 137, rectification of returns. So, GSTR 1 we can rectify, but when you rectify GSTR 1, the rectification should not be on account of scrutiny, audit, inspection or enforcement activity. Means your supplier has not voluntarily paid, it has been recovered from him. The moment it has been recovered from him, through amendment, he can think, through amendment I will add it in GSTR 1. So, when he adds in GSTR 1, it will come in your 2B. So, you can take ITC. But the problem is that it should not be done. Why it should not be done? It is not in input tax credit. Some other place it is restricted, wherein they are telling you cannot do the rectification of return on account of scrutiny, audit, inspection or enforcement activities. Got it? So, which means once he has not voluntarily paid and it has been recovered from him, he can never put it in GSTR1. When he cannot put it in GSTR1, it will not come in 2B. If it is not coming in 2B, you cannot take that as ITC. That's the conclusion of this story. So this is about that blocked credit point. Then, so we have completed blocked credits. See the next discussion, section 18. Section 18 talks about ITC in special cases. Sir, rate of GST is 5% for construction of buildings. No, it is 1.5% and 7.5% only. That 1% and 5% is the effective rate of GST. How that effective rate is arrived? Usually, whenever we sell any flat, so including the land, UDS, we will get a 1/3 reduction with respect to the contract price. Okay. So say this, for example, contract price of flat including UDS is 75 lakhs. Now in this case we will get 1/3 reduction towards UDS. You will get a reduction. This is an exemption we have. So which means 25 lakhs will be exempted. So what is the value on which GST payable? Value on which GST payable will be 50 lakhs. And what is the rate of GST? Rate of GST is 7.5%. So GST payable will be 50 lakhs into 7.5%. So that will be 3,75,000. But normal layman cannot understand this. Why 1/3 reduction? What is UDS? All these things builders cannot explain to the buyers. So what they will tell is that this 75 lakhs into 5% is GST. That will also come to 3,75,000. Okay. So rather than putting this way, in market, this is the way in which it will be shown, 5% like that. So we also, like stupids, we will think that 5% is the rate of GST. 5% is not the rate of GST. The rate of GST is 7.5%. This only you need to follow for exam purpose. Okay. So in reality you can follow anything, but for exam purpose don't write 5%. You know what? When you do this exemption also will give 1/3. Thereafter if you do 5%, answer will be wrong. Okay. So this is the only way in which you need to do. So don't remember the rate as 1.5%, 1% or 5%. Remember it as 7.5%, 1.5%. That is one question. Then next, seating capacity 13, any logic, regular batch. Then will e-bike comes under motor vehicle definition? Actually yes, because the power of propulsion can be through the internal source or can be from the external source. So either using fuel it can be, or it can be from recharge, electric charge. Okay, both will be coming under motor vehicles. Okay, simple logic. Usually for electric vehicles also registration is required, and for whichever electric vehicles registration is required, those vehicles and all will be automatically coming under motor vehicles. Okay, so it will come. Then next, they have taken solar panel as immovable property. Yes, of course, solar panel immovable property only, but it will come under plant and machinery. The solar panel will come under plant and machinery. In RTP, yes, there is one question related to that. It should be plant and machinery, dear. Okay. Then can Swiggy take ITC on its inputs? Buying from other restaurant food? No, because basically the rate of GST applicable for food is 5% without ITC. So due to that reason, so restaurants which are supplying food cannot take ITC, because that is like rate related provision. Those rate related provisions and all you don't have, so don't worry about that. And then yes. Sir, will you solve few questions for better understanding? I am doing that. Really I am doing. See how many questions I have written from morning. I am doing, no? This only I can do. You cannot expect me to solve you know, past exam questions, all these things. There is a limit, bro. Bro. Say this. Section 18, availment of ITC on closing stock. So this is about section 18 subsection 1. That is, there are 4 situations where we can take ITC on closing stock. So 18(1)(a), a person is liable to get registered and applied within 30 days. So before I was not registered, now I am liable to get registered. I made application for registration within 30 days. Now before the date I am liable to get registered, I have some closing stock. On that closing stock, I have not taken ITC. Why I have not taken ITC? Because at the time when I purchased that closing stock, I was an unregistered person. Now I am registered, I will use this closing stock, so I can take ITC on the closing stock. See this, you are liable to get registered and you made application within 30 days. Now you have some inputs. What is the meaning of closing stock? Input as such held in stock, inputs in the form of WIP held in stock, and inputs in the form of FG held in stock. And which date closing stock should be taken? Immediately preceding the date on which he is liable to get registered. And so this stock should have been purchased within 1 year prior. So means on obsolete stock or non-moving stock and all, they are not giving credit. They are giving credit only on those stock which is purchased within 1 year prior to the closing stock date. Why they are giving ITC? Why we have not taken ITC at the time when it is purchased? Because at the time when you have purchased, we were unregistered person. Being unregistered person, we cannot take ITC. Then why are they giving now? Because using the closing stock, we are making outward supplies. And when we make outward supplies, we need to pay GST on that outward supply. So logically, they are giving ITC on the closing stock. Then 18(1)(b). What is the difference between 18(1)(a) and 1)(b)? 18(1)(a), I am liable to get registered and I made application for registration within 30 days. But in 18(1)(b), I am voluntarily getting registered. But the closing stock meaning is same. Inputs as such held in stock, inputs in the form of WIP held in stock, inputs in the form of FG held in stock. Which date I need to take? Before the date I get the registration certificate. So whatever is the closing stock. Sir, on capital goods, can we take credit under 18(1)(a), 1)(b)? No. Why they are not giving credit on capital goods under 18(1)(a), 1)(b)? Because 18(1)(a), 1)(b) do not require matching. Moreover, matching cannot be made. Why matching of ITC cannot be made? At the time when you purchased, you were an unregistered person. Being an unregistered person, you would not have given your GSTIN. Means your supplier would have shown it under B2C supplies. So which means you cannot take ITC with respect to that. So that's the reason why matching is not required. As matching is not required, definitely fake invoices can be brought, and capital goods and all involves a huge credit. So that's why they are not giving credit in case of 18(1)(a), 1)(b) with respect to capital goods. But if you see 18(1)(c), 1)(d), for 18(1)(c), 1)(d), they are giving credit on capital goods. And when 1(c), 1)(d) will be applicable, you were under composition scheme. So under composition scheme, you would not have taken ITC. Now you have migrated to normal scheme. Under normal scheme, you can enjoy the ITC. So from the date you are migrating from composition scheme to normal scheme, at that time there was some closing stock. Now on that closing stock, GST paid can be taken as ITC. But what is the meaning of closing stock here? Same. Inputs as such held in stock, inputs in WIP held in stock, and inputs in FG. What is the extra point we have? Capital goods. But sir, capital goods, can we take full credit? No. You cannot take capital goods full credit. It should have been purchased past na. So we should reduce. How much we should reduce? Usually what is the depreciation for ITC? 5% for every quarter or part thereof. So see the note below. In case of capital goods, ITC shall be GST paid minus 5% into number of quarters from the date of purchase till the date of migration or conversion. For example, say this. So it is like on 1/4/2024, I am moving into regular scheme. And before that, I was under composition scheme. Now, when I was under composition scheme, I would not have taken ITC. Now, I am migrating from composition scheme to regular scheme. Now, Previously, when I was under composition scheme on 8 February 2023, 8th February 2023, I purchased capital goods and the value of that capital goods is 10 lakhs excluding GST at 12%. Excluding GST at 12%. Now, how much ITC I can take in case of regular scheme? How much ITC I can take on this capital goods under regular scheme? Calculate that. So, this is under 18(1)(c) na? Yes, 18(1)(c), composition scheme to normal scheme. So, how much is the ITC under section 18(1)(c)? How much is the ITC? So, capital goods is purchased and on which GST is paid. So, 10 lakhs into 12%. How much? 1 lakh? 1,20,000 minus 5% into how many quarters? 8 to 2023 I purchased. 8 to 2023 when I have purchased it, you count the number of quarters. So, that is Jan, Feb, March 1 quarter. Then again April, May, June, July, August, September, October, November, December, again Jan, Feb, March. So, 5 quarters, correct. So, 5% into 5 quarters, that is 25%. How much? 1,20,000 into 25%? 30,000. So, 30,000 we need to reduce and remaining 90,000 we can take as ITC. You understood? You do this way so that your result will be fail. Kumuttai, we have discussed within 1 year back only it should be purchased, correct? Am I right? So, the above closing stock including capital goods should have been purchased within 1 year prior to closing stock date. So, everything don't nod your heads. So, 1/4/2024 means within 1 year prior. Here you will not get 1 rupee also. ITC will be 0. Why ITC will be 0? Because the capital goods are purchased before 1 year. We cannot take ITC on that capital goods and all. For 18(1)(c) or 18(1)(d), all the goods including capital goods should have been purchased within 1 year prior. Capital goods are not purchased within 1 year prior to, what is the closing stock date? 31st March 2024. Okay. So, means everything should be purchased within 1 year prior, including the capital goods. Then, how to avail this ITC? Whether we avail this ITC in GSTR 3B? No, we need to file one declaration in ITC 1. And that ITC 1, when we should file? Within 30 days from the date of migration or from the date of registration, like that. Okay. Now, one more case you see, 18(1)(d). What is 18(1)(d)? A person whose exempted supplies became taxable. When exempted supplies became taxable, he need to take ITC. At the time when his outward supply was exempted, he would not have taken ITC. Now, the moment exempted supply became taxable, he can take ITC on his closing stock. So, but again, what is the closing stock? Same. Inputs as such held in stock, inputs in WIP held in stock, inputs in FG held in stock, and even on capital goods. And which date? Immediately before the date of such conversion. Okay. So, what are the 4 situations that we need to remember? Liable to get registered and made application for registration within 30 days. Voluntarily got registered. Number 3, registered person migrated from composition scheme to normal scheme, and registered person exempted supplies have become taxable. Now, in these 4 situations, what is the difference between first 2 situations? So, first 2 situations, liable to get registered and made application within 30 days, voluntarily got registered, and date also will change. So, in first case, it is before the date the person is liable to get registered. Second case, immediately before the date of registration. Then, what is the difference between third case and fourth case? Third case, composition scheme to normal scheme. Fourth case, exempted supplies to taxable supplies. And date also same, immediately before the date of migration, here immediately before the date of conversion. What is the difference between first 2 points and the next 2 points? First 2 points, we cannot take ITC on capital goods, but the next 2 points we can take ITC on capital goods. How much ITC we can take on capital goods? Total GST paid minus 5% for every quarter or part thereof from the date of purchase till the date of conversion. And one more difference. First difference is capital goods. Second difference, matching is required in case of 18(1)(c), 1D, but 1A, 1B matching is not required. And third difference, 1A, 1B is applicable for an unregistered person who is now only getting registered, but 1C, 1D is applicable for a registered person whose outward supplies became taxable from exempted, or registered person who is migrating from composition scheme to normal scheme. Now, let us see one more situation in this. That is, I commenced business on 10/5/2023. Commenced business on 10/5/2023. Making exempted supplies. So, as I am making exempted supplies, I am exempted from registration, correct? Making exempted supplies, and on 1/10/2023 exempted supply became taxable. Exempted supply became taxable, and person got registered. Person got registered after 1/10/2023. Okay. Now, capital goods purchased in 31, purchased on 31/7/2023, whether ITC available. Whether ITC available. It is purchased within 1 year prior only. But why ITC not available? Because in this case, the applicable section is 18(1)(d) or 18(1)(a. No, applicable section is 18(1)(a, not 18(1)(d). Why not 18(1)(d)? 18(1)(d) is applicable when registered person's exempted supply becomes taxable. But is this person a registered person? No. Now only he is getting registered. So applicable section is 18(1)(a, but not 18(1)(d). Under 18(1)(a) can we take ITC on capital goods? No. Therefore ITC cannot be availed. Cannot be availed on capital goods. Clear? That is with respect to this. Next one, see below. Here, all the above closing stock should be purchased within 1 year prior, and ITC with respect to GST paid on inputs can be availed as ITC, no restriction. Full ITC you take, inputs no issue. But for capital goods alone, we need to reduce 5% for number of quarters from the date of purchase till the date of migration or conversion. And one electronic declaration we need to file to take this ITC, that is ITC 1, and that ITC 1 should be filed within 30 days. In case of 18(1)(a), from the date we get the registration certificate, 18(1)(b) from the date we get registration certificate, 18(1)(c) from the date of migration, 18(1)(c) from the date of conversion, within 30 days or extended time limit. And suppose if the claim of ITC exceeds 2 lakhs, it should be certified by a CA or CMA. Suppose if the ITC claim does not exceed 2 lakhs, then it will be self-certification. So this is about 18(1) and 18(2). 18(3) will be applicable in case of transfer of ITC. So whenever I transfer my business with specific provision for transfer of liabilities, so whatever is the unutilized ITC from the transferor will be transferred to transferee's electronic credit ledger. So but remember, the transfer of business should be with specific provision for transfer of liabilities, means both assets and liabilities should be transferred, means it should be transfer in the nature of merger or amalgamation, but it should not be mere procurement of assets or procurement of brand name or a simple takeover. So there should be all risks and rewards incidental to the business should be transferred. Means assets and liabilities should be transferred, and the transferee should have the intention to continue the business as a going concern. So then only it will be called as transfer of business with specific provision for transfer of liabilities. Then transferor will file one form, ITC2. ITC1 is for availment of ITC on closing stock, ITC2 is for transfer of ITC in case of transfer of business. And this ITC2 should be certified by a CACMA. ITC1 should be certified by CACMA if the claim of ITC exceeds 2 lakhs, but ITC2 should be certified always, whatever may be the amount. And what is that CACMA will certify? That this business is with specific provision for transfer of liabilities. Then in case of merger of two companies, say A Limited and B Limited gets merged into AB Limited, no issue. So whatever ITC that is there in A Limited will be transferred, whatever ITC that is there in B Limited also will be transferred. So this is not a big deal. But when AB Limited is getting demerged into A Limited and B Limited, now from single source the ITC needs to be transferred. Then what is the ratio to be followed? So you take the assets ratio of A Limited and assets ratio of B Limited immediately after demerger, and the ITC will be transferred. In case of demerger, credit shall be transferred to the new entities in the ratio of net assets. So we should take all assets, whether ITC is availed on that assets or not availed on that assets, that should be taken post demerger. Then transfer or change in ownership also includes transfer or change in ownership due to death of sole proprietor. So what happens is that there is a sole proprietor who is dead and his son has taken over the business. In that case also ITC can be transferred from the father's GSTIN to son's GSTIN. Should the son get a new registration? Definitely son should get a new registration, because there is a death of sole proprietor, means permanent account number changes. When the permanent account number changes, GSTIN is connected to permanent account number, so new registration should be obtained. And thereafter son can log in the name of the father and he can file ITC2 for transfer of ITC from father's credit ledger to son's credit ledger. Then transferor and transferee should be in the same state. So this is the restriction which is given in the portal, and that is included in the circular. So one CBSE clarification has been given. For example, transferor is in Tamil Nadu, transferee is in Karnataka, ITC cannot be transferred. So means transferee should get a registration in Tamil Nadu and then only the ITC can be transferred. So transferor and transferee should be in the same state. Then this transfer of ITC is also applicable in one more case. What is that? There is a single registration which is now converted into multiple registrations. For example, within the state, we have an option whether to go for single registration or separate registration. For example, say in Karnataka, there is a person who is having a place of business as Bengaluru, Hubli and Mysuru. Like that, 3 places a person is having place of business, and he was under a single registration, because it is optional. When I have multiple place of business, either I can go for single registration or I can go for separate registration. Now I am going for single registration in Karnataka and it is optional for me, so I selected single registration. Now so far I am having one GSTIN in Karnataka. Now as my business demands, so I want to go for separate registration. So I got separate registration in Bengaluru, Hubli and Mysuru. I am getting a separate GSTIN. Separate GSTIN in Bengaluru, separate GSTIN in Hubli and separate GSTIN in Mysuru. Now so far I was doing business in the single GSTIN. Now from the single GSTIN, the ITC will be transferred to all these 3 GSTINs. Okay. So for that purpose, because so far I have been doing single registration only, means ITC will be accumulated in that registration. That ITC can be transferred, for which one ITC 2A form needs to be filed for transfer of ITC between single registrations to multiple registrations. So that is this. When a single registration gets converted into multiple registrations, then ITC against single registration can be distributed to multiple registrations by filing one form. What is that form? ITC 2A. In what ratio, sir? In what ratio? Simple, assets ratio. Same way. In demerger we saw na assets ratio. In that assets ratio between these 3 registrations, ITC can be transferred. Then next we are looking into 18 subsection 4 and 29 subsection 5. This is with respect to reversal of ITC on closing stock. This is the opposite of 18(1)(c) and 18(1)(d). 18(1)(c) is what? A registered person migrated from composition scheme to normal scheme. Now opposite, normal scheme to composition scheme, means he is going into composition scheme. As he is going into composition scheme, he cannot enjoy the ITC. So he need to reverse the ITC. Then registered person, exempted supplies became taxable. Okay, now taxable supplies becomes exempted. So as the taxable supply become exempted, he need to reverse the ITC on closing stock. So what are the two situations that we have seen? Normal scheme to composition scheme, taxable supplies to exempted supplies, or cancellation of registration, third case. So reversal of ITC on closing stock in three situations. What are the three situations? Normal scheme to composition scheme, taxable supplies to exempted supplies, cancellation of registration. Say on 1/4, so this happened. Now you take the closing stock as on before date. What is it before date? 31st March. As on 31st March, what is the closing stock? Input as such held in stock, input in the form of WIP, inputs in the form of FG. These three inputs, whatever ITC we have already availed, that we need to reverse. ITC availed equals to ITC reversed. Whereas capital goods also we need to reverse. How much we need to reverse for capital goods? ITC availed divided by 60 into balance life. So here we follow a different way. So it is not minus 5% for every quarter or part thereof. So far everywhere it is minus 5% for every quarter or part thereof. In this place alone, what we will do? Total ITC divided by 60 into balance life. So that's what we will do as ITC reversal. Now sir, I have one doubt. While availing the ITC on closing stock, you told that the closing stock including capital goods should have been purchased within 1 year prior. While reversing the ITC on closing stock, that 1 year time limit is not applicable. No, not applicable. Even if 3 years before you buy also you reverse. You understood? Because availing ITC is lost to government. So time limit, reversal of ITC is gain to the government. So therefore no time limit. Even 3 years, 4 years before if you have purchased also, you can happily do the reversal. Okay. Then inputs and capital goods can be purchased any time on which ITC is availed. If ITC not availed on such inputs or capital goods, reversal shall not arise. Suppose if capital goods is purchased before 5 years, then it will become 0. Why it will become 0? ITC availed divided by 60 months, 5 years over, into balance life 0. Anything multiplied by 0 is 0. So we don't have to do any reversal. If capital goods are purchased before 5 years on which ITC is availed, then reversal shall not arise. Now, sir, matching required or not required? Not required. Reversing, na? Why matching? Availing only matching. You understood? Reversal, gain to the government, no matching. Matching not required. But then, what if invoice is not there? Don't worry. Today, you will have a market value for these goods. You take that market value and do the reversal. And as you are taking market value, get a certificate from a CAR/CMA. Okay. If invoice pertaining to such capital inputs are not available, then market value can be considered, and a practicing CAR/CMA certificate is required in that case. And all these details of reversal will be reported in ITC 3. ITC 1, availment of ITC on closing stock. ITC 2, transfer of ITC. ITC 2A, transfer of ITC from single registration to multiple registration. ITC 3, reversal of ITC on closing stock. ITC 1, when CA/CMA certification, ITC amount exceeds 2 lakhs. ITC 2, always CA/CMA certification. ITC 2A, not at all required. ITC 3, CA/CMA certification if market value is replaced with invoice value. Then, suppose if there is any balance in ITC after reversal, sir, what will happen with respect to the balance? Balance will be lapsed. And suppose if there is any shortfall, then we need to pay that shortfall. For example, so what is the ITC? Say this, case A, case B, the balance in ITC before reversal. Balance in ITC before reversal. Before reversal, case A 2 lakhs, case B 1 lakh. Then reversal of ITC on closing stock. Reversal of ITC on closing stock is 1,25,000. Now what will happen? So here 1,25,000 we will adjust with 25,000 and balance in ITC 75,000, here 0. This 75,000 will be lapsed. That will be lapsed. And what is the GST payable? Whether we need to pay any GST? Yes. Here 25,000 we need to pay. Why 25,000 we need to pay? How much was the balance? 1 lakh. How much we need to reverse? 1,25,000. This 1,25,000 we will adjust from 1 lakh. So remaining 25,000 we need to pay. Whereas in this case 2 lakhs and 1,25,000 you will adjust. Remaining 75,000 will be lapsed. Anyhow it will be lapsed now, sir, then why we need to do reversal? Mainly to know whether GST is payable or the ITC will be lapsed. For that reason only we need to do this computation. And this computation should be done separately for CGST, SGST, UTGST and IGST. Then this 18 subsection 6 already I told you. Remember, when 18 subsection 6 will be applicable, I am purchasing some capital goods. At the time of purchase of capital goods, I have availed the ITC and that capital goods is being disposed of. So in that case, the GST payable will be ITC availed minus 5% for every quarter or part thereof from the date of invoice till the date of supply, or compare it with what? GST on sale value of that capital goods. Whichever is lower should be taken or whichever is higher should be taken. Whichever is higher. But we have an exception to this. In case of refractory bricks, molds and dies, jigs and fixtures, 3 goods you remember, refractory bricks, molds and dies, jigs and fixtures. If it is sold as scrap, then in such case GST is payable on normal sale value. So means ARB whichever is higher not applicable, just the B point only will be applicable. Then next section 19 talks about job work provisions. So section 19 should be read with section 143 of CGST Act. What does it says? So I am sending the inputs or capital goods for the job work, and at the time when the inputs or capital goods are sent for the job work, I don't have to reverse any ITC on that. Normally I can send. But from the job worker's place, the inputs are capital goods, the processed goods or the capital goods should be brought back. What is the time limit within which it should be brought back? Processed goods should be brought back within 1 year and capital goods should be brought back within 3 years. This 1 year can be extended for a further period of 1 year, and the capital goods can be extended, 3 years can be extended for a further period of 2 years. Remember, 1 plus 1 year, 3 plus 2 years. So processed goods should be brought back within 1 year and capital goods should be brought back within 3 years. And capital goods or inputs, first we will see inputs. Inputs to be received within 1 year, which is sent directly from the principal's place of business, and if it is not received within the time, it will be deemed as supply on the date of receipt by the job worker. For example, I am sending the goods to the job worker. You are the job worker. I should have got the goods back from your place within 1 year. You did not send me. Then on expiry of 1 year, it will be deemed as supply in my hands. So means 1 year back itself it was supply. Now I will come to know that it is supply. Now I have to pay GST. So logically I need to pay even GST. For example, 1/4/2023, I sent you inputs here and you should send me the processed goods by what time? 31st March 2024. You have not sent. As you have not sent, so 1 year time limit is over. Further it can be extended for a further period of 1 year by the commissioner. Commission is not giving extension. Now it will be treated as sale in my hands. On which date? On which date it is treated as sale in my hands? 1/4/2023, 1 year backwards. And I have to pay GST now. Now means which date I am in? 1/4/2024. You got it? And I have to pay GST pertaining to which month? 1 year before. Means I have to pay interest for last 1 year. That is the additional burden that I will be having. You got it? And this GST I will recover from you. Got it? Because of your mistake only now I have paid. So I will recover it from you. Now what happens? You have returned the goods to me after this 1 year. Now in that case, whatever ITC that I have, whatever GST that I have paid, I will reavail as ITC. No. It will be treated as new sale made by the job worker to the principal. You got it? So Section 143 basically puts the time limit. What is the time limit? The goods should have been brought back to the principal's place within 1 year plus 1 year in case of processed goods, and capital goods should be 3 years plus 2 years. If 143 breached, then what will happen? Section 19 will come into picture, that is deemed fiction. What is a deemed fiction? It will be deemed as supply. On which date it will be deemed as supply? On the date of dispatch to the job worker. Okay. Now see this. ITC not required to be reversed by principal when goods are sent on job work, and such goods should be sent under the cover of a delivery challan and e-way bill. Yes, because goods sent on job work is not a supply at the time when we are sending it for job work. So as it is not a supply, the document that is required is delivery challan, and e-way bill always required in case of goods sent on job work. Even if goods are directly received by job worker, ITC can be availed by principal. How ITC can be availed by principal? Bill to ship to transactions. When the goods are received by the job worker, the invoice will be raised to the principal. The day on which job worker has received the goods, it is deemed that the principal has received the goods, and the principal can take ITC with respect to that. And see these additional points. Job worker can avail ITC with respect to inputs or input services used for job work. So job worker also will do some process na, so he can take ITC on that. If the processed goods or capital goods are returned by the job worker after 1 year or 3 years, then it will be treated as new supply by the job worker and chargeable to GST, and as you pay GST you can recover that from me and I can take ITC with respect to that. The period of 1 year in case of processed goods and 3 years for capital goods on sufficient cost being shown be extended by the commissioner for a further period not exceeding 1 year or 2 years respectively. And what if job worker is not registered? There is one condition here. If the job worker is not registered, the principal should show job worker's place as the principal's additional place of business. That is one point. If job worker is not registered, principal should declare job worker's place as principal's additional place of business, and jurisdictional commissioner should be intimated about the job work contract, and processed goods may be brought back to principal's place, or it can be sold or exported from the job worker's place directly. And every principal who is sending the goods on job work and receiving it from the job work, they need to file one form. What is that? ITC 4. ITC 4. This ITC 4 will be filed on a yearly basis if the aggregate turnover of the principal during previous year does not exceed 5 crores. 5 crores. It does not exceed 5 crores annually. By when? 25th April. So financial year get over by 31st, na? So 25th of April. Suppose if the aggregate turnover exceeds 5 crores, then it will be 2 times, half yearly. Half yearly by 25th of the month following every half year. So first half year is what? April to September by 25th October, and the second half year is what? October to March by 25th of April. So this is about section 19 read with section 143. Okay, and we have this input service distributor. So we'll take a break, and then we will complete this. Okay. Okay, we'll start. So there is one query, 10cc bikes ITC available. Yes, actually ITC available for 10cc bikes, because 10cc bikes will not come under motor vehicles, and as it is not motor vehicles, we don't have any blocked credit. So which means it will be like used in the course or furtherance of business, and ITC is available. So that is about that. Then next, Input Service Distributor, section 20 and section 21 of CGST Act. Basically input service distributor is like a head office. That head office will receive the services and distribute the credit with respect to these services to the branches which are having the same permanent account number as that of the head office. So basically head office will receive the tax invoices with respect to input service. Remember, only input service, inputs and capital goods credit cannot be distributed this way, only input services. And this ISD, input service distributor, distribute the credit to its branches having the same permanent account number, and this ISD is required to get a separate registration, even though that company is already having, that is each and every branch is having a separate registration. Even then for ISD they need to get a separate registration and distribute the ITC. And here there is one important condition. ISD is say in Tamil Nadu, ISD is in Tamil Nadu and the branch is also in Tamil Nadu. Then CGST credit will be distributed as CGST, SGST as SGST, IGST as IGST. Whereas with respect to registrations in other states, say branch 1, this is branch 1 and this is branch 2 and this is branch 3. Now with respect to branch 2 and 3, so 3 is in Andhra Pradesh. With respect to branch 1, CGST will be distributed as CGST, SGST as SGST, IGST as IGST. With respect to branch 2, CGST, SGST as well as IGST, everything will be distributed as IGST only. Okay. So the ISD which is in Tamil Nadu, with respect to branch 2 and branch 3, with respect to these two branches, CGST or SGST or IGST distributed as what? IGST, distributed as IGST. Whereas to branch 1, CGST or SGST or IGST distributed as CGST, SGST or IGST accordingly. So that is what I have given below. CGST and SGST distribute as CGST, SGST for the unit in the same state of ISD. So ISD is in Tamil Nadu, whereas branch 1 is also in Tamil Nadu. So credit will be distributed in the same manner, same name, and distributed as IGST if the unit is in the different state than that of ISD. So suppose if the unit is in different state than that of ISD, then everything will be distributed as IGST only. Then suppose if the service is attributable only to one branch, entire credit will be distributed to that branch only. If the service is attributable to more than one branch, it will be distributed to those 2 branches or 3 branches in the ratio of its turnover. So input service attributable to one unit, entirely distributed to that unit. Input service attributable to 2 or more units, such 2 or more units we will distribute the ITC in what ratio? Turnover ratio. Suppose if the input service is attributable to all units, ITC will be distributed to all units which are operational based on the turnover ratio. Now turnover, whether we need to take current year or previous year turnover, we need to take previous year turnover or the last quarter based on the availability. Then how this should be distributed? The ITC should be distributed on a monthly basis, not on a quarterly basis. And for distribution of this ITC, one return needs to be filed, that is GSTR 6 by 13th of the month following every month. And excess distributed ITC can be recovered by issuing a ISD credit note. For example, this ISD has distributed to branch 1 some excess ITC, and to branch 2 and branch 3 there is a shortfall. Now what they can do, excess they distributed na, to reduce that excess distribution. So this ISD can give a credit note to branch 1. That's what they are telling. Excess distributed ITC can be recovered by issuing ISD credit note. Now for branch 2 and branch 3 there is a shortfall. For distributing that shortfall, they can give a ISD invoice. And distributed credit should not exceed the credit available for distribution. Suppose if the ITC available with ISD is 5 lakhs, then while distributing it to these 3, the total should not be more than 5 lakhs, means excess credit should not be distributed. If the ISD has distributed excess credit to any one recipient, the excess can be recovered from the recipient with interest. For example, they should distribute 3 lakhs, 3 lakhs and 3 lakhs to these 3 units. But instead what they did, they distributed 4 lakhs, 2.5 and 2.5 to 2 branches. Instead of 3, 3, 3, they distributed 4, 2.5 and 2.5. Now to which unit they have distributed excess? Branch 1 they distribute excess na. From branch 1 the recovery of 1 lakh will be made. So if the ISD has distributed excess credit to any recipient, the excess can be recovered from the recipient with interest. And every ISD should get a compulsory registration irrespective of their aggregate turnover. Then, so we will come across turnover in 3 places. One is Rule 42, common ITC used for both taxable and exempted proportionate ITC available. Then Rule 43, Rule 43 also same, total ITC divided by 60 into exempted turnover by total turnover. Again input service distributor also we come across turnover ratio. Wherever we take the turnover ratio, in the turnover we need to exclude old indirect taxes. What are they? Excise duty, central sales tax and value added tax should be excluded. Also value of supply of duty credit scrips should be excluded, okay, which means duty credit scrips, even though it is exempted, but it will be excluded from the exempted turnover na, it should be treated as taxable turnover. But this point already I gave there. So you remember only one point. What is that one point you should remember? Old indirect taxes should be excluded. Generally these old indirect taxes will form part of turnover value under 15(2)(a), which says all taxes, duties and cess by whatever name called other than GST should be included in the turnover. Because of that reason, so this should be added generally as per 15(2)(a), but this is an exception. While determining turnover in 3 places, what are the 3 places? Rule 42, Rule 43 and Rule 40 like section 20. In these 3 places, so turnover excludes old indirect taxes. Then next one, we have a circular on replacement of parts during warranty. So these are some additional circulars which are basically amendments for May 24 exam. So please concentrate, carefully listen. So this circular is basically about purchased goods which are used in replacement during warranty period. So here warranty can be given by the supplier. So whenever there is a like standard warranty or additional warranty, so during that warranty period if there is any manufacturing defects or etc., so freely the part will be replaced by the supplier. So this is that background. So here issue number 1, Sleek is a modular kitchen supplier. So they have done the interior decoration to Mr. X, who is a customer, for which the customer pays a consideration of 8 lakhs plus GST 18%. This is a normal contract, interior decoration contract. Under this contract, if there is any part which is used in the modular kitchen is damaged, so that will be replaced by this company for a period, usually 6 months or 1 year or 2 years. That will be a warranty period. In that warranty period, they will replace the parts. And now what happened is that Mr. X asked Sleek to replace a part during warranty period, and Sleek will purchase that part for replacement. So parts purchased by Sleek for replacement to customer during warranty period, and the value of that part is 50,000 and GST is 6,000. Now they have replaced that part during warranty period and they did not charge any amount for that. Who did not charge any amount for that? The Sleek supplier did not charge any amount for that. Now the question here is, On this 6,000, can ITC be taken or cannot be taken? First, anywhere we have blocked credits related to this. Goods used in warranty period, so ITC is blocked, like that anywhere we learn? No. And is it used in the course or furtherance of business? Yes. So as a business practice, they have to give this assurance to the recipient, then only the recipient will undertake, like receive the services from the supplier. So therefore, as a part of this business only, they do the replacement during warranty period. Means logically, they can take ITC, we don't have any restriction. You got it? So reversal of ITC by manufacturer shall not arise, even if such replacement of part is without any consideration. So yes, they can enjoy this ITC of 6,000 rupees. Now, sometimes they charge a nominal amount rather than giving it for free absolutely. So they will charge a nominal amount like 10% or 20% depreciation value, like that they will charge. See, you used for 3 months. Now I am replacing a part new. Then for the 3 months you used now. So for that reason, I will charge some money from you, 10% or 25%, like that I will charge. Now in that case also, is there any restriction with respect to ITC? No, whether you charge or you do not charge, that is irrelevant. And you are using the goods for replacement during warranty period, so happily you can take the ITC. If any consideration is charged with respect to such replacement, then it is supply under 71A. Which is supply under 71A? That money collected, the 10% or 25%. And GST payable on such consideration, but reversal of ITC shall not arise. So what is one point that you need to remember based on this example? If I am purchasing any goods and used it as replacement during warranty period, for that replacement, whether I charge any consideration or not charge any consideration, I can take ITC on the goods purchased. Clear? Then second issue. Issue number 2, you see. So there is a car manufacturer. Toyota is a car manufacturer. Lance and Toyota is a dealer, and they are making sale of car including warranty for 3 years to Mr. X, a buyer. So car manufacturer will sell the car to the dealer, and dealer will sell the car including warranty to the buyer. Now in this background, what happened is that, so dealer has paid 12 lakhs plus GST to the manufacturer, and they collected 15 lakhs plus GST from the buyer. Why they are getting 3 lakhs? That is their profit margin. Dealer's margin 3 lakhs. Now dealer will provide the service, free after sale service. In this free after sale service, dealer will do service plus even change the part during the warranty. Got it? Now this services plus part, whether the dealer is really doing it for free or he will get the money, he will definitely get money. From whom he will get the money? Not from the buyer, he will get money from the manufacturer. Dealer will get the money from the manufacturer. So Lance and dealer provided free after sale service of 3,000 and replacement of parts 2,000. This is the background. Okay. Now in this case, we need to understand certain things. First, dealer is procuring the parts for replacement from the third party. Means this replacement of part 2,000 is there na. The dealer did not get from the manufacturer, but he purchased it from the market, and he used it for free replacement during warranty period and charged consideration from the manufacturer. Now you please step into the dealer's shoes. As a dealer, what is that you are doing? First, you are buying the part from the market for replacement. Can you take ITC on the part purchased? Yes or no? From dealer point of view, you please interpret. Yes or no? Yes. That already we discussed in the previous point. What is that? If any goods are purchased for replacement during warranty period, whether we charge or we do not charge, we can take ITC on the part purchased. Correct? So on this part of 2,000 rupees, whatever GST is paid, as a dealer you can take ITC on that. Done. Second point. Now you are incurring 5,000 rupees. What you will do? 5,000 rupees you will incur out of your pocket, or you will charge it to manufacturer? You will charge it to manufacturer. On that, will you pay GST also? Yes. And in turn you will recover it from the manufacturer. You got it? So see the dealer's perspective. First, invoice for recovery of cost from manufacturer, 3,000 after sale service, replacement of part 2,000, total 5,000, GST 18%, so 5,900. Now dealer will pay this 900 rupees to government. Then on parts purchase, 2,000 into 18%, 360, ITC is available to the dealer. And whether any reversal of ITC? No. Even though you are doing it for free or you are charging, you can enjoy the ITC of this 360. No reversal of ITC required by the dealer in case of replacement of parts. This is from the dealer's perspective. Now, from the manufacturer point of view, we will see. So, as a manufacturer, now step into the shoes of a manufacturer. Now, what you are doing? You are paying 5,900 rupees to the dealer, correct? Now, can that 900 rupees be taken as ITC by you? Yes, because dealer will raise invoice to you and you can take ITC with respect to that 900. That is simple. Manufacturer shall pay 5,900 to the dealer and ITC of 900 can be claimed by the manufacturer. So, you tell me, this is example. From this example, you should remember the provision. I have not given the provision directly because if you read the provision directly, nothing you will understand. That's why through numbers I am making you understand. So now tell me, what is the treatment when the part is procured from the third party? As a dealer, dealer will recover the charges from the manufacturer and GST will be payable on those charges recovered, and on the parts procured ITC can be availed. And as a manufacturer, manufacturer will pay the charges to the dealer and on the charges GST ITC can be availed by manufacturer. Then second situation. Same scenario. Question is same. Scenario 2, situation 2. What happens in situation 2? If replacement of parts are received by dealer from the manufacturer. So means what happens here? That part dealer is not procuring. Dealer is not procuring that part. That part dealer got it for free from the manufacturer. Okay. And the dealer has used it in the buyer, which means as a dealer, how much you will recover from the manufacturer? 3,000 or 5,000? 3,000. Why you will recover only 3,000? Because part you got it for free from the car manufacturer. So to the car manufacturer, you raise a bill for 3,000 plus applicable GST and you will pay the GST. As you did not procure the part, so the question of ITC does not arise. So see that as a dealer, you will raise invoice to the manufacturer 3,000 rupees after sale service, GST 540 and invoice value 3,540 and you will pay 540 rupees to government. Now you tell me as a manufacturer what you will do. So as you procure the part freely, you have given to the dealer, but you would have procured the part as a manufacturer. On that part procured, so you can take ITC, yes, because you are using that part for what purpose? Free replacement during warranty period. As a manufacturer, you can enjoy the ITC on that part procured, and even dealer will raise invoice to you for that 3,000 rupees plus GST. That 540 rupees can be taken as ITC. So see that manufacturer shall pay 3,540 to the dealer and ITC of 540 can be claimed by the manufacturer with respect to after sale service. Then 2,000 into 18%, sorry, you just change this to 360. 2,000 into 18%, that is 360 rupees. What is this 360 rupees? GST paid on the part purchase. GST paid on the part purchase, so can be taken as ITC. And any reversal of ITC required by the manufacturer? No, not required. Now you tell me what is the treatment of this as a provision? What is this situation? So parts are procured by the manufacturer and given it for free to the dealer. In that case, can the ITC be enjoyed by the manufacturer? Yes. And whenever dealer raises the invoice for free after sale service, on the GST paid can be taken as ITC by the manufacturer. Dealer will simply pay GST on whatever money that he has recovered from the manufacturer, and dealer will not purchase the part. So the question of ITC does not arise. Now, third situation. Listen, what happens in this third situation is that 100 numbers of spare part is supplied by the manufacturer to the dealer at 2,000 rupees, excluding GST at 18%. So these parts are for sale. Basically, these parts are for sale. Manufacturer will send it to the dealer for sale parts, but the dealer out of this 100, one part he has taken and used it for replacement during warranty period, which means dealer is required to pay to manufacturer for 100 parts or 99 parts, only 99 parts. Why 99 parts? Again I am replying, again I am discussing this, concentrate. I am a manufacturer, you are my dealer, I am sending you 100 parts, I will raise invoice for 100 parts to you, but you will pay me for 100 parts or 99 parts, only 99 parts. Why not 100 parts? Because one part you are using it for replacement during warranty period, and for which you are not required to pay me money, correct or not? Which means first I will raise as a manufacturer to you invoice for 100 parts. Thereafter I will give you credit note for one part because you are not required to pay money for that. You got it? Now, as a dealer, first you procured 100 parts and you availed the ITC, and as you got the credit note, you need to reverse the ITC. Got it? This is related to that parts. Over, job done. Now, how much you will charge to the manufacturer for after sale service? 3,000. So, into 540 rupees, that I will take as ITC. Okay. So, say this. First, from the dealer point of view, situation 3, 100 numbers of spare parts supplied by manufacturer to dealer at 2,000 excluding GST. Out of that, one spare part is used as replacement during warranty period. So, the dealer will pay 2,36,000 to manufacturer first. Why? Because manufacturer will raise invoice for 100 into 2000, 2 lakhs, and GST 18%, 2,36,000. And in that 2,36,000, ITC dealer will take 36,000. Now, one credit note will be given to the dealer. So, ITC must be reversed by dealer based on credit note. So, if 100 parts GST is 36,000, for one part it is how much? 360, that 360 needs to be reversed. Then, as a dealer, you will raise invoice to the manufacturer for 3,540 and you will pay GST of 540. This is the job in the hands of dealer. Now, in the hands of manufacturer, what will happen? Manufacturer will first raise invoice for 100 parts now, 2 lakhs plus 36,000, and one credit note will be given for reducing that, and dealer will raise invoice for 3,540 to manufacturer, and 540 can be taken as ITC by the dealer. Okay. Actually, this is given in pure English. In the circular, they have given a circular related to this, and in that circular, they have given fully about this, in English, which we cannot read and comprehend. Even in exam also, they will not test whatever you learnt in circular, you write like that, they will not ask a question. So, they will convert it into numbers like this. So, that is why this will be useful. So, just literally like this only they can ask questions on this. Then next, another issue. Issue number 3. This is related to, usually warranty, we pay additional amount for warranty. If you pay that additional amount for the warranty at the time of purchase of the product itself, what is the GST rate applicable for this additional warranty? At the time of purchase of the product itself, you pay for warranty. Whatever is the GST rate applicable to the product, that should be taken for additional warranty also. Suppose if you buy the additional warranty separately, not at the time of purchase of the product, then for the warranty, the general rate 18% will be applicable. For example, iPhone 15 Pro Max 1,59,900, say rate of GST 28%. And coverage is there. Usually extra money you have to pay for the coverage, Apple Plus coverage, 15,000 inclusive of GST. Now, this 15,000 is taxable at what rate of GST? Now, if the coverage is taken at the time of purchase of iPhone, this 15,000 will be taxable at 28%. If the coverage is taken at a later point of time, then this 15,000 will be taxable at what rate? 18%, because it will be treated as a separate contract. Then another circular is related to cross charge. So, it is not gross charge, it is cross charge. In this alphabet, it is cross charge, it is not gross charge, cross charge. So, what is this cross charge means? Cross charge means one office will raise invoice to the another office. It can be head office or branch office. So, ISD opposite is cross charge. So, either we can distribute the credit based on ISD concept, or we can also follow the cross charge. It is like head office. Head office is there, and below the head office we have branch office 1, branch office 2, and branch office 3, and there is a supplier, and this supplier will raise invoice to the head office, and the head office will avail ITC, and this ITC will be distributed to all the 3 branches. So this is the concept of input service distributor. Okay. Now here, what is the disadvantage in this ASD? They should distribute it in turnover ratio, correct? Distribute in turnover ratio. Now I don't want to follow this. Instead, I want to make it simple. That is, the supplier will raise invoice to branch office 1, and the branch office 1 will raise invoice to branch office 2, branch office 2 will raise invoice to branch office 3, or branch office 1 will raise invoice to branch office 3. So I just wanted to structure it that way. So branch office 1, branch office 2, branch office 3. Now I want to eliminate this concept of ISD. So the supplier will raise invoice to branch office 1. Now branch office 1 will take ITC availed, full ITC. Now branch office 1 will raise invoice to branch office 2 and branch office 3. Invoice they will raise. You got it? And this concept is known as cross charge. This is known as cross charge, whereas this is known as input service distributor. Okay. So, but both cases the objective is achieved. All the 3 branches are taking the ITC. Now based on this invoices, so here branch office 2 will take ITC availed, and even branch office 3 will avail the ITC. You understood? Whereas in ISD also the objective is same, all the 3 branches, so distribution of ITC, so 3 branches will also take the ITC. Now should I follow ISD or cross charge? Circular says anything you follow, either you follow ISD or you follow cross charge, but ensure that in cross charge this service is not attributable to only one division. The service is really attributable to other divisions also, then you do this. But what is the advantage we can achieve in this cross charge? Turnover ratio we don't have to follow, got it? Turnover ratio need not be followed. Okay. Now this particular circular will be applicable only for May 24 exams. Reason being, they gave Finance Bill 2024. As per the Finance Bill 2024, they are telling that this cross charge should not be followed, ISD only should be followed. Previously ISD only should be followed. Circular gave either cross charge or ISD you follow. Again Finance Act 2024, they are telling follow ISD only. Okay. So then Parchimoto Gordon Lyrical. So therefore why they change that I don't know, but this circular is applicable only for your exam. Okay. What is that? Either ISD or cross charge can be followed by head office for distribution of credit to branch office. In case of cross charge, normal invoice is raised by head office to branch office. Turnover ratio need not be followed, but those services should be attributable to branch office. Okay. And even in case of cross charge, separate registration not required. That head office, one separate registration we used to get, that is also not required. That all those things are only for ISD, not for cross charge. Then now one more point they have given in the circular related to internally generated services. See, with respect to services procured from the third party, either they can follow ISD or they can follow cross charge, no doubt. But with respect to internally generated services, what is this internally generated services means? Branch office HR branch office HR function is taken over by the head office. Means head office or corporate office is only looking after the HR of all the branches, because HR they will make centralized, they will not do separately. HR, finance, marketing and sales, these things and all, they will make it like a common, they will not give it separately for each and every branch. If that is the case, then good, one chartered accountant can be appointed for one branch. So, but usually finance and all, they will concentrate only in the centralized location. Now, in that case, what happens is that head office will incur the expenses even for the branch office also, and will raise a debit note for recovery of the expenses, common expenses. This only we call as apportionment of overheads. Common overheads we will apportion between the divisions. So, head office will incur the common services, they will incur the expenditure. And how they will recover the expenditure? By raising the debit notes to the branches, they will recover the expenses. Now, what is the treatment of that recovery of expenses? This is not procured from the third party, this is internally generated. What is the treatment of that? Services provided by head office to branch office, not procured from the third party, internally generated. Now, this will come under transaction between distinct persons. In case of transaction between distinct person, head office is one distinct person, branch office is one distinct person, and the value needs to be determined under Rule 28. We have Rule 28 of valuation rules, which says that you take either open market value or like kind and quality or cost plus 10%. If the recipient is eligible for full ITC, the open market value is nothing but the transaction value. Okay. Now see that. Is branch office eligible for full ITC or branch office not eligible for full ITC? If branch office is eligible for full ITC, whether amount recovered or not from the branch office by head office, value under Rule 28 is nothing but invoice value. Why? Open market value deemed to be transaction value. You can write that. Open market value deemed to be transaction value. Because of that reason, even value can be taken as nil also, no issue. Suppose if branch office is not eligible for full ITC, then we need to determine the open market value. Amount recovered from branch office by head office, open market value should be taken. What if open market value not available? Like kind and quality or cost plus 10%, that will come. What if amount not recovered from branch office? Even then open market value should be taken. But this is exception to Rule 28. What does they are telling? No value of taxable supply. So this is exception to Rule 28. Actually Rule 28 says whether consideration is there or not. Sir, if the amount is recovered, it will become supply under section 71A. If the amount is not recovered, it will become supply under section 71C. Whether it is supply under 71A or 71C, transaction between distinct person, the value will be as per Rule 28. As per Rule 28, if the value is open market value, only should be taken. But in this case, when the amount is not recovered from the branch office by head office, the CBIC circular says that you don't have to take any value. Okay. So value will be taken as 0 and no need to pay GST. This is an exception which they have created in the circular. Okay. So these are the amendments that we have in input tax credit. With that we have completed ITC. So we will see the next area, that is value of supply. So please take value of supply. What's the page number? Page number 71. So value of supply, we don't have any amendments. It is the same old story, and except for in Rule 28, one corporate guarantee provision they have changed, otherwise everything will be same. So section 15 deals with the value of supply. What does section 15 say? Section 15 subsection 1 says value of supply is nothing but the transaction value. What is transaction value? Price actually paid or payable. and this transaction value will be taken as value or assessable value provided two conditions are satisfied. Condition number 1, price must be the sole consideration, supplier and recipient are not related. Both these conditions should be satisfied. If any one condition is not satisfied, transaction value not applicable and we need to determine the value as per rules. And for this transaction value, we have some inclusions as per 15 subsection 2. What does it says? So first, supplier will supply the goods or services to the recipient, for which recipient will pay some money. That amount which is paid by the recipient will be taken as transaction value. 15(2)(a), total 5 inclusions we have. The first inclusion is taxes, duties and cess by whatever name call other than GST. So that is, any tax other than GST, if charged by the supplier to the recipient, it should be included in the value. For example, so entertainment tax which is collected by the cinema theatre from the audience. So price of the ticket say 190 rupees, entertainment tax somewhere like 30 rupees. So now while computing the GST, whether entertainment tax should be added or not, yes, we need to add. Same way, at the time of import of goods, we need to compute the customs duty. While computing the customs duty and IGST, so IGST should be computed even on customs duty component also, yes. So a value of goods imported plus customs duty, on that IGST should be computed, which means that for computation of GST, all taxes, duties and cess by whatever name call other than GST should be included in the value. That is this, any tax other than GST should be included in value. Then 15(2)(b), recipient is incurring some expenditure on behalf of the supplier, that expenditure should be included in the value. This is like, say, supplier is liable to pay some money. For example, I am a finished goods manufacturer and I have procured some raw material for 4,000 rupees. Now I need to pay that 4,000, but I asked you to pay the 4,000 and pay 6,000 rupees to me. So 6,000 rupees will be transaction value plus 4,000 which you paid to my raw material supplier on behalf of me is like any amount that the supplier is liable to pay but incurred by the recipient should be added to the value. So that 4,000 should be added. So the value will be taken as 10,000 rupees. That is about 15(2)(b). What if recipient is incurring the expenditure on his own account? Will that expenditure be included in the value? No, it will not be included in the value because it is expenditure incurred by recipient on his own account. Example, transportation charges. The sale is a ex-showroom sale. Ex-showroom sale means my sale is completed the moment I hand over the product in my showroom. Thereafter, you should only incur the transportation cost. Now you incur the transportation cost. Will it be included in the value? No, because expenditure incurred by the recipient on his own account, that will not be included in the value. Then 15(2)(c) says, if supplier is incurring any expenditure and recovers from the recipient, then it should be included in the value. But here we need to check, is that expenditure incurred by supplier and recovered from recipient as a pure agent of the recipient? If it is supplier acting as a pure agent, don't include that expenditure in the value. So we need to check whether it is as a pure agent on behalf of recipient, such expenditure shall be excluded from the value. When supplier will act as a pure agent of the recipient, firstly, it should be the liability of the recipient, which is incurred by the supplier, and supplier should satisfy certain conditions. What are those conditions? Number 1, there should be a written agreement between the supplier and the recipient, where supplier is acting as a pure agent, recipient should authorize the supplier to act as a pure agent to incur the expenditure. So first condition, contract. You can see in the next page, conditions for pure agent. Supplier should enter into an agreement with the recipient, and supplier should recover only the actual amount incurred. Means supplier should not make profit out of the transaction. Supplier should not hold the title of the goods or services so procured. Means the invoice should not be in the name of the supplier, the invoice should be in the name of the recipient. And supplier should not use the said goods or services so procured for his personal purpose. Now, example, there is a chartered accountant who is doing the income tax filing of a client, and the chartered accountant incurred the income tax liability of the client and recovered the filing fees as well as income tax paid on behalf of client. Now, in this case, whether pure agent point will be applicable or not, definitely it will be applicable. Firstly, income tax liability is the liability of the client, that is recipient. Who incurred it? Supplier has incurred. Now, check the condition number 1, whether the recipient is authorizing the supplier to incur that expenditure. Yes. Number 2, whatever is the actual expenditure of income tax, that much only is recovered. And the income tax receipt definitely will not be in the name of chartered accountant, but it will be in the name of client. And it is not the chartered accountant's income tax liability he recovered. So therefore, it is not used for the personal purpose of the supplier. Due to that reason, supplier acts as a pure agent. And in this case, filing fees 10,000, income tax 5,000, 15,000 recovered, but GST payable only on 10,000. That 5,000 income tax liability, which is of recipient, supplier incurred as a pure agent, and it will be excluded from the value. Got it? So, when you need to apply pure agent concept, first you need to check, is that expenditure the liability of the recipient? Number 2, incurred by the supplier. Number 3, supplier is acting as a pure agent. Okay. So, when the supplier is acting as a pure agent, for the third point, 4 conditions. So, when the supplier is acting as a pure agent, first, agreement, through an agreement, recipient should authorize the supplier. Second, the title should not be in the name of the supplier. Number 3, only the actual amount should be recovered, and it should not be used for the personal purpose of the supplier. Then, suppose if it is not a pure agent, it will be in the course of supply, and that expenditure should be included. For example, door delivery contract. In door delivery contract, what will happen? Supplier will undertake to deliver the product to the recipient's location. Now, supplier will incur the transportation cost. This transportation cost should be included in the value or not? Yes. Expenditure incurred by the supplier and charge it to recipient other than as a pure agent. So, that should be included in the value. That is about 15.2c. 15.2a, first, value equals to transaction value if 2 conditions are satisfied. Supplier and recipient are not related and price must be the sole consideration. 5 inclusions. In that 3 inclusions we have seen. 15.2a, any taxes, duties and cess by whatever name called other than GST, and first one is recipient incurring expenditure. Recipient incurs expenditure on behalf of supplier, that should be included in the value. The next one is supplier incurring the expenditure and charge it to recipient. Divide into 2. Pure agent, it will not be included. Otherwise, as a pure agent, it will be included in the value. Then 15.2d talks about interest, late fee or penalty for delay in receipt of consideration. That is, whenever supplier has to get the money from the recipient, but the recipient has not made the payment on time, because of which supplier will be collecting some interest from the recipient. This interest is known as interest on account of delay in receipt of consideration. That should be included in the value and chargeable to GST. So basically, interest will come in 2 places in GST. One is interest on loans, advances, deposits, which is exempted, no need to pay GST. Whereas interest on account of delay in receipt of consideration, it should be included in the value and chargeable to tax accordingly. Include in the value means, so if the invoice is taxable, this interest also taxable. If invoice value is exempted, this interest also exempted. Means this interest is not treated as a separate activity. This interest will derive the character of the invoice for which this interest is collected. Okay. Then, that is with respect to this 15.2d. Then 15.2e is about subsidy. Subsidy is basically an amount which will be collected from one person, and this subsidy is not arising out of any contract. It is like a grant which is given by one person to the another person, and these grants may be with certain objectives or it may be out of gratitude. Anyway, it can be given. So, subsidy basically divided into 2. Is it directly linked to price or not directly linked to the price? What is the meaning of not directly linked to the price? Means subsidy is no way connected to the outward supply. Whereas if the subsidy is connected to the outward supply, it is called as directly linked to the price. If I am selling a electric motor vehicle, so I will get a subsidy from central government 10,000 rupees per 2-wheeler sold. So this 10,000 rupees per 2-wheeler sold is directly linked to the outward supply, correct? Directly linked to the price. For every 2-wheeler sold, I am getting 10,000 rupees. Means it is directly linked to price. Recently also, if you are installing a panel, that is the solar panel, you will get a subsidy from the government. Is it related to your outward supply? No. It is general subsidy. For installation of a solar panel, they are giving this. This is not linked to outward supply. Means it is not directly linked to the price. So, directly linked to the price means subsidy based on outward supply. Not directly linked to the price means subsidy irrespective of the outward supply. If the subsidy is general subsidy, example, to set up a power plant or to set up a green energy plant, to set up a solar plant, you are receiving some money. So this money received will be called as general subsidy. That general subsidy should be ignored. It should not be considered for valuation purpose. Ignored and not considered in value, you treat it like a donations. Whereas directly linked to the price, that is subsidy based on outward supply. So is it from central government or state government, or is it from others? If it is from central government or state government, to be excluded from the value. Suppose if it is from others, to be included in the value. Now, how we need to understand this particular implication? Now, say for example, the price, there is a coaching center. There is a coaching center, and this coaching center is getting 3 revenues. From student they are getting 10,000, and from central government they are getting 3,000. From NGO they are getting 2,000. What should be taken as the value of supply? So this 10,000 will be taken as the transaction value, and this 3,000 rupees from central government, will it be included in the value or not included in the value? Not included in the value, because subsidy both are directly linked to the price, because 3,000 per student, 2,000 per student, you understood, directly into the price. But subsidy from central government or state government not included in the value, but subsidy from an NGO to be included in the value. Therefore, what will be taken as the value of supply in this case? The value of supply in this case will be 12,000 rupees. Okay. Now, problem is whether this 10,000 rupees is inclusive of 3,000 and 2,000 or non-inclusive of 3,000, 2,000. That's the confusion where we will be getting. It is very simple concept only. So, subsidy from CGST don't include. Subsidy from others you include. Okay. And if it is not directly linked to the price, you ignore it. But the problem is whether the price is considering subsidy or without considering the subsidy. In this case, this 10,000 rupees is without considering subsidy. Sorry, considering subsidy. After considering subsidy. After considering subsidy. What is the meaning of after considering subsidy? Means the coaching center knows that they will get 3,000 and 2,000 from others. So they would have reduced it from the original price, and they would have collected only 10,000 rupees from the student. Means the given price is based on original price minus subsidy. That is the meaning of considering subsidy. After considering subsidy means the given price. What is the given price? 10,000 is after reducing subsidy, means there is a original price. What could be the original price? 15,000 could be the original price. From 15,000 they reduced 3,000 and 2,000, and they got given price 10,000 rupees. Now what we need to do in that case? In that case, first we need to take transaction value. So what is the transaction value? Transaction value is 10,000 rupees. Now subsidy from CG. Subsidy from CG. As per provision, subsidy from CG to be included or to be excluded? To be excluded. In the given price it is already excluded. See this minus subsidy, already it is excluded. So therefore ignore. Got it? So as per provision, to be excluded. To be excluded as per section 15(2)(e), and in the given price, it is already excluded. So what you need to do? Ignore, don't consider. Okay. Then subsidy from NGO. Subsidy from NGO. Subsidy from NGO, as per provision it is to be included, but in the given price it is excluded. Excluded, we excluded it. So therefore we need to add. So to be included as per section 15(2)(e), and in the given price it is excluded. So what you should do? You should add. How much is that? 2,000 Now you will get the transaction value, the assessable value. The assessable value or value of supply. So that value of supply will be 12,000 rupees. So this is how we need to do. Now sir, what if the given price of 10,000 is without considering subsidy? Then how it will change? If given price of 10,000 is without considering subsidy. What is the meaning of without considering subsidy? Without considering subsidy means the original price itself is the given price. The given price itself is the original price, means they have not reduced any subsidy. They have not reduced any subsidy. Then in that case what will happen, sir? Then same story. First transaction value you will take, and transaction value under section 15 subsection 1, that will be 10,000 rupees, and subsidy from whom? First CG, subsidy from central government to be included or to be excluded? To be excluded. And in the given price what we have done? Not excluded. So therefore we need to deduct. Okay. So subsidy from CG to be excluded, and in the given price it is not excluded. So what you should do? Deduct. So we have to reduce that 3,000. Then next, subsidy from NGO. Subsidy from NGO, it is to be included, and in the given price already included. When it is already included, again are you required to do anything? No, simply ignore. So therefore value of supply will be 7,000. So this is how the answer will change accordingly based on which assumption we need to take. Sir, if the question is silent, which assumption I should take? So just take the assumption as price after considering subsidy. That point I have given there, you can see. Note, if the question is silent, consider the given price as after reducing the subsidy amount given in the question. That is original price minus subsidy is the given price. That's how we need to take the assumption there. Then this conditions for pure agent already we have seen. Now there is one point related to pure agent: passenger service fee and user development fee. Usually airport operators, Airport Authority of India or any airport operator, they will be providing access to the airport to the passengers, for which they will be collecting PSF, passenger service fee, or UDF, user development fee. But this fee they will not collect from the passenger, they will collect from the airlines, and at the time of booking the ticket, airlines will collect it from the passenger. So airlines will pay UDF or PSF to the airport and will recover it from the passenger. So whether this UDF and PSF will be included in the value of the ticket for computing the GST? No, basically this UDF and PSF will come as a pure agent expenditure. Actually it is whose expenditure? Passenger's expenditure. Who is paying? Airline is paying and recovering it from the passenger. And moreover here, so passenger authorizes the airline to incur that expenditure, and the title is not in the name of the airline, and only the actual amount incurred they are recovering. So it is not the personal expenditure of the airline. So therefore pure agent will be applicable, and while computing the GST on the ticket fare, this UDF PSF which the airline is collecting from the passenger should not be included. See there, passenger service fee and user development fee collected by airline operators from passengers are to be remitted to airport operator and falls under expenditure incurred as a pure agent, and it should not be included in the value. Then exclusions from the value of supply as per 15 subsection 3. So far we have seen inclusions, 5 inclusions, and we have exclusion only one, that is discount. So discount is divided into 3. Discount given before or at the time of supply, is it allowed as reduction? Yes. So discount given before at the time of supply, it will be duly recorded in the invoice. It will be allowed as deduction. For example, 10,000 rupees is the product price and I am giving 3,000 rupees as a discount. Now GST will be payable only on 7,000. 10,000 minus 3,000, 7,000 only GST payable. There is no confusion in that. Whereas if the discount is given after supply, so pre-supply discount always allowed as deduction. Post-supply discount. Post-supply discount means what? Discount given after supply. But they are telling whether conditions are agreed before at the time of supply or not, you check. If conditions are agreed before at the time of supply, then in that case, supplier can give a credit note to the recipient, because of which the liability of the supplier will get reduced and the recipient will reverse the ITC. So what is the need of credit note and debit note? Whenever the invoice value increases, basically credit note and debit note is given by supplier to recipient, and the recipient shows what balance in supplier's books? Debit balance. So when the debit balance increases, the name of the document is debit note. When the debit balance decreases, the name of the note is credit note. Now sale invoice given, so recipient will show a debit balance. Now a credit note to be given. Why? Discount. Now when I am giving a discount, what I will do for discount? What is the entry that I will pass in my book, supplier books? Discount. Discount allowed account debit to recipient account. Means recipient I am crediting na. Due to that reason, the name of the document will be credit note. And when credit note is given by supplier to recipient, because of the credit note, the liability of the supplier gets reduced and even the recipient should reverse the ITC with respect to that. Okay, and that is this. Credit note allowed as deduction, credit note shall be issued and recipient should reverse the proportionate ITC. This is in case of post-supply discount. Example for post-supply discount is cash discount. Suppose if it is a post-supply discount and the terms are not agreed before at the time of supply. Example, end of season sale discount. Will it be allowed as deduction? No, it will not be allowed as deduction, which means GST will be payable on entire value before discount. I gave you goods worth 1 lakh and thereafter I gave you a post-supply discount of 40%. Means you will not pay me 1 lakh, you will pay only 60,000. But this post-supply discount terms are not agreed before at the time of supply. Consequently, it is not allowed as deduction, which means I need to pay GST on 1 lakh or 60,000? 1 lakh. Even though I collect 60,000, I should pay GST on 1 lakh rupees. That is with respect to this. Then next one, whether GST is applicable on additional or penal interest on the overdue loan. So basically, if you are not repaying a EMI, so there will be a penal interest that will be charged. Now, in the EMI, whether the interest is taxable or exempted, you check. If the interest involved in the EMI is exempted, the penal interest for non-payment of the EMI is also exempted. If the interest involved in EMI is taxable, the penal interest for non-repayment of the EMI is also taxable. For example, housing loan you have taken. Housing loan EMI interest is exempted because that will come under interest on loans, advances, deposits. As the interest in housing loan is exempted, housing loan EMI is exempted. So for non-payment of the EMI, one penal interest is charged, that penal interest is also exempted. Whereas credit card EMI, so is taxable. Interest involved in credit card EMI is taxable. So when you swipe the credit card and convert into EMI, there will be interest component in the EMI. That interest will be taxable. We don't have any exemption. And non-payment of this credit card EMI, they will be charging a penal interest. That penal interest will be taxable or exempted. That will be taxable. So you need to remember, if the interest involved in EMI is exempted, penal interest also exempted. If the interest involved in EMI is taxable, penal interest is also taxable. So hire purchase transaction. In hire purchase transaction, there will be a EMI. So hire purchase transaction, there will be two parties, hire vendor and the hire buyer. So hire vendor will give the asset on hire purchase, for which the hire purchaser, hire buyer or purchaser will pay the EMIs. This interest is on account of delay in receipt of consideration. So interest involved in this EMI will be taxable. In which EMI? Hire purchase transaction EMI or hire purchase financing EMI? Hire purchase transaction EMI. So non-repayment of this EMI interest, penal interest will come. That penal interest is also exempted. Whereas in hire purchase financing, what will happen? There will be three parties: hire vendor, hire purchaser, and one financier will be there, like Bajaj Finance, etc. Now in that case, the financier will recover the EMI from you. So in that EMI, the interest is exempted because it will come under interest on loans, advances, deposits. for non-payment of this EMI, there will be a penal interest that Bajaj Finance will charge. That interest is exempted. As the main interest is exempted, penal interest is also exempted. Now, that's where many people, instead of calling it as penal interest, they will be calling it as bounce charges or finance charges, etc. for non-payment of EMI. Whether these charges will be taxable? Yes. Be careful in the question whether they are using the word penal interest or finance charges. If it is finance charges, example, same Bajaj Finance, EMI, if you are not missing a EMI, if you are not paying a EMI, instead of levying penal charges, they call it as EMI bounce charges. EMI bounce charges, even though the interest involved in the EMI is exempted, but these EMI bounce charges will be taxable. Why, sir? Because it is not penal interest. Only penal interest is exempted, but not any other charges. The other charges and all will be taxable. You got it? So this logic of penal interest is only for penal interest, okay, not for other charges. So that is about this. Then next point, you see, treatment of inclusions or exclusions in the given price. What we should check is that first, as per provision, whether an amount is to be included. Example, so there is a packing charges. Packing charges included or not? Yes. Packing charges is an expenditure incurred by supplier and charged to recipient before delivery of goods. So definitely the packing charges should be included in the value. But in the given price, it is already included. So what is the treatment? Ignore. Already it is included. Don't add it again. Second, an amount is to be excluded as per provision. Example, so discount, pre-supply discount should be excluded as per provision. But in the given price, it is already excluded. Means the given price itself is after discount. Whether you need to deduct it? No, ignore. An amount is to be included. Example, transportation charges. Transportation charges incurred by the supplier and charged to recipient. So to be included. In the given price, it is not included. So what you should do? You need to add. Then an amount is to be excluded. Example, subsidy from central government or state government to be excluded. In the given price, it is not excluded. Means you need to deduct. Okay. So then, see, next 2 points will complete with this. 2 points you see, whether no claim bonus given by the insurance company to the insured can be claimed as deduction while computing the value of supply. So here, what is this no claim bonus? No claim bonus is like whenever insurance company, you have taken a general insurance. There is no concept of no claim bonus in life insurance. Okay. In life insurance, you cannot say I will not claim, I will die this year, again next year I will be born, I will take, no, there is no concept. So usually in case of general insurance only, there is a concept of no claim bonus. And if you are not lodging any claim in the last year, this year while paying the premium, so you will get a reduction. That is what no claim bonus is. Basically this no claim bonus is like a deduction, pre-supply discount, because we will know this no claim bonus at the time of paying the premium itself, and in the invoice it will be duly mentioned that this is the premium minus no claim bonus, this is the net premium that you need to pay. So it is like a pre-supply discount and it is allowed as a deduction. That is this. Whether no claim bonus given by insurance company to insured can be claimed as deduction while computing the value of supply. Yes, provided the same is shown in the invoice, it is allowed as deduction, because basically it is like a pre-supply discount. Then another circular you see. Usually for this low value UPI transactions, what is low value UPI transactions? Up to 2000 rupees, up to 2000 rupees, low value UPI transactions or Beam UPI transactions or RuPay debit cards. In that case, the people that is acquiring banks will not be charging any processing fee. For C2C, there is no processing fee at all. C2C, consumer to consumer. For example, I am transferring amount to you in GPay, so there is no problem there. So there is no processing fees at all. But B2B and B2C, there is processing fees. For example, you are purchasing a book or you are making some fees to us. So now you will pay using scan and you will make payment. Do you think there is no charges? No, there is charges. There is processing fees. But if it is a low value transaction up to 2000 rupees, there won't be any charges. Why there won't be any charges? Because the acquiring bank like Paytm or PhonePe or etc., these people get an incentive from Ministry of Electronics and Information Technology. So because this UPI platform is developed by Ministry of Information Technology and Electronics, so this incentive received from them is like subsidy from central government or state government, and that should not be included in the value and not chargeable to GST. Is it clear? Read there. Whether incentive paid by Ministry of Electronics and Information Technology to acquiring bank under the incentive scheme of RuPay debit cards and low value UPI transactions. So it is considered in the nature of what? Subsidy by central government, and therefore it will not be included in the value. Okay. So these are the points related to value of supply, and then we have rules related information that we will see in the next class. Okay. So this is about today's discussion, and so tomorrow we will see value of supply, the remaining portion, and as I said, a composition scheme that we will be completing, and even I will take exemptions and RCM. So that is the agenda for tomorrow. Okay. Thank you. So there is one query. In situation 2, how it will affect the manufacturer turnover supply of spare parts for without consideration? It will not be a supply. So manufacturer who is sending the spare part free of cost to the dealer, one example we saw na, will it become supply in the hands of manufacturer or not a supply? Not a supply. Because to become supply, 71C should get attracted. So that 71C will come or will not come. Manufacturer purchasing the part and ITC availed on that part. Manufacturer give the part free to the dealer. You understood? Situation 2 we saw na here. Is it supply or not a supply? It is supply. Disposal of business asset on which ITC is availed. So it will become supply and it will be added to his turnover. Okay. Whose turnover? Manufacturer's turnover. Okay. Then next. In the warranty case 3, is it not simple to treat the transaction as independent, pay for 100 components and charge the manufacturer for that one part used for warranty? We can do that, but in the business practice what will happen? Manufacturer will be sending the parts to the dealer and they don't know which part will be used for free warranty and which part will be used for sale. And logistics. The problem is logistics. For one part, we need to send a courier. Instead of sending a courier for one part, anyhow we are sending at regular intervals parts, so manufacturer will be sending it. So practically that's how it happens. Okay. And tomorrow class timings will be from 10 to 6. That's regular time. So no change in that. Tomorrow, day after tomorrow, that's regular time only. Okay. And please upload only amendment lecture separately. So let me do here, because see, you have to think about my situation also. Just because you cannot attend the revision lectures and you want amendments only separately, so from my point of view also you think of same thing I have to repeat again. I am also human being only now. I am not a mission, and I am going every time extra mile and doing benefit for the sake of students. Just because some person is doing, you should not take things for granted. Little bit have a feeling for me also. First you attend these revision lectures. If time permits, I will do, otherwise I cannot. Okay, please try to understand. Okay. Yes, thank you.